Gentlemen, a very, very good morning to all of you present here. On behalf of SEBI and NISM, it's my absolute privilege to welcome all of you to Samvad 2026, being held here in the financial capital of India in association with NSE, BSE, NSDL, and CDSL. My name is Bhavna Bhatia, in the industry for over 15 plus years, and it's truly my honor to be your master of ceremony for today. Samvad, true to its name, is a platform for dialogue and deliberation. It's a space where regulators, market institutions, industry leaders, as well as the global experts come together to exchange ideas and share those perspectives. Each edition has strengthened this collective conversation. And this year, ladies and gentlemen, we gather under a powerful and timely theme: sustained capital formation. At the time when India's markets are expanding in depth, diversity, and global relevance, today's discussions are not just relevant, they are truly essential. We invite all of you to share your insights and key takeaways on social media using the hashtag Samvad2026 as one word. As we always feel that let's allow these conversations to travel beyond this room today. But looking at such bright faces today in the morning, ladies and gentlemen, I must say I'm extremely elated and honored to be here today. And let's begin by acknowledging each other's presence with a warm round of applause. Can I request our audience members to give a resounding round of applause and acknowledge all of you who are present here in huge numbers. And now, to begin today's proceeding, may I please request everyone present here to kindly rise for the national anthem.
जन गण मन अधिनायक जय हे भारत भाग्य विधाता पंजाब सिंध गुजरात मराठा द्राविड उत्कल बंगा विंध्य हिमाचल यमुना गंगा उच्चल जलधि तरंगा तव शुभ नामे जागे तव शुभ आशीष मांगे गाहे तव जय गाथा जन गण मंगलदायक जय हे भारत भाग्य विधाता जय हे जय हे जय हे जय 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 हे.
Thank you so much. You may be seated. Ladies and gentlemen, as we move forward, we now arrive at a moment that symbolizes the union of tradition and purpose. The Saraswati Vandana, invoking the goddess of knowledge and wisdom, that reflects the very values that underpin strong institutions, informed markets, and responsible capital formation. Simultaneously, we will also witness the lighting of the ceremonial lamp. Here in India, it is a timeless symbol of clarity, integrity, and collective progress. For the rendition of Saraswati Vandana, we have our very own talented students from NISM who are going to be joining us for the same. But for the time being, we'd also now like to invite our distinguished dignitaries with us, a member of Niti Aayog. Let's give him a warm, warm round of applause as we welcome him. Shri Tuhin Kanta Pandey, Chairman, SEBI. Let's welcome our leader with a big, big round of applause. Our keynote speaker, Ms. Samara Cohen, Senior MD of BlackRock. Samara, thank you so much. Let's give her a warm round of applause as we welcome her. Shri Shashi Krishnan, Director, NISM. Let's give him a warm round of applause as we request him to join us on stage for the lamp lighting ceremony. We'd also like to place on record our deepest appreciation for the participating institution whose steadfast support and collaborative efforts have been integral in organizing the symposium. May I also invite the MDs and CEOs of these institutions to the dais for the lamp lighting ceremony. Ladies and gentlemen, the MD and CEO of BSc, let's please call upon stage Shri Sundararaman Ramamurthy ji. Thank you so much for joining us. We'd also like to take the opportunity of calling the Honorary Shri Ashish Kumar Chauhan, MD and CEO of NSC. Shri Nehal Bora, MD CDSL. And Shri Vijay Chandok, MD and CEO of NSDL. Ladies and gentlemen, the applause has to be roaring. We've got such great leaders under one roof. May I please urge our dignitaries to now join us towards the lamp for the lamp lighting ceremony. It's only moments like these that we have such dignitaries here with us on stage.
हे शारदे माँ अज्ञानता से हमें तार दे माँ हे शारदे माँ अज्ञानता से हमें तार दे माँ तू स्वर्ग की देवी है संगीत तुझसे हर शब्द तेरा है हर गीत तुझसे तू स्वर्ग की देवी है संगीत तुझसे हर शब्द तेरा है हर गीत तुझसे हम हैं अकेले हम हैं अधूरे तेरी शरण में हमें प्यार दे माँ हे शारदे माँ हे शारदे माँ अज्ञानता से हमें तार दे माँ मुनियों ने समझी है गुनियों ने जानी वेदों की भाषा पुराणों की वाणी मुनियों ने समझी है गुनियों ने जानी वेदों की भाषा पुराणों की वाणी हम भी तो समझे हम भी तो जाने विद्या का हमको अधिकार दे माँ हे शारदे माँ अज्ञानता से हमें तार दे माँ अज्ञानता से हमें तार दे माँ अज्ञानता से हमें तार दे माँ
Thank you so much. A heartfelt thanks to the talented students of NISM for that serene and soulful invocation of the Saraswati Vandana. It truly was a fitting and the auspicious beginning to Samvad 2026. But ladies and gentlemen, before we begin with the inaugural session, may I please urge all our dignitaries who are present here to please grace us with the occasion of coming together for a group photograph. Can we urge the five of you to please proceed forward? Just allow us an opportunity to capture you first in one frame. And we also feel that when you have such great leaders for the inaugural ceremony, they need to be encouraged with a big, big round of applause, ladies and gentlemen. Such a pivotal moment. We are having such great leaders with us on stage here to kickstart with Samvad 2026, and we are here to begin with the inaugural ceremony. And it's truly a befitting moment that the topmost leaders are here to encourage all of us today. Thank you so much to our leaders. May we request you to kindly be seated, and thank you for being with us today. Before we proceed further, let us take a brief moment to reflect on the journey of Samvad, a journey that started as an international research conference on securities market under the aegis of SEBI and NSIM 7 years back, which was rechristened as Samvad last year. So technically, we're now in its 7th edition. Samvad has evolved as a premier annual platform for thought leadership, policy dialogue, and stakeholder engagement in India's capital market ecosystem. It is truly a hallmark event, ladies and gentlemen, that brings together regulator, policymakers, market participants, investors, and academics to deliberate on the future of the securities market. The journey has truly seen robust discussions on foundational themes such as capital formation, investor protection, market innovation, and technological adaptation. This 7th edition continues our collective mission of shaping ideas and those actionable insights that drive sustained capital formation and truly encourage in deepening the India's securities market footprint, reaffirming our commitment to growth, innovation, and inclusive market development. Ladies and gentlemen, now to formally set context for today's symposium, we have with us a technocrat from IIT Bombay and IIM Calcutta. He was a part of the founding team at NSE. He's credited with setting up the first screen-based trading in India, mobile trading, mutual fund distribution through exchanges, markets for SME shares, satellite telecom, the Nifty index, derivatives trading, and many other modern developments in the Indian stock markets. He's truly considered as the father of modern financial derivatives in India. Prior to joining NSE back in 2022, he was the MD and CEO of BSE Limited for 10 years. He's a member of the University Grants Commission, UGC, the Chancellor of University of Allahabad, and currently acting as a chairman of the board of IIM Calcutta. He's also a board member at the Data Security Council of India, DSCI, and other institutions of repute. He has worked in the Reliance Group as the group CIO and as the CEO of Mumbai Indians IPL cricket team in its formative years. He contributes extensively to public policy as a part of several forums and is a visiting faculty member, indeed, at the Nottingham University, UK, and Toronto Metropolitan University, Canada. He's been awarded many awards in India and abroad, including the Lifetime Achievement Awards by Regulation Asia and by Outlook Business in 2025, India's Impactful CEO Award by the Times Group in 2025, CEO of the Year by Asia Asset Management in 2025, Most Influential CEO by CEO Monthly in 2024, Lifetime Achievement Award by the Global Custodian in 2023, and trust me, many more. A book has been titled The Process of Maintaining an Equilibrium, addresses his life's journey, called Sthita Pragya. Ladies and gentlemen, I've had the honor of meeting him on multiple forums, and indeed, today, it's such an honor to have him once again join us. Ladies and gentlemen, let's give it up for none other than the MD and CEO of NSE, Shri Ashish Kumar Chauhan.
Dr. Arvind Virmani, Honorable Member, Niti Aayog, Shri Tuhin Kanta Pandey, Chairman SEBI, Sushri Samara Cohen, Senior Managing Director, BlackRock, Shri Sashi Krishnan, Director, NISM, whole-time members, executive directors, and other senior officials from SEBI, distinguished leaders from market institutions and the industry, colleagues from NSE, colleagues from other market infrastructure institutions, members of the media, ladies and gentlemen. Good morning. It's a privilege to welcome all of you to Samvad 26, convened by SEBI and NISM, a forum to reflect on how our markets have evolved and to shape how they must evolve in future. May I especially welcome Dr. Arvind Virmani, our chief guest today, who I associate for over 32 years when I was in process of setting up NSE and he was in process of making policies for enabling NSE to come up at Ministry of Finance, and also congratulate him for his contribution to India's economic thinking and public policy over all these years. Sir, we are honored to have you with us today. On a personal note, since I was 25 years of age, I have been associated with Samvad, with SEBI, government, industry, intermediaries, and investors. Over 3.5 decades, through that Samvad, together, brick by brick, we have built the modern markets that we see today. Samvad here carries that same spirit, constructive dialogue, shared responsibility, and nation building. The theme of Samvad 26, sustained capital formation, beautifully captures India's long-term economic ambition. It brings together three powerful ideas: sustain, capital, and formation. Each word matters, and together they frame what India must get right on the road to Viksit Bharat as envisioned by our Honorable Prime Minister, Shri Narendra Modi ji. Let me start with the last word, formation, because it is often seen through a narrow lens. Capital formation is not the same as capital mobilization. Mobilization is only the starting point. Capital formation is what emerges, the value, wealth, and productive capacity created through economic activity enabled by the capital. Indian households have experienced this very tangibly. Estimates suggest that since April 2020, household wealth creation in equities has been about 53 lakh crore additionally. That is called capital formation. Which brings me to the second word, capital. India needs capital at scale for infrastructure, industry, innovation, urbanization, energy transition, and the aspirations of our young population. NSE has facilitated 76 lakh crore of capital raised since April 22. In 25 alone, NSE enabled about 20 lakh crore, out of which about 15 lakh crore through debt and 4 lakh crore through equity. On the primary markets, NSE facilitated 222 IPOs in 2025, raising 1.8 lakh crore, reinforcing India's position amongst the world's most active IPO markets and underscoring NSE's leadership amongst the top IPO platforms globally. Debt markets are a significant part of this mobilization. Since financial year 22, over 60 lakh crore has been raised through NSE's debt platforms. In calendar year 25, of 15.1 lakh crore mobilized through debt instruments, 9.2 lakh crore came through commercial paper and 5.9 lakh crore through privately placed NCDs, while public NCDs issuance were only 2,257 crore. Market-based financing is also expanding through REITs and InvITs. Since financial year 22, business trusts have raised 1 lakh crore through NSE, including 33,860 crore in 25. Municipal bonds are also emerging as a bridge for urban financing with 7 issues in 25, and social stock exchange is enabling purpose-driven capital with 14 projects having raised 43 crores so far. But capital is not enough. Can we sustain it with trust and discipline? The first word, sustain, means three things: trust and governance, resilience through cycles, and sustainability in later in spirit. Financing India's transition. Over the last 3 decades, India's markets have transformed from fragmented, manual, open outcry trading over 23 exchanges to a fully electronic, nationwide, real-time ecosystem. Today, India is the 4th largest capital market globally. Market capitalization of NSE-listed companies, over 466 lakh crore or $5.2 trillion, over 130% of its GDP. With close to 3,000 listed companies on NSE, the market cap is almost 1.6 times the banking sector's all assets. Participation has also become truly national. 12.5 crore or 125 million unique investors hold 245 crore plus or 245 million plus accounts across 99.85% of India's PIN codes on NSE. The median investor age is 33, and nearly 1 out of 4 investors is a woman. Individuals and mutual funds now hold 19% of market capitalization, the highest share in over 2 decades. This scale reflects a structural shift in how India finances growth, but it is only the first chapter. The next chapter must be about institutional maturity, trust, and purpose-driven capital allocation. This brings us to the central question before us today. How must capital markets evolve to finance India's next phase of growth? Being a developed economy will require sustained high growth over the next 2 decades, around 8% in real terms and 10 to 12% in nominal terms. That trajectory demands a clear setup in investments. India's investments rate must rise from 30% of GDP to 35%, with a large share coming from market-based financing to complement bank credits. Translating this mandate into reality requires us to deepen capital formation across both equity and debt markets. On the equity side, this means expanding SME as well as infrastructure pipelines, reducing issuer frictions, and crowding in long-term domestic institutions, particularly pension and insurance capital. India's ecosystem, 2 lakh startups and 35,000 medium-sized registered MSMEs represent a substantial pool for future listings and capital mobilization. And the SME market itself is maturing from exuberance to discernment as more enterprises from Tier 2 and Tier 3 step forward. The promise is enormous, but so is the responsibility to ensure discipline, disclosure quality, governance standards, and fit for market preparedness. The opportunity in debt markets is even larger, and it is strategic. India's corporate bond market has expanded meaningfully, but it remains about 15 to 16% of GDP, well below global peers. Participation by MSMEs, retail investors, and FPIs is still limited, and secondary market liquidity remains uneven in debt market. So this is just not a market development agenda, it's a national financing necessity, and we should also be candid about the structure of debt mobilization today. Much of it is still concentrated in short-term and privately placed instruments. That is why the next step is not just more debt, it is more transparent, widely distributed, liquid, listed public debt for long term. With coordinated reforms, market infrastructure, simpler processes, broader investor participation, and deeper secondary liquidity, Niti Aayog projects that India's bond markets could grow to 100 to 120 lakh crore by 2030. This is the ambition we must rise to, with every participation acting as a market builder, improving transparency and liquidity, widening credit risk, pricing beyond narrow AAA silos, standardizing structures to build confidence, and using tools like partial guarantees and blended finance to expand access for mid-rated issuers. India's net zero commitment will require over 10 trillion of financing. This cannot be financed through public resources or bank balance sheets alone. Capital markets must play a central role. Encouraging green bonds, sustainability-linked debt, and green equity issuances are expanding. NSE's green equity pathway, with its orange, green, and dark green classifications, is designed to bring transparency and credibility to sustainable investing. Trust is market infrastructure, and at the core of trust is strong corporate governance that keeps markets fair, efficient, and transparent. This democratization has been supported by safeguards such as segregation of client funds, margin discipline, pledge, repledge mechanisms, online dispute resolution, robust protection for funds, and a strong clearing and settlement framework that provides institutional-grade assurance. Equally important is investor education. In 25 alone, exchanges conducted more than 30,000 awareness programs across India, reaching more than 20 lakh participants across the country. I congratulate NISM and Shashi Krishnanji for the steady work to strengthen investor education and market capability. As millions of first-time investors enter the markets, we must shift from protection to preparedness through financial literacy, product suitability, and swifter grievance redressal. As markets scale, institutional maturity must translate into structural protection. We are already seeing this shift: direct payout of securities to client demat accounts, upstreaming of client funds, auto-pledge mechanisms, obligation-based debits, and the discontinuation of the client unpaid securities, measures that reduce risk while improve ease of doing business. Under SEBI's guidance, steps such as technology-based regulatory submissions, rationalized penalties, and pruning low-value filings are helping intermediaries focus on outcomes over paperwork. And for investors, measures like verified UPI payments, investor charters, and simple safety tools such as voluntary freezing of accounts are strengthening transparency and confidence. Susri Samara Cohen's presence here today is meaningful. Sustained capital formation benefits enormously from stable long-term global capital. We value foreign participation not just for flows, but for what it represents, enduring confidence in India's institutions and market integrity. NSE International Exchange in GIFT City, IFSC strengthens this bridge to global pools of capital in a well-regulated international setting, adding a powerful pathway to India's capital formation story. As participation scales, technology and resilience becomes as central to trust as regulation. On peak days, NSE systems process over 20 billion order messages and 300 million trades in 6 hours and 15 minutes. But digital scale also brings digital risk. So cyber resilience is treated as a stability priority. AI can strengthen systems and compliance, but only with explainable models, audit trails, and human oversight, tested responsibly through sandboxes. And SEBI is doing a remarkable job in all these areas. And in a social media age, when narratives can travel faster than numbers, public markets must stay anchored to fundamentals. I take this opportunity to express my sincere gratitude to SEBI, to the entire SEBI team of officers and colleagues who work tirelessly and purposefully so that India's market shine and grow. A special thanks to Chairman Shri Tuhin Kanta Pandeji. Sir, since you have taken charge, we have seen a clear step up in the quality of engagement across the market, more meaningful dialogues, faster clarity on key issues, and a calibrated approach that supports growth while keeping governance and trust at the center and provides ease of doing business. The entire ecosystem feels more confident and positive than ever before. Today's discussions at Samvad, capital formation, debt market, green finance, investor participation, technology resilience, and market governance reflect the seriousness with which India is preparing for its next phase of development. We'll also release the Investor Survey 2025 today. I look forward to that. On a lighter note, last year, Samvad 25 was held at NSE. This year, SEBI has chosen a new venue, and many more participants are participating. So congratulations, SEBI team, for increasing the popularity of this very, very important event. But may I place a friendly request? Next year, Samvad 27 should return to NSE. So, sir, we look forward to have you Samvad or other initiatives at NSE. As I welcome all of you once again, I wish Samvad 26 a great success, and I look forward to the ideas and discussions. Thank you. Jai Hind.
Thank you so much, Mr. Chauhan, for that thoughtful and comprehensive opening and for setting the tone for today's deliberation. Ladies and gentlemen, we now move on to the keynote address, which brings a valuable global perspective to our theme. It's our privilege to welcome our next leader, who's a senior managing director at BlackRock and the global head of market development there. A member of the BlackRock's Global Executive Committee, she has played a pivotal role in shaping global capital markets, strengthening market structure, and expanding investor access through innovation in ETFs and index investing. Over the years, she's been recognized amongst the most powerful and influential women in finance. Ladies and gentlemen, it's indeed our honor to welcome on stage and the dais now, as she's present, let's call her Ms. Samara Cohen.
Good morning. It's an honor to join you here in Mumbai, a city whose energy and history as a financial center remind me of my own roots in my native New York. This is my first trip to India, and I made sure to arrive early. Thank you. joined by some gracious colleagues who agreed to spend part of their Sunday with me. We walked the waterfront in Bandra, envisioning how today's skyline emerged from a cluster of 7 islands, and witnessing firsthand how Mumbai's evolution as a financial hub has been shaped by trade, exchange, and a vision for the future, long before stock exchanges, electronic bond markets, or digital payments took hold. Our guide did tell me that Mumbai is better compared not only to New York, but also to Washington, D.C. and Los Angeles, because Mumbai uniquely combines finance, politics, and entertainment. I look forward to seeing a bit more of the city before I leave tomorrow night. As we just heard so eloquently from the NSC leader, markets are built on trust. Trust that contracts will be honored, rules will be clear, and risks will be shared fairly. This trust isn't automatic. It's forged over time through law, regulation, and the daily actions of market participants. India's history is a testament to this, from informal trade networks built on reputation to the sophisticated capital markets we see today that are supported by robust frameworks and oversight. In 2008, as the global financial crisis unfolded, I was working on the trading floor in the derivatives business of a bank that was in the headlines day after day, embroiled in debates over the role banking and derivatives had played in the shocks experienced around the world. I was also a new mother with a 22-month-old son and a daughter who was born 3 weeks after Lehman Brothers declared bankruptcy. The day before her birthday was one of the largest market drops in history. Experiencing this loss of trust in our markets as a new parent ignited my passion to make markets more accessible and more resilient so that more people could understand, participate, and trust that they will deliver. The reforms initiated after the GFC have created a much more resilient system and earned back some of that trust, but there is much work still to do to ensure that more investors can participate in economic growth. Today, India's market capitalization exceeds 5.5 trillion. Mutual fund assets under management have reached almost $1 trillion, and over 200 million investor accounts are active. These are remarkable achievements, but they also bring new responsibilities to strengthen market integrity and resilience, and to ensure that India's markets remain trusted, robust, and globally competitive. India's markets have weathered global volatility and attracted record foreign inflows. FPI turnover surpassed $1 trillion last year, up from less than $400 billion in 2017. India's capital markets have also outpaced most emerging markets in growth and innovation. The market cap to GDP ratio has risen from 70% in 2016 to over 130% today. And regulatory advances, such as T1 settlement and strengthened surveillance, have set new benchmarks. Retail participation is at an all-time high, with 78% of investors under 40 years old. And during my visit to the NSC this week, I was delighted to learn that 1 in 4 Indian investors is a woman. This is amazing, but I think we can do even better. So let's talk about how we can close some gaps and unlock even more opportunity. While 63% of households are aware of the securities market, only about 9.5% actually invest. Of the more than $1 trillion of annual household savings, only about 5 to 6% is invested in equity markets. Sitting in cash may be one of the biggest risks for an investor whose wealth accumulation will not keep pace with inflation. Fewer than 100 million Indians have pension exposure to capital markets, and foreign investors account for a smaller share compared to other regional markets, suggesting underinvestment in India by the rest of the world. These gaps are opportunities to turn retail cash into investments, to foster foreign investment, and to streamline market access. So what can SEBI industry, and investors do together to close these gaps? I would propose 3 areas for consideration. First, continue to innovate in ways that center on better experiences for more investors. Second, improve market structure and practices to deepen liquidity, encourage foreign investment, and better align incentives with positive outcomes for capital formation. And third, lead the world in setting standards for resilience in this increasingly digitalized financial world. So on my first point, let's talk about innovation and access. Investment funds, like mutual funds and ETFs, have been transformative around the world and also in India, helping investors move from owning individual shares with risks concentrated in a single company to accessing broader, global, diversified opportunities. Pooling capital efficiently also creates important economies of scale for those raising capital. SEBI and the investment industry in India should be incredibly proud of their work to educate individual investors. Since its launch in 2017, the mutual funds Sahi Hai campaign has helped drive India's mutual fund folios to over 200 million and mutual fund AUM to a record 900 billion, making mutual funds a mainstream investment choice. By simplifying investment and building awareness, the campaign has empowered millions of new retail investors. Monthly systematic investment plan contributions have grown 8 times to over $3.5 billion US, a critical shift towards long-term, disciplined wealth creation. During my visit with Geo BlackRock colleagues earlier this week, I saw further evidence of this trend. Of the 1 million investors they have, over 18% are first-time mutual fund investors, and 51% have active SIPs. Through digital means, Geo BlackRock is reaching investors across 95% of India's postal codes, and 40% of retail assets are coming from outside the top 30 cities. This success is a function of offering high-quality investment solutions supported by convenient tools to access the market. Indexation and ETFs are redefining investor access globally, with ETFs now surpassing $11 trillion worldwide. Expanding India's index investing and ETF ecosystem is critical. While ETF assets are growing, they remain concentrated in a handful of funds and are primarily institutional in users, and the runway ahead is enormous. ETFs have had a modernizing effect on markets around the world, deepening transparency, liquidity, and resilience when supported by strong market structure foundations. Around the world, ETFs represent 5 to 15% of equity market capitalization. But in India, ETF assets total just over 100 billion, or around 2% of the equity market. An improved stock, borrow, and lending framework will support a balanced two-sided market. This will increase cash market liquidity, especially beyond the top 100 names. It will strengthen hedging capabilities and improve secondary market liquidity. This, in turn, will reduce dislocations between cash and derivatives markets. India's derivatives markets are well developed and will be a key dimension of a healthy ETF ecosystem. ETFs with options ecosystems around them demonstrate higher market quality. And by this, I mean deeper on-exchange liquidity, tighter spreads, and more competition between market makers, especially when supported by strong security borrowing and lending practices. Chairman Pandey's commitment to reviewing the stock, borrow, and lending frameworks will be critical to unlocking these investor benefits. Additionally, market-making frameworks, perhaps led by the exchanges that balance obligations and incentives, can encourage quality participations by liquidity providers. And continued improvements to customer onboarding and KYC processes will also be critical to making it easier for investors to enter markets through investment funds.
So on to my second proposal, market structure improvements. To build resilience, we must strengthen market structure. Implementing a formal closing auction will reduce volatility and align India with global best practices. Globally, closing auctions account for about 15% of daily volume, whereas in India, 20% of volume occurs in the last 30 minutes of trading, leading to higher volatility and creating challenges for both index and active investors. SEBI and the Indian investment community should be commended for the thoughtful analysis that has gone into considering this step. Streamlining trade netting and repatriation by moving from gross leg-by-leg settlement to a single net cash and FX instruction will reduce operational risk, cut funding friction, and align India with global standards. For foreign investors, this would reduce intraday funding requirements, minimize idle cash, and lower operational complexity. By freeing up balance sheet capacity and cutting transaction costs, netting can support greater participation in Indian markets. India can also improve access to its corporate bond market by partnering with global electronic trading and RFQ platform providers to create a seamless, transparent, and standardized execution environment. Such collaboration will enhance liquidity, reduce transaction costs, and align India's corporate bond market with international best practices. And it will also enable the development of a fixed income ETF ecosystem, making it easier for individuals to diversify their fixed income investments. Finally, onto digital and operational excellence. At BlackRock, we often use the phrase always on markets to describe the increasing demand for real-time access to trading and investments. The future of market resilience is digital resilience. Investing in seamless digital public infrastructure, interoperable APIs, high-quality data, and efficient onboarding is essential. Leveraging technology, AI, machine learning for surveillance, potentially blockchain for settlement and readiness for tokenization will future-proof India's markets. India is structurally positioned to be a first mover and potentially the reference model for the next phase of digitized finance. The combination of digital public infrastructure, high fintech adoption, and an explicit strategy to export these rails gives India a credible path to set norms for digital finance across markets. We congratulate SEBI on decades of work to democratize investor access through tools such as centralized KYC, Mutual Fund Central, and ASBA. These capabilities are significant differentiators for the Indian market and will support its next stage of growth as many more households become long-term, successful participants in the markets. So, as I reflect on my first visit to Mumbai, I'm struck by how this city's financial ecosystem resembles its iconic banyan trees, deeply rooted, ever-branching, and capable of sheltering and supporting millions. In New York, our own markets trace their beginnings to something a little humbler, a group of traders gathering under a buttonwood tree on Wall Street to formalize the rules of exchange. Two different continents, two different trees, yet both symbolize the same truth. Strong markets grow when trust takes root, when participants agree on shared principles, and when everyone can see a path to opportunity. Mumbai's banyan-like expansiveness and New York's buttonwood beginnings meet in the vision we share today. Markets that are resilient, inclusive, and built for generations. BlackRock is committed to being part of that journey, working with SEBI, industry, and innovators to help India continue sharing the canopy under which more households, savers, and entrepreneurs can thrive. I'm genuinely grateful for the opportunity to be with you today, and I'm looking forward to exploring a bit more of this extraordinary city before I leave tomorrow. And I can't wait to tell my husband about a sign I saw in Bandra that read, "A fisherman lives here with the best catch of his life." This made me laugh, but it also struck me as a reminder that the most enduring successes, whether in families or in markets, come from cherishing what you have and doing the work to help it thrive for the long term. So together, let's engage, collaborate, imagine, and shape a future for India's capital markets that creates more opportunity for more investors and builds long-term prosperity. Thank you again for having me today.
Thank you so much, Ms. Samara Cohen, for those insightful perspectives and, of course, for setting that strong global context. Let's give her once again a big, big round of applause to express our gratitude to her. Ladies and gentlemen, it is now our privilege to call upon our next speaker, a distinguished IAS officer and one of the key architects of India's financial and market reforms. He was the Secretary of the Department of Investment and Public Asset Management, and in January 2025, ahead of the Union budget, he was appointed the Revenue Secretary. With his deep experience as a former Finance and Revenue Secretary, he has led landmark initiatives including the LIC IPO, Air India disinvestment, and major fiscal reforms. His leadership continues to strengthen market integrity, investor protection, and confidence in India's capital markets. His 4 core focus areas lie around trust, transparency, teamwork, and technology. And let me assure you, the multiple times I've had the opportunity of hearing him, it's truly been great and iconic. And now it is time for us to call on the podium the chairman of SEBI. Ladies and gentlemen, let's give it up for none other than Shri Tuhin Kanta Pandey.
Shri Arvind Vermani ji, Honorable Member Niti Aayog, Shri Ashish Kumar Chauhan, MD&C UNSC, Shri Ms. Samara Cohen, Senior MD, BlackRock, Shri Shashi Krishnan, Director NISM, distinguished guests, industry leaders, members and colleagues from SEBI, ladies and gentlemen, a very good morning to all of you. It's a privilege to welcome you to Samvad 2026, SEBI's annual symposium on the securities market. The name Samvad, which is dialogue, a conversation, captures the essence of why this platform exists. Markets thrive when ideas flow freely, when assumptions are tested respectfully, and when institutions listen as much as they speak. This forum is more than an event. It's a shared space for reflection on where our market stands and where they must go. This year's theme, Sustained Capital Formation, goes to the heart of India's economic journey. Capital formation is not simply about raising funds. It's about converting household savings into productive enterprise, about enabling innovation to scale, about allowing aspiration to find expression through opportunity. Most importantly, it's about building confidence because capital flow most freely where trust runs deepest. Today, I would like to reflect on one overarching idea. India's capital markets are no longer merely supporting economic growth. They are increasingly shaping the quality, resilience, and inclusiveness of that growth. We are meeting at a time when India's economic story commands global attention. The latest GDP estimates project real growth of around 7.4% for 25-26, following 6.5% growth in FY25. India now stands as the fourth largest economy globally. At a time when many economies are contending with the weak growth, high debt, and persistent uncertainty, India continues to demonstrate resilience and momentum. This performance rests on deliberate structural choices, investment in physical, digital, and social infrastructure, reforms in taxation, and sustained efforts towards improving ease of doing business. But a less discussed, yet equally powerful transformation has been unfolding alongside the growing centrality of capital markets in financing India's development. As the economy has expanded, so too has the role of the securities market as an engine of capital formation. A decade ago, capital markets were often seen as a supplementary to the banking system. Today, they have become structural pillars of the financial architecture. Over the past 10 years, equity and debt markets together have facilitated average annual issuances of about 9.6 trillion rupees. This is capital that has flowed into highways and ports, into renewable energy and semiconductors, into manufacturing corridors, startups, MSMEs, banks, and fintech platforms. Even this year, the momentum remains strong. Between April and December, that is 9 months of FY26, companies have already raised more than 3.8 trillion rupees in equity, while corporate bond issuances have reached nearly 6.8 trillion rupees in the first 9 months alone. For the second consecutive year, we have witnessed record IPO activity, 311 IPOs in the first 9 months, following 320 IPOs in previous financial year FY25. This reflects issuer confidence that Indian markets can deliver scale, efficiency, and long-term capital. More structurally, we are seeing a shift in how Indian businesses are financed. Outstanding corporate bonds, which were around 43% of bank credit to industry and services a decade ago, now stand at nearly 56 trillion rupees, close to 60% of bank credit to these sectors. This diversification of funding sources strengthens systemic stability and reduces concentration risk. The evolution is also visible in broader indicators. India's market cap to GDP ratio has risen from about 69% in FY16 to nearly 140%, over 130%, but nearly 140% by December 2025. This signals not just market growth, but the increasing integration of capital markets with national wealth creation. Yet the most significant transformation is not merely quantitative, it is social and demographic. India today has 140 million unique investors compared to 38 million in March 2019. Participation is no longer confined to metropolitan centers. It's expanding across geographies. The profile of investors is also changing. Approximately 69% are below the age of 40, compared to 55% in FY19. These are young citizens placing long-term faith in India's economic future. Mutual funds illustrate this shift powerfully. Industry AUM has expanded from 12 trillion in FY16 to nearly 80 trillion today. Average monthly SIP contributions in FY26 have reached about 28,500 crore compared to 7,700 crore in FY19, a more than 3.7-fold increase. Moreover, the AIF ecosystem has expanded from just about 0.2 trillion rupees in FY16 to over 6 trillion today, channeling risk capital into startups and emerging sectors. And today we are celebrating 10 years of startups, and there's a very big event in Delhi. Honorable Prime Minister is also addressing that event. Together, these developments point to something fundamental. Indian households are no longer passive savers. They are becoming informed participants in wealth creation. Capital markets are no longer elite institutions. They are becoming public institutions in the truest sense. Such transformation does not occur organically. It requires regulatory philosophy to evolve. Our role is to ensure fair access, encourage responsible innovation, protect integrity, and support long-term market development. The objective is not to choose between growth and protection, but to design systems where both reinforce each other. This philosophy underpins the reforms undertaken across the ecosystem. We are trying to build an easier path for capital formation. For issuers, access to capital must be efficient and predictable. Over recent years, we have streamlined IPO processes, simplified compliance pathways, and enabled practical solutions. For instance, facilitating compliance with lock-in requirements even when shares are pledged. Founders can retain certain ESOPs post-listing, preserving incentive alignment without compromising transparency. We've introduced a single filing system to eliminate duplication, simplified related party transaction disclosures, and recommended changes to ease minimum public offer households and timelines, thresholds and timelines for achieving MPS, particularly relevant for large issuers. Comprehensive reviews of key regulations covering mutual funds and stockbrokers have been undertaken to make them more coherent and contemporary, while the review of LODR and settlement regulations is ongoing. These reforms aim to convey a simple message: Indian markets should be rigorous in standards, but reasonable in processes. Capital formation also depends on market depth. To strengthen the debt ecosystem, thresholds under the electronic book mechanism have been reduced, and the scope of electronic book provider platforms has been extended to include REITs and InvITs. Participation in these instruments has been facilitated by expanding the definition of strategic investor and by reclassifying REITs as equity for mutual fund investments. In the AIF space, the minimum investment for large value funds has been reduced, and efforts are underway to promote investor accreditation alongside greater flexibility for accredited investor-only schemes. These steps aim to ensure that sophisticated capital can flow more efficiently to emerging enterprises. For global investors, the introduction of the Swagat FI framework represents a move towards unified registration, simplified documentation, and reduced compliance friction. We are also progressing towards fully paperless, digitally signed onboarding for FPIs. Market microstructure reforms have also been prioritized. Changes to the block deal framework addressed long-standing investor concern, while the introduction of the common contract note with a single VWAP for institutional trades improves clarity, auditability, and operational consistency. Each of these measures serves a common purpose: building markets that are deeper, more transparent, and more accessible. Participation must be inclusive. Growth without inclusion is fragile. Expanding participation geographically and demographically has therefore been a central focus. Distributor incentives have been redesigned to encourage onboarding of first-time investors from below 30 cities and to enhance participation by women investors. Debt issuers are now permitted to offer incentives in public issues to promote retail participation. The minimum investment size for privately placed bonds has been reduced, lowering the barriers for individual investors. For NRIs, we have eased requirements that earlier mandate physical presence in India for certain KYC processes. To further simplify onboarding, we are considering enabling access to supplementary account opening form information through KRAs, reducing repetitive documentation and improving data consistency. These are small changes individually, but together they contribute to a market that feels navigable rather than intimidating. As markets widen, confidence in their fairness becomes the bedrock of sustained participation. Tools such as validated UPI handles and SEBI check enable investors to verify intermediary accounts before making payments, and it's a 30-second check. Active monitoring of social media helps identify misleading or manipulative content. The Unified Investor app provides consolidated visibility across holdings and simplifies engagement through e-voting and access to proxy advisor inputs. The Parva initiative ensures that performance data presented by intermediaries is verifiable and comparable, helping investors make better informed decisions. And certainly this Parva has just been launched, and as it grows, it could actually be, in our opinion, quite a landmark in the world. Our investor awareness efforts will continue to expand across languages, media platforms, and institutional partnerships. Markets ultimately reflect institutional behavior. Recognizing this, we have taken several measures to strengthen governance and accountability across the ecosystem. SEBI has designated the compliance officer as a key managerial personnel, reinforcing accountability at the highest operational levels. We have mandated that regulated entities dissociate from unregulated entities that make unverified claims on returns or performance. To strengthen governance of market infrastructure institutions, we have specified norms for appointment of key directors and mandated periodic performance evaluation of MIIs and their statutory committees by an external independent agency. We have also taken steps to enhance transparency and quality of disclosures. Disclosures in price band advertisements for public issues have been strengthened, and we are introducing an abridged prospectus at the draft office stage to improve information accessibility for investors. Looking ahead, we are in the process of developing a technology roadmap for market infrastructure institutions, which will provide a structured short-term as well as long-term strategic technology vision for the securities market ecosystem and further enhance its resilience. No regulator, however effective, can build a marketplace alone. Boards must pursue governance as culture. Institutions must invest in capability, in cyber resilience, data ethics, organizational efficiency, and integrity. Market participants must view transparency as a strategic asset, not merely an obligation. Capital markets are collective institutions. Their credibility is shaped daily by the conduct of every participant within them. Our priorities ahead are clear: promoting sustainable finance, encouraging innovation anchored in investor protection, and ensuring responsible use of technology and data. But beyond specific initiatives lies a broader aspiration to build markets where growth, governance, and convenience reinforce each other. India's financial system stands at a rare intersection of opportunity and responsibility. Opportunity because participation is expanding and economic momentum is strong. Responsibility because trust must be preserved as scale increases. The decisions we make today in regulation, in institutional conduct, in professional ethics will determine not just the efficiency of our markets, but their legitimacy in the eyes of millions of citizens who now participate in them. I am confident that discussions at Samvad today will contribute meaningfully to shaping the next phase of India's market evolution. Let us use this forum to think beyond immediate pressures, to learn from diverse perspectives, and to reaffirm a shared commitment to markets that are efficient, inclusive, resilient, and worthy of public trust. Thank you. Jai Hind. I wish you all a thoughtful and productive Samvad 2026.
Thank you so much, Shri Tuhin Kanta Pandeji, for joining us. Truly a forward-looking and inspiring address. Let's once again encourage him with a warm, warm round of applause. Always such a pleasure hearing from you. Thank you so much for joining us for the same. Now, ladies and gentlemen, it's my true honor to welcome our chief guest for today. A globally respected economist, he's somebody who's played a defining role in shaping India's macroeconomic and policy framework. He's somebody who has served as the chief economic advisor to the government of India and as the executive director at the IMF, bringing that rare global and domestic policy experience. His thought leadership continues to guide India's growth, reforms, and long-term economic vision. We're truly privileged to have him here with us today. Let's give it up for the Honorable Member, Niti Aayog, our chief guest, Shri Arvind Virmani ji.
SEBI Chairman, honored guests, ladies and gentlemen. I'm usually very brief on my intro because I have this tendency of overshooting my time, but I try very hard, so excuse me if I don't go into other things. So, next slide. I'm going to talk about Viksit Bharat. Yeah. Three things I will talk about. A little bit about Viksit Bharat and its growth aspects, because that I thought would be of most interest to you. Two very important global trends which are critical to India's growth, world demography and concentration of manufacturing, and then some very brief observations on financial regulation. Next. So, Viksit Bharat. It loosely translates into developed India, but it's way beyond that. We won't go into the details, but the goal is very clear, and it requires sustained, fast, inclusive growth over the next 25 years. So I will start by telling you a little bit about the foundations of growth, present a kind of baseline scenario, and say a little bit about the aspirational aspects. You know, I was in Planning Commission for a long time, and we always had an aspirational scenario, which we knew may not be achieved, but it's always good as a motivator. So let me start with the first, the link on GDP growth. Not very clear, huh? So on the left, we have per capita GDP, and on the right, we have GDP growth. Just look at any one of these graphs. Let's take the left one. So this is the rate of growth of India relative to the world. That is the pink line, and the blue line is the rate of growth of India relative to China's. And what we see here, I have given from 2000, but if you see over 20 years, 30 years, what has been happening is that the rate of growth of India has been accelerating with respect to the rest of the world, and also with respect to China. And in the case of China, we have just crossed the line from negative to positive. So this is a historical trend, and this is the foundation on which we are going to build. Next link. Next link. Yeah. Now, people talk a lot about employment, so I thought I'll just put one graph of employment. This is the employment growth over the last 8 years, and this is a positive trajectory. This is the employment population ratio. What this shows is that the rate of growth of job creation is faster than the growth of population, okay? This is an incontrovertible trend. The interesting thing behind it is that the share of females in the workforce is increasing. Behind this is a rising ratio of female workers to male workers. Back. So there are a whole bunch of other graphs I could show, but I'll just say, if we look at other factors like poverty, multidimensional poverty, consumption, all across the board, there has been improvement over the last 11, 12 years. So the foundations of future growth is very strong. So on the basis of this, I'm going to show you one scenario which has OECD projections for the rest of the world and has my assumptions, baseline assumptions for India, which is an average growth of something like 6.1%. Let's go to the link. So this is a projection, as I said, based on, this is an index of mine which I've had since about the last 20 years, which broadly reflects what happens in the current the US dollar GDP for all the countries. The interesting point, as I said, is this is a growth rate which is actually marginally less than what we have achieved over the last 14 years, which is an average growth of 6.2% per year in real terms. So what does it show? The red line here is India. The pink, below pink brown, etc., are Russia, Japan, and Germany. The blue line is China, and the green line is the EU. So basically, at a growth rate of a little over 6%, which is very, very achievable, we will equal the EU and China by 2050. And as you all know, we've talked about, everybody has been talking about India becoming the 4th largest economy. If you look down here, where I say the VIP is already exceeds, it's an index of economic power, which I'm showing you. And as I said, in a couple of years, so we already, in terms of VIP, Russia, we've already overtaken Russia in 2023, Japan in 24, and Germany in 25. But the current US dollar GDP will reflect this in a couple of years. You've already seen the chairman also said that our GDP is now larger than Japan. In the next few years, it's going to exceed Germany. Back. So a little bit about the aspirational aspects. You have all heard the Prime Minister talk about a 30 trillion economy. That is more in terms of current GDP. As an economist who's worked on GDP, I tend to think of real growth and measurement in GDP PPP. But let's talk a little bit about this aspirational. So whether it's 30 trillion or the World Bank definition of high-income country, that requires a growth rate of between 7 and 8%. If we look at the reforms which are going on, I think this has not been fully appreciated either in India or abroad, actually. I have been in the reform business. I call it a business because people find it very strange. So it's good to mock oneself. I've been in this business since around the 1980s, 30 years. And I can tell you, this is the largest reform since the 1990s. But this is not getting through. That's why I'm spending a little bit of time on this. What it's going to do is it's going to raise the growth potential of the economy by at least 0.5%, but more likely up to 1%. It's a reform which is not over. It is not just central government. It's happening at every level. And again, I can tell you the speed with which some of the states are adopting these reforms. I have been, again, in this business for 30 years. And the speed with which the states are adopting some of these reforms, like land reform, etc., is truly amazing. Next. Back. Next. Sorry. Next. Yeah. So the two trends I mentioned, the scenario was to whet your interest. So what is going to be behind it? There are two very important trends, as I said, which are going to help us reach these goals, the 7%, 8%. As I said, the 6.2% and catch up, in my view, is the easy part. It's going to happen. So what are these two trends? So one is global demography. I'm going to show you some graphs about the worker population ratio and the labor force across the world, what is going to happen in the next 25 years. Say a little bit about how India's global comparative advantage is going to develop, and then mention very briefly about the challenges which we face. So first link. So on the left, we have the change in worker population ratio of different countries. I'll just tell you about it. On the right, we have the change in labor force. Okay? Now, if you look at the countries, I don't know whether you can read them. China, you all heard about. But next is EU, Japan, USA, Russia, South Korea, and what I call the MIC5. Those are generally the countries which are thought of as potential competitors of India, like Vietnam, Thailand, Malaysia, etc. All of them, the worker population ratio is going to go down. Only India's will increase slightly. But look at the workforce. So these are estimates. The right side is estimates. The left is based on UN data. So the right side is my estimates. So you can see, again, China's labor force is going to shrink. Again, that's been talked about, but what is not talked about is the EU, Japan, USA, and everybody else's labor force is going to shrink, actually literally shrink, compared to India's, which is going to rise. So this is the huge demographic change which is going to occur over the next 25 years, which is going to determine global trade, etc. Back and link, next link. Next link. So there's a tendency to think that means low quality labor or low labor intensive work. No, what this graph shows you is the change in the the portion of the labor force which has past schooling and those which are past college, right? So the blue bar represents those who have school education and the red bar which have college education. So again, we estimate, these are again my estimates, we estimate for the EU, for Japan, USA. So you can see the EU and Japan are going to decline across the board, okay? And many other countries, I've just shown you two here, in terms of both the school, the labor force which has schooling, secondary schooling as we call it, and tertiary level. The USA will increase slightly, okay? Their share will increase slightly. The MIC will also increase, but India will increase hugely, okay? So again, the shift is across the board. Next, back and link. Right, so let's go to the next slide. Next slide, yeah. So what is it? So India is going to be comparative advantage in human capital is going to increase over the next 25 years. So really, this is a huge opportunity we have to exploit. This is not something which will occur naturally. And I spend my time thinking about what to do. I'm just going to tell you a little bit about what I call the education pyramid, the job skilling pyramid, and the employability, which is talked about. You know, you must have heard we say we produce a lot of engineers, but they are not employable. Okay? So education pyramid. Over the last year or so, I have been looking at something called minimum learning proficiency. So this is the bottom of the pyramid. Okay? I am less worried about the top of the pyramid because people like you, people like NIMS, and I'm so sure SEBI chairman are going to help develop the skills, all of you actually, I depend on all of you. But at the bottom of the pyramid, you know, we are actually not that bad for our per capita GDP. But there's a huge challenge if we are going to get to that Viksit Bharat point. And it turns out that this is not rocket science. So UP and Odisha, which are generally thought of as the poorer states, have increased this minimum, the bottom of the pyramid, by 11 to 12% point improvement over the last decade. So it is not a difficult thing, it's just a challenge. We have to understand the challenge and make it happen. Similarly for skilling, there is a skilling pyramid. So one has been looking at all kind of training centers, ITIs, polytechnic, etc. There's a huge challenge there to improve the quality. But it turns out, again, the situation is not hopeless, because what we are seeing is the outcomes in terms of independently measured employability has improved across the board. So whether it's the polytechnics, whether it's the ITIs, whether it's BA educated people, BSc, etc., and the professional courses, over the last 8 years or so, the employability is increasing. So that is the good news. But good news should not be taken as such. The challenge is still huge, and all of us have to make sure the skilling happens. Next. Next. Sorry, yeah. Okay, so second trend. So first is this changing comparative advantage, human capital for India. I don't have time, but I don't know if there are questions, I'll talk about AI. That's another challenge, but I'm not going to talk about it in my limited time, which is 10 minutes. Okay, manufacturing concentration. Let's go to the first link. This is the biggest challenge facing the world today. And again, we have to see how we can take advantage of it and make it happen in combination with the human capital, which I mentioned. So this is the graph of merchandise exports. That red line there is China. That is the share of manufactured exports of China, and the second one there is US and Germany, okay? So you can see how rapidly the share of China has increased. It is now larger than the combined share of Japan and Germany and USA, okay? They used to be at the top. USA used to be the top exporter of manufacturers. Germany used to be down there. I don't know if this is working. Oh, can't see it. Okay, doesn't matter. Same thing which people don't focus on, the next link, is the world share of manufactured value added. What is happening inside China? Same thing. Massive increase in the share of China in the world manufactured good production. Okay? It's roughly, you can see from there, it's about 80% larger than that of USA, which is still number 2. Okay? USA has been declining, China has been rising. And incidentally, I should mention here, we did projections of this for pre-2018 and post-2018. I don't know how many of you remember that 2018 were the Trump 1 tariffs. Okay? It's made a difference. Okay? I don't think the current tariffs are very rational, but the 2018 were actually quite well thought out. And you can see the little dip out there. If it had continued on its way, there are projections from UNDP which say that the share of China in total manufacturing production in the world would have gone up to 40 to 50% in the next 10 years. Next. Link. So all this, is this imaginary? No. So here is something we call the Hirschman-Herfindahl index, okay, in 2008 and 2021. So in manufactured exports, it's increased by about 40% over this period. In manufacturing value added, it's increased by almost 60%. So huge concentration of manufacturing in China. It's a risk. You can imagine what kind of risk it is for the whole world, not just for India. Back. Okay. So, I mentioned the 2018, etc., and the effect of 2018. So let's go to the next slide. So building competitive supply chains. I said this is going to be a trend. No matter what's happened in 2025, I am firmly of the view that this is something which the world cannot ignore, okay? They ignore the concentration of manufacturing in one country, okay? So what is it going to be? What is it? What's the problem? As others have pointed out, one of them being Rush Doshi in the USA, that that the US, EU, and India together have the potential scale to challenge, because the gap is now too huge for any one country to do, including the USA, including Germany, okay? Incidentally, I didn't say, but India is the 4th largest manufacturer in the world after China, USA, Germany, and Japan. Okay? But together, we can do it together, US, India, EU, India, or all three together, okay? Because the gap is now too large. It's too risky for any one company to invest, for any one country to do all across the board. So, because you need assured demand. As you know, the latest data shows that the volume of Chinese exports is going up, but the unit value is declining. That's another polite word for dumping. Okay? So you can't compete unless you have a joint demand. Supply costs can be reduced by combining the comparative advantage of India with US or EU, which was my first point. And finally, it's part of India's strategy to have FTAs with HTDCs, what I call high technology developed countries, again, to utilize that comparative advantage and to incentivize MNC supply chains to set up joint supply chains in India and these countries. And just, I should mention that the transitional costs need government support. That is why we have these schemes like PLI, etc., the state support for land, which we have been urging different states. You know, again, you must remember, land is a state subject, so all the central government can do is nudge. You know, we can nudge, we can incentivize, we can support and to them to do ease of doing business. Okay, next. So, so that's the main part of my story, but before I end, I thought, because it's a seminar on finance, but by the way, all those things I've said should be relevant for financial sector also, but I'll say a few words on financial markets as I see this in connection with what I've said before. So, firstly, I think one of the great developments, again, you've got to remember, I have a long horizon backwards and forwards, but the big change which I've seen is this change in household investment. You know, I've been on many committees in the past on statistics, etc. We used to have, I don't know how many, I think probably maybe 1 or 2 people here know, there was this big thing in the national account which was direct investment, savings and investment by household. It was measured physically, okay? Physical investment was also savings, SHH equal to I. The big change which I'm seeing is that this household saving, instead of being just directly invested in houses, etc., is going into the financial sector. I think that's a big trend which is going to be very good for India, because it will increase the efficiency of the whole investment. Several people, including Chairman Sebi, have talked about that. It's not just the finance, it's what is translated into actually investment, how efficient and good that is, that matters. Okay? So, a couple of related points. So, fintech, I think I have talked to people and based on this, so clearly fintech, reducing the cost and risk is very important for the regulators to facilitate this. Because, and this is an age-old problem which I'm sure all of you know and the regulators certainly know, is balancing the innovation potential versus investor risk. So my suggestion is only, I'm sure maybe you've already thought about it, but this is a constantly changing thing. You know, the world is changing, India is changing, so my suggestion would be have some kind of a standing committee mechanism which constantly evaluates and re-evaluates things. It's not a one-time thing. It's not going to be, especially if you think of that curve, you know, that's why I put it up. The steepness of that curve means there are going to be a lot of changes happening internally, you know, with that kind of growth relative to the world. So it's not a one-time thing. That's the point. Secondly, long-term debt market. I've been talking about it. Mr. Chauhan was very kind to mention all kinds of things, but I've been involved in it from the creation of NSE, actually. So we've been talking about it about the corporate debt market, how to promote it for at least 30 years. I remember myself being in meetings. So it's a tough challenge. But if you can find a solution, you know, people like me always think of the macro, but recently in going down, talking to people, perhaps there are micro solutions. So that would be my solution. Go down and see, are there little constraints? You know, we don't think of it. We are big people. I'm sitting in office in Delhi or something. But I think going down into the micro structure and seeing, are there little problems which are kind of holding this back? So that would be my second suggestion. And finally, of course, risk capital is critical. You know, that's a challenge for, and maybe I've run out of time, but okay. So as SEBI chairman mentioned, today is the 10th anniversary of PM mentioning or encouraging startups. I think this was one of his great achievements, besides, by the way, sanitation. I'll take a minute. When he got onto the ramparts of Red Fort and talked about toilets, I thought it was incredibly brave of him, by the way. I was the first person to welcome it because I've been talking about toilets for 20 years. Not very important, hugely important, Anyway, I won't divert to that. So, startups, okay? So the issue of venture capital, private equity, I'm sure again you're looking at it, that'd be my third suggestion, but let me end with a couple of stories. So a few days ago, I met a small entrepreneur who has developed product and technology for the distributed food sector. So I'm sure some of you know that in the USA and the West, there are huge, large companies with centralized food processing. In India, food processing of all stages occurs all over the country, small scale. He has invented a combination of AI and small, nothing, it's the idea which counts, you know, solving a problem. And he is running up against a wall. So it is not just funds, it is mentorship, okay? Knowledge, he doesn't know how to expand, okay? He doesn't know how to push this great technology which he's invented, in my view. By just talking to him, by the way, I wouldn't market it, but without knowing further. In fact, I've told him I'll come and see his factory where he's installed it. So that is one. The second is, in my visits, I don't want to mention a company, but you know the kind of products, you know, let's say EVs, mobiles, whatever. So in one factory I visited, they were looking to make these very sophisticated tools which they were using, which have to be replaced, let's say, every 6 months or every year. So they searched all across the country, and they found one company, small company, okay? Which, they called the guy, talked to him, and their idea was that maybe it'll take 12 months to make this tool. So the guy asked, when do you want it? They said, if you can, you know, we expect 1 year, but if you can do it in 9 months, that would be great. He said, don't worry, I'll do it in 6 months. And believe me, in 4 months, he had delivered this sophisticated tool, not even 6 months. So what's the point? The point is there are lots of hidden gems. I've come across stories from handicraft manufacturers of very sophisticated companies which are out there, startups. These are not the traditional small and medium. Small manufacturers who are going and looking for quality. So that's a challenge. I'm leaving it as a challenge to all of you. If any of you have ideas, feel free to contact me and come and give it. Thank you, and I wish you the best in your...
Thank you so much to our chief guest, Sri Arvind Virmani ji, for gracing us on Samvad 2026 with his presence and, of course, his visionary thoughts. Once again, let's encourage him with a warm, warm round of applause, ladies and gentlemen. Now, since we're in the inaugural segment, we're pleased now to release the report of the Investor Survey 2025. An important initiative of SEBI in collaboration with AMFI, NSE, BSE, NSDL, and CDSL. For this, along with our dignitaries who are present on stage, may I also take the opportunity of inviting our set of experts on stage, the MD and CEO, ladies and gentlemen, of BSE. Once again, let's give it up and call upon stage Shri Sundara Raman Ramamurthy ji, along with Shri Nehal Vora, MD CDSL, Shri Vijay Chandok, MD and CEO NSDL, and Shri S.L. Pandian, Deputy CEO AMFI. Let's give them a big, big round of applause as we welcome all of them. While one of the largest household surveys of its kind conducted by Kantar, the survey captures those perspectives, behavior, and expectations of both the investor and potential investor. This survey will serve as a valuable input for targeted investor awareness and policy formation to promote responsible investing and make India's security market more inclusive. Truly a pivotal moment as we now request the reports to be presented on the stage. And may I urge all our eminent dignitaries to please take the opportunity of unveiling that report for us. Ladies and gentlemen, this is the report of the Investor Survey 2025. And may I urge all our dignitaries to kindly take the opportunity of unveiling that report. And of course, your round of applause can only add more energy to them. So ladies and gentlemen, at Samvad 2026, please give a big, big round of applause as we celebrate the official launch of the report of Investor Survey 2025. Come on, we can be much more energetic with that applause. Keep that going. To promote responsible investing and make India's securities market more inclusive. Thank you to our dignitaries for joining us on the same, and may I request our dignitaries from the inaugural address to please stay back and stay seated. But meanwhile, congratulations to all those who worked towards the report of Investor Survey 2025. May I urge our inaugural address dignitaries to please stay seated. Well, truly a great moment here to celebrate, and what better than inviting our next leader for the closing remarks. Well, he's somebody who brings nearly 40 years of experience in pension fund management, life insurance, and mutual fund industries, with extensive expertise in equity and debt markets. He's been an active member of the Index Policy Committee of India Index Services and Products Limited, the Capital Markets Committee of the IMC Chamber of Commerce and Industry, and the co-chair, ladies and gentlemen, of the Life Insurance Committee of the Bombay Chamber of Commerce and Industry. Please join me in giving a big, big round of applause as we welcome now on the dais the Director of NISM, Shri Shashi Krishnan.
Dignitaries on the dais, industry leaders, distinguished guests. As we draw this inaugural session to a close, I find myself reflecting on what the word Samvad itself means. Chairman did say that Samvad is dialogue. If I may add, sir, Samvad is also constructive discourse aimed at finding direction. And I think the direction, after listening to all the dignitaries on the dais, is very clear. We are looking to architect a future-ready India. And I think the insights that were shared by the dignitaries over the last hour and a half are not merely academic. They're really laying out a roadmap for our economic sovereignty. And I think, as many of these speakers said, we are standing at a junction where I think India is breaking out of this moniker of, a developing market. And in spite of that, I think, as our speakers have pointed out, this requires more than just momentum. It requires a structural rethink, which I think the regulator and the policymakers are clearly doing. And we also need to mobilize and deploy, as Ashish rightly said, capital to make this work. And a lot of the data that our speakers have put out, has really been overwhelming. But I think the opportunities that they highlighted are even more exciting. And I think it is these opportunities that will be the underpinning of the discussions we're going to have here today. So, as many of the speakers had pointed out, the gross capital formation in India did see a drop from something like 36% to 30% where it is today, and possibly because our savings rate did drop a little bit over the last couple of years. But I think this calls for a very sophisticated and intense approach towards both raising and deploying capital, which I think the next few decades and years will, possibly see us, working on. The second thing that Mr. Virmani did pointed out is that we have shifted dramatically to becoming a service sector-driven economy. And in the graph that he put out, slide number 12, if I remember right, where he showed global manufacturing, India did not figure in that slide. I hope the next time around Dr. Virmani comes here, we'll see India on slide number 12. The concentration of corporate capex also has, unfortunately, even in manufacturing, been on utilities, energy, materials, etc. And I think in spite of the fact that we've had things like the National Infrastructure Pipeline, the PM Gati Shakti, and a whole host of programs that have been crowding in private sector investment, I think we need to remember that we are at a state where the government and the state can sort of build the rails, but it is for us in the private sector to raise capital and run the engines on those rails. I'd like to express my deepest gratitude to the speakers for dissecting the complexities with such surgical precision. Dr. Arvind Virmani, your analysis of the structural shifts of our economy has sort of provided us the necessary macro lens. VIPE clearly is very, very exciting. I did mention to you this last year also. But I think what I'm even more excited is that Dr. Virmani has gone beyond that three-sector model to the three-pyramid model. And I think his paper, he tells me, is going to be out in the next couple of days. And it will be very interesting to see how the employment pyramid, the skill pyramid, and the opportunity pyramid, the education pyramid, the skill pyramid, and the employment pyramid sort of get together to, make this economy even more sort of vibrant. I think the other point that struck me specifically is that while all of us understand capital as, the money that flows into putting up, manufacturing infrastructure and other facilities, Dr. Virmani specifically talked about human capital. And that's something that, we must add to our understanding of what capital means. And I think that's going to be extremely important for us in the years to come. Mr. Pandey, Chairman SEBI, thank you, sir, for highlighting both the government and the regulators, single-minded commitment and purpose to improving the ease of doing business. And you listed a whole set of, initiatives that the regulator has taken to sort of ease doing business. And I think one thing that struck me very, very starkly was that he said, we are making small changes, and they may look like small changes done individually, but at the end of the day, they make markets less intimidating. And I think that's the most important thing in raising capital. We need to make the markets less intimidating and more accessible to people. Samara, your perspective as a global gatekeeper of capital was invaluable. I know that ETFs is something that you would obviously have to push in a forum like this, and we in India are clearly going that way, and I think passive capital and ETFs will be a big driver of how capital will come into this market. And I think you did mention that if you wanted to reduce volatility in the market, we will need India to align with global best practices. And I particularly liked the always-on, markets philosophy that you brought to this conversation. Ashish, you touched upon, I think, the most vital nerve, that missing middle, where large caps now command 75% of the market, but where is the capital for startups and SMEs? And if we need to build modern markets, then we really will need to sort of get trust to be central, and that would be especially important for the SME and the startup sector, because market integrity and governance will become very important. I'm sure the technical sessions that will follow will give us even deeper insights to a lot of the points that our speakers have raised. As SEBI chairman said, we in India are looking for patient capital, we are looking for long-term capital, and though we must attract global capital, I think we at the same time must build up resilience, and resilience was something that sort of echoed through a lot of what most of our speakers talked about. And this should be capital with a purpose, especially if you're looking at the green transition, the digital transition that India needs to make to reach the Viksit Bharat 2047 goals. And lastly, obviously we need a more candid discussion on startups, SMEs, and how the regulatory hurdles that they face, the valuation gaps, the need for liquidity, all this I presume will be debated in some of the sessions we have through the rest of the day. And we also must reimagine investor education and financial inclusion in a digital world. So with this, I formally close the inaugural session of Samvad, and invite you to the technical sessions that we go forward with. And I think we will reassemble in a very short time for a fireside chat that Mr. Tuhin Pandey, Chairman SEBI, will have with Lata Venkatesh of CNBC. And thank you very much for coming in today, and Jai Hind.
Thank you so much. And with that, ladies and gentlemen, we're now going to be taking that opportunity of felicitating our dignitaries on stage. Shri Shashiji, can you please stay back? Can we request our dignitaries to please stay back on stage? May I now invite and may I encourage Shri Tuhin Kanta Pandey ji to first felicitate our distinguished guests. If you can do us the honor of first felicitating Mr. and Shri Arvind Virmani ji. Can I request? In frame, we have the Chairman SEBI and our chief guest, Shri Arvind Virmani ji. May I also encourage the Chairman SEBI to now felicitate Ms. Samara Cohen. We now take the opportunity of requesting the Chairman SEBI to now felicitate Ms. Samara Cohen. Thank you so much to our dignitary for joining us. Let that applause continue, everyone, as we take this opportunity of felicitating our distinguished guests of the day. We'd also like to request Shri Amarjeet Singh, whole-time member, SEBI, to please join us on stage. Can I request Shri Amarjeet Singh, whole-time member, SEBI, to please take the opportunity in felicitating the Chairman, SEBI. Ladies and gentlemen, please give a big, big round of applause once again for Shri Tuhin Kanta Pandey ji. I always feel that the energy has to come from the audience. And we're here together at Samvad 2026, and we're taking the opportunity of thanking the Chairman SEBI, Shri Tuhin Kanta Pandey ji. May May I now further invite Shri Sunil Kadam, Executive Director, SEBI, to felicitate our dignitary Shri Ashish Kumar Chauhan ji. We're requesting Shri Sunil Kadam, Executive Director, SEBI, to now please join us and further felicitate Shri Ashish Kumar Chauhan ji. We'd like to humbly thank all our dignitaries, our guests of honor, for giving us their valuable time. May I further request Shri Sunil Kadam, Executive Director, SEBI, to felicitate Shri Shashi Krishnan, sir. Can I request Shri Sunil Kadam to now further felicitate Shri Shashi Krishnan. Let's give them a big, big round of applause, ladies and gentlemen. And of course, such a powerful inaugural segment this has been, and your applause can be a testament to the impact they have created. So can I encourage all the audience members, as we finally request all of them for a group photograph, all the dignitaries on stage, can we request all of you to take that moment in giving your loudest round of applause. What a fantastic inaugural address, opening segment this has been. Such an honor having all of them at Samvad 2026. And ladies and gentlemen, do not go anywhere, as we're going to be moving ahead to our next segment. Thank you once again to our dignitaries. Thank you for joining us. To each and every one of you out here, stay seated, as in the next few minutes, we're getting ready for our next session. Allow me an opportunity as we get set for our fireside chat, which is going to feature the Chairman SEBI, Shri Tuhin Kanta Pandey, in conversation with the Consulting Editor, CNBC TV 18, Ms. Lata. May we urge all of you to just allow us a few minutes before we get set for our next session, but can we kindly request you all to stay seated. Thank you so much. Ladies and gentlemen, we're about to begin with the fireside chat. Can I request all of you to kindly take your seats? Thank you. Well, all of you out here present, I'm sure all our delegates are waiting for what lies ahead. And currently at Samvad 2026, we're all set to commence the next session. Ladies and gentlemen, that's going to be a fireside chat. May I urge all of you to continue that conversation in the next break. But for the time being, can we please urge each and every one of you to kindly stay seated? In an increasingly complex global environment marked by geopolitical shifts, capital fragmentation, and evolving risk perceptions, the long-term investors truly seek markets that offer stability, transparency, regulatory certainty, and depth. As we now here welcome for the fireside chat, ladies and gentlemen, we are now joined by Shri Tuhin Kanta Pandeji, Chairman, SEBI, along with Ms. Lata Venkatesh, Consulting Editor, CNBC TV 18. This fireside chat will be focusing on confidence in the market, continuity of investments, and a vision on India as a destination for long-term global capital. We're looking forward to Ms. Lata to further curate this forward with our guest present on stage. Over to you, Ms. Lata.
Thank you very much, SEBI and NISM, for giving me this opportunity. It's to the credit of both these institutions and the exchanges and the mutual fund community that, as Chairman of SEBI has repeatedly said, in the last 5 years, the unique investor community has gone up from 3.8 crore to over 14 crore. That's a seminal achievement. So let me start over there, the expansion in this community. One of the big fears for this community now is, are we losing the favor of foreign investors? Does that worry you? I mean, whether it is the currency market or the bond market or the rupee market, the fear that FPIs have kind of sidelined us for the past 2 years. Anything that SEBI is doing to just make them feel more welcome?
I think this is not really an issue of being welcomed or not welcomed. I think the frameworks, Indian regulations are well in place, and FPI's decisions are contingent on how they look at different markets and returns, and also look at earning growth. They also look at currencies. And they also look at geopolitical factors. And they are, in a position to come in and go out as well. Now, if you are really looking at, the FPIs are there to the extent of $900 billion invested into Indian market. And yes, there has been, $18 billion movement over a period, outflows over the period. But it also depends upon cyclical factors. So on regulations, we can only say two things. One is making our markets deeper and more diversified, especially the debt markets, the corporate bond markets, and so that, to some extent, it will be within, not pro-cyclical, but other approach can be taken. The people can shift also from equity to debt, depending upon the situations, depending upon the circumstances. The second issue, of course, is, are there any frictions which we can improve structurally, whether we can improve the market? So one area which we have really looked at it very closely is the registration process. How we can have, registration which is faster, digitizing the whole process, looking at, whether the FPI, KYC across SEBI and RBI can be done very quickly. We've introduced the concept of Swagat FIs, bringing in greater amount of certainty in registration period over a period of time, less paperwork, more flexibility. And going forward, I think that particular thing will also expand. Digitizing, digital signatures, even otherwise also allaying certain fears that they had following the, the threshold and other levels which were brought in, and they were also relaxed. So other points, of course, we are looking at very closely is netting. And I think the consultation paper will be out very, very soon on this to allow them to net in some respects so that there is a greater operational efficiency while they operate.
When do you think we may see us getting closer to it? I guess there'll be some conversations with the banking system also on that. So, should we expect it sooner rather than later?
Maybe it is out today.
Oh, excellent. I think that deserves a round of applause. That's a big headline you've given us. I will expect more in the course of the conversation. Actually, what I wanted to ask you was, we are up again, there's an upcoming budget.
Now, there was also, for example, Samara mentioned, the earlier that we are looking at, closing auction session.
Yes.
Very closely. And I should presume that that circular will be out also possibly today.
Ooh, another round of applause. So we are getting two headlines over here from the chairman. So I would ask you
I'm not too sure, but they're very close to issuing it.
I mean, if it's today or tomorrow, but the point is that, Samara had to speak about closing auctions, and SEBI is ready with it, shows an extremely proactive regulator, and many congratulations for that. But, like I said, an unfair question, because we have the upcoming budget. One of the complaints you get from FPIs on our channel is the withholding tax. You've been at North Block, now Kartavya Bhavan. You think there is a case to withdraw it simply because now we have to fight for FPI funds more?
I would not like to comment on, that's not my prerogative indeed, and this is not the forum also to express on this issue close to the budget.
Okay, fair enough. I take your point that it was your former responsibility, not your current responsibility. But, speaking of FPIs, and just to conclude that conversation, clearly valuations are an issue. I mean, we're running at 22 times when earnings are growing at probably single digit. And therefore, that constantly FPIs are coming and telling us that. One reason which comes from the market is that this highly differential capital gains tax between equity and debt, and this big tidal wave of investors who have come from 2020 to 2025 largely have gone to equity because people are not planning asset allocation depending on their risk appetite. They're not planning asset allocation because of their age. I know retired people now going to, direct index funds, equity funds, simply because the tax is less. So you think that this is now becoming counterproductive? Purely as an academic and someone who has been in Kartavya Bhavan before, do you think this at least merits a debate? This very wide difference between capital gains on equity and fixed income.
Again, I would like to avoid my thoughts on this issue close to the budget. I think you are already, different people have been talking about it, and Finance Ministry will take a view, and it's the Honorable Finance Minister who has to take a view.
Oh, yes,
the end of it.
Okay. Let me put the ball directly in SEBI's arena itself. Can you give us the third headline? You already told us last week NSE IPO announcement may come very soon, and the settlement issue is something you've taken in your stride. You've taken a call on. Can we hear when the final NOC comes? Since you're in a mood to give headlines.
No, I mean, I've already indicated, so there is no more further information.
No, the NOC comes soon, like this week.
No, I said within this month.
Okay, fair enough. I was hoping you would say within this week. That's why I asked you. Okay, sir, let me now get to the other issue of corporate bonds. The corporate bond market, from time immemorial, from the time I joined journalism, I'm asking questions on when will we have a more vibrant corporate bond market. Anything up your sleeve now?
So first of all, corporate bond market is more vibrant than before. So whether that should be still more vibrant,
is
and
the question.
I agree, it will be still more vibrant.
I mean, we trade only, we hold to maturity most of the bonds. Trading is less.
That's not correct.
And even issuance, mostly AA or A above, not below.
I'm afraid that's not correct. It's not that completely HTM. There is, bonds are being traded, and there is, you can check the volume. Maybe we would like volume to be higher. Maybe we would like, and I think the whole, our both SEBI and RBI working closely on bond derivatives and bringing in an extra, opportunity to look at it, because secondary trading in bonds is taking place, but it needs to be much, much better. There are certain constraints. So if you really look at the size of the bond market, I indicated, it used to be, about 40% a few years back of the total bank credit to industry and services. It's now climbed to 60%. So the 56 lakh crore are outstanding bonds. Certainly they are, lower than what it is there in China or other places. And we have a constraint that we have not too many still issuers. So number of issuers need to expand. Similarly, there has to be a number of different rated and more than, A-rated and below bonds must also come in to give the proper yield curve. And those efforts are continuing. Third important issue is that even if we say that the retail participation in bonds, that we have facilitated by bringing down the threshold from 1 lakh rupees to 10,000. And online bond platform providers are providing liquidity and availability to the retail investors. But of course, we need to do far more. So in terms of education and awareness regarding corporate bonds at the retail level, certainly it is largely missing. And therefore, we need to have something like you had that mutual fund Sahi has, something like a campaign to go around and also make people educative about what it entails to invest in bonds, because you need not always say that the bonds you have to hold till maturity. You can also dispose it. The question is whether the secondary market will offer that purchase and sale. We did give liquidity window facility saying that you can give a put options, but so far not much movement has taken place. Not many issuers have come forward. Still the market is OTC market. We have also provided the platforms. We have an RFP platform at the primary stage and the RFQ platform at the secondary stage. And many steps have been taken to improve transparency in the market. Secondary market trading has improved, but far from what is desired. And I believe that bond derivatives will be another way of also creating further liquidity and depth in this market. The other issue, of course, you have mentioned that there is a differential in taxation treatment, and that is something which certainly may be under the consideration, because so much is being debated and discussed already in the media about it.
No, actually, it's being debated. Since Nilesh Shah is here, I'll take the liberty. He was on stage a few months back, and he said, began as a debt fund manager. I would love to continue as a debt fund manager, but because its fortunes have been eclipsed by tax, I have chosen to become CEO. He mentioned himself, Navneet Mulnoth, Sandeep Sikka, all of them, beginning as debt fund managers, ending up as CEOs. So, it is a widespread issue. You spoke about transparency, so let me, take off on that. SEBI has done a lot, but every now and then there are issuances. I don't want to name names. There were 2 companies where disclosures were even pulled up by the courts for not making disclosures, at the right time. Now, of course, on other things like entities and fin influencers, you have Parva, as you said. What are you looking at in terms of improving disclosures, higher penalties, or, as you point out, institutions like Parva?
I think one normal thing which should not be really, accusing SEBI of is the lack of disclosures. No. I think this institution, SEBI as an institution, if you look at it over a lot of period of time, has given every possibility, every system for the disclosures. And we constantly say that this is a disclosure-based regime. Yes. Even for that matter, when valuations, it's clearly, we don't look at the valuations because you have to let the markets work. Our job is not to become the market, yes, but let the markets work, where there are buyers and sellers and the expertise and the traders and the speculators and the arbitrators. So we have to really be, very clear that disclosures, wherever possible, we make. And so therefore we make disclosures, we make compulsory disclosures wherever for primary purpose in terms of IPOs and FPOs. There are disclosures for corporate governance, all kinds of disclosures. The companies need to disclose. So an LODR has been amended to facilitate such disclosures. Materiality of disclosures have been there. So I think on disclosures, SEBI's record is not of a recent origin, but of a very longish origins. And therefore, this market has actually developed.
No,
now,
I agree with you.
Sometimes, of course, there was an issue of excessive nature of, the very lengthy disclosures, and now the people are wanting, how quickly we can grasp it. And we have heard their voice. For example, in case of IPOs, we said, and I think very soon we will be notifying it, but the board has approved it, that we will have a draft abridged prospectus whenever the IPOs are issued, and there will be a QR code. People can access it in all these advertisements. So the draft abridged prospectus also we will define very clearly all the factors which are needed to be disclosed for very quick glance by the media as well as by the investors.
So to be fair,
we want more active participation of investors in terms of their understanding of what it contains. But we have to also educate always investors, and so is your duty to educate them, is to not to have always a herd mentality, to really look at their exposure, do a bit of their research. Today there are opportunities available of a very high order in order to really find information and find all kinds of information. So therefore, before they take investment decisions, they should be clear where they're investing.
No, I like the backhand shot, lobbing it back to the media. We are using agentics to, derive main points from, IPO disclosures and other large disclosures. Maybe a more educated agentic from SEBI will be more helpful in that direction. But let me come to the other issue you raised in your speech as well. SEBI has been excellent in ensuring that capital market does its main job, allow companies to raise capital. And the latest strides in including REITs as to be defined as equity, goes a very, is a very large step. And then now, of course, InvITs also. Can you inform us as to what are the other steps in the direction if you have to think of a second round of improvement of capital raising from the market? Anything on your mind?
We have a whole range of measures, and we have different kinds of markets, and we have different types of risks which are associated with the market. We want to really make it available as a very diversified market with diversified regulations, keeping with the view the diverse needs and the diverse risk profile of the investors. And we should not have always a one-size-fits-all. For example, the investor protection, the investors themselves are of a different types. What it means for an institutional investors may be different from a retail investors. What it will mean for an accredited investor will be different from an ordinary investor who is, So therefore, we have to look at, in derivatives, we have to look at it, well, who is really, who knows the market. So there is an investor education. We have also to see that what markets the investors will be more comfortable with. And there could be a light touch regulation for those areas where we feel the risk is well understood by the investors. Like, for example, AIFs. And therefore, we have an AIF accredited investor scheme only. And we are going to liberalize the way the accreditation is granted, because that itself will speed up the process of such investors to come and quickly come to the market. And there will be other markets where we will be more intensive in regulations, because there is so much of retail money is involved.
Exactly, sir. And you all already showed your hand when the FNO trades burgeoned and SEBI put out repeated studies indicating how retail investors are not always benefiting. Have you seen any change in their behavior? You also brought out that excellent investigative report on one of the high-frequency traders. Has it changed behavior according to you, or will more rules be needed?
That is for us to constantly see and examine. So I don't think that I am in a position to give a very clear answer on that. And all these measures also do take time.
No, you also said at that time, in one of your many speeches, that the volume of the derivative market is way more than the volume of the cash market, and so we will try to increase the depth and volume in the cash market as well. Is anything on the way?
There are several things are on the way, and you will hear them. The stock lending and borrowing mechanism was mentioned. There is a group which is looking at it. I think there are SEBI committees looking at it. Our people are working at how to increase the cash market liquidity. It's already doubled, more than doubled over the last 3 years. It's more than 1 lakh crore per day, but it could be better. Okay. So therefore, wherever we can to do this thing, because the markets are good when they are liquid, particularly delivery markets.
Okay. Fair enough. Well, speaking of that, I was just thinking the Securities Markets Code bill is on the anvil, and that is, among the many things, it is also looking at expanding the SEBI board. What are your views? If from 9 it goes to 15, will it mean slower decision making, or, because more people will come with their points of view, or could it mean maybe less independence because more people will be prevailing upon you? Any reaction to that proposal?
See, this SMC is with the Parliament.
Yes.
And the Parliament, the Standing Committee on Finance is looking into it.
Discussing it.
And so therefore, the Standing Committee on Finance, once they invite us, we will give our views there.
Okay, but that is something which is exciting attention, at least among regulators, not so much among investors. The other very interesting point you made in your speeches, and I assume that the report that you all released today will have more of it, that survey where you point out that 63% of Indian households are aware of securities market, but only 9.5% actually invest. Is there anything further you all are doing? We've already seen your ads, the SEBI-sponsored ads. anything more to ensure that those who are aware of the markets become active investors?
So here I would say that our member Sandeep Pradhan is very actively engaged with all market participants and others, drawing up a strategy of investor awareness.
Yeah.
How do we really reach out to millions of people? Because we are doing, as a matter of course, several such seminars are organized. We have smart investors, we have RISA seminars. But there is a need to, in view of the survey results, and I must say that this kind of survey has been done for the first time, and the fact that all of the important market infrastructure institutions and participated in it really indicates a collective desire of our SEBI ecosystem to understand the problems in a more granular manner. We just can't be taking, hunches. We have to go down actually deep into the cities and towns and villages to understand what's going on in the minds of the people. And then learn, how they can be made aware of these things better in the languages they understand, in the medium they understand, in the forums they could probably do better. And this survey is providing us several such strategic choices. And the whole system under Mr. Pradhan is now working to do a next way of campaigning. It also includes a number of themes that could be taken for this, including the theme of responsible investing that you indicated.
Okay. Well, I'm aware that we are running out of time. A final question, these new batch of investors that have come, especially the later ones, and it's almost a flood now in the last 4-5 years. They are coming at a time when valuations don't seem to be working in their favor at all. Does it worry you? Do you want to warn investors about valuations and earnings growth? Does it make you cautious?
My views on valuations are well known because I've answered these questions at various forums. Valuation is in fact the most difficult question ever encountered by human beings, and they have never got the real story. How about it? Valuation can be quantitative. The methodology can be quantitative, but it is still subjective.
Yes.
Because if the valuations is based on the future, what you look at the future means there is no such theory to say this is the way it is going to be future. Future is about beliefs, and different people believe it differently. And that is why you have bulls and the bears, and they keep fighting in the stock markets in order to determine what's going on. And so therefore, how is it that, such a people with fantastic degrees, they take wrong decisions?
That's true. No, I agree with you.
I am reminded of the seminal work of Mr. Daniel Kahneman, and some young man was asking me this question. No, I think the lady, and she's teaching, and I told her that please teach your students what Daniel Kahneman told about the prospect theory, about the way people's minds work. People minds do not work in the way we thought that they will be most efficient, even if they are well educated.
Yes.
And so therefore panic selling takes place when they should be patient. And we are talking of patient capital. We should the power of compounding, in which the people should stay and not really try to do that. And many of the frequent day traders and others, they've realized to their horror that what they wanted that to make a big money, they haven't. But there are others who are advising, who have built up very big portfolios, how the proper investing and choosing the right investing and staying on has helped them. Nobody can advise. People are different advisors. People have to take their advice. Nobody can say, I am the advisor and my advice is the best one. And the least of all that of SEBI chairman, who is not allowed to invest anyway.
I think a SEBI chairman who is reading Daniel Kahneman's Thinking Fast and Slow and expounding on that gives me the assurance that we are in very safe hands. The capital markets are in very safe hands. Thank you very much, Mr. Pandey, for giving us so many headlines and for continuing to be a very able steward of the capital markets. Thanks a lot.
Thank you.
Thank you so much to our dignitaries for joining us. May we please request you to stay with us on stage. Allow us an opportunity to capture you in one frame, both our leaders, ladies and gentlemen. And also I'd like to call upon Shri Sunil Kadam, Executive Director of SEBI, to please join us on stage and help us in felicitating Ms. Lata in presence of our guest, Shri Tuhin Kanta Pandeji. We'd request Shri Sunil to please felicitate Ms. Lata. Let's give it a warm, warm round of applause, please. Such a thoughtful and engaging conversation this has been. And thank you once again to both our dignitaries. Ms. Lata, we also have a small token for a memory for you. Let that applause continue. Thank you so much to our guest, Shri Pandeji, for joining us. And thank you so much to Shri Sunil, and thank you so much, Lata. Ladies and gentlemen, it is now time for us to move ahead to our next conversation. And as we can see this room brimming with energy, I'd once like all of you to give this entire community, since you are going to be driving India's future in this space, can you give each other a big, big round of applause? Come on, ladies and gentlemen. The best of the minds in one place. And it's only and only courtesy each and every one present here. Ladies and gentlemen, with the inaugural session and the fireside chat having set a strong strategic context, we now move ahead to the first panel discussion of Samvad 2026. A session that looks squarely at the evolving role of capital markets in supporting the purpose-driven and sustainable growth. As India's economy expands and diversifies, securities markets are increasingly called upon not only to mobilize capital efficiently, but also to channel it towards outcomes that align with broader development priorities. You would all agree that instruments such as the social stock exchanges, ESG-aligned investments, and green bonds reflect this shift towards purpose-driven capital formation, where growth, responsibility, and resilience converge. This session will explore how India's market architecture can support such purpose-oriented capital formation, while ensuring stability, transparency, and investor confidence. Ladies and gentlemen, to steer this conversation, may I take the opportunity of inviting on stage the moderator of this session, whole-time member, SEBI. Let's give it up for Mr. Amarjeet Singh. May I also request our distinguished panelists to join him on stage. Amit Chandra, co-founder, ATE Chandra Foundation and chairperson, Bain Capital, India. Nilesh Shah, managing director, Kotak AMC. Amitabh Chaudhary, managing director and chief executive officer, Axis Bank. Andrew Sheng, distinguished fellow, Asia Global Institute, the University of Hong Kong, who has shared his recorded lecture with us as well. Maybe before we begin with this session, can I request our four dignitaries who are present here? We always like to capture a picture before our session. So can I please urge the four of them to join us in the center, allow us an opportunity to first capture this moment and then, of course, thereby begin with the discussion. Can we once again, ladies and gentlemen, collectively give them a big, big round of applause for all of them to take out their valuable time and be with us at Samvad 2026. With that, may we request you all to kindly be seated. But before we begin our panel discussion, just to our panelists present here on stage, we have a short interactive segment to engage with the audience. So just allow me 3 minutes for that. So ladies and gentlemen, for all of you, we have something interactive. There'll be a 5-question quiz which will appear now on the screen. Each question is going to be having 20 seconds for response, and as you can see on the screen, we have the QR code. Can I please urge all of you to take this opportunity to participate in the quiz, as we're going to be declaring 3 winners from here immediately after this session. May I request all of you, while registering for this quiz, to please enter your full name, your name and surname, so that once you win, you could be called upon with your full name. So may I urge, as I can see on the screen, so many of you are joining in. We'll give you just another 20 seconds, as I'm sure a lot of you want to be a part of this quiz. Remember, we're going to be selecting 3 winners from here. The top 3 participants are going to be based on accuracy and speed. They'll be recognized at the end of this particular session, wherein I'm going to be requesting our moderator to felicitate our winners at the end of this session. I can see a lot of you in the room. I would urge all of you to continue with that scan. We'll just give you 10 more seconds on this. And let's begin. So I hope everyone is ready to now enter the quiz. Remember, it's the fastest finger first in terms of answering the question right, and the fastest one. I hope everyone was able to scan the QR code. If not, you still have it on the left-hand side. Or you can just join slido.com. And with that, we can see 239 of them. Can we go ahead? Let's display the questions now. Ladies and gentlemen, the first question is already on the screen. You have the 4 options. Please select what you feel is the answer, and you just have 8 more seconds. And remember, we have 4 more questions after this. All right, so the first question is up, and we've had 67% of you answer the first one. All right, we're going to move ahead, and this is the right one. We're going to be moving ahead to the next question. Ladies and gentlemen, request your attention on the screen, as your timer has already begun. Continue answering. There are 346 of you who are logged in for this quiz. 168 have already put in that answer. And let's see who all have voted for which option the most. The second option gets 86%. Let's find it out. Yes, that's the right answer. Now we move ahead to the next one. Your 20 seconds have begun. Remember, it's all about the accurate answer as well as the fastest. 10 more seconds. 200 of you have already registered the answer. And let's see where your head was at. 64% voted for sovereign green bonds, and yes, that was the right answer. Now we move ahead to the next one. Your 20 seconds have begun. I can see a lot of you answer, and we have currently 430 people in this quiz. So it's going to be a tough competition. We'll see who the winners are shortly. It's going to display live on the screen. And let's see, majority answered between 37 and 34% to 0.6, 1.7. 34% of the audience got the answer right. And the final question now on the screen. Your 20 seconds have begun. This is the ultimate question. This is going to decide who's going to win. So answer it correctly, but also at the fastest pace. 450 have now joined the quiz. And let us see what's the final answer which is correct amongst the options. First, the audience sense is 53% of you have opted for option 3. And let's see if it's the right answer. Yes, it is. And now, ladies and gentlemen, let's find out the winners on the screen. Let's give it up for Rushikesh Ugle Aditya and Yogi Kedari. Congratulations to all three of you. Remember, post this session to be around so that we can felicitate the winners after this session. With that, over to our moderator to take it forward.
Yeah, that was very efficient, I must say. Very quick quiz. So good morning, everyone, and I welcome all of you to this annual Samvad. I have been witness to the evolution of Samvad over the last 6-7 years now, and it's very nice to see how the event has matured over the years. And one good thing which I personally like about this is every year, every member of SEBI is asked to moderate a session, and I quite welcome it because for a change, it turns the table, you know. I get to ask questions to the market participants. So it's been such a stimulating morning. We've had such fantastic round of discussions. I hope we can keep the momentum on in this session as well. Let me just turn to my kind of formal setting the context for this session. As we all know, India's capital markets have come a long way. We have expanded, we have deepened, the width has also increased. In every respect, we've witnessed a very good expansion. And at the same time, the expectations of stakeholders with this growth have also been rising, and rightly so. Markets, of course, are a place for wealth creation, and I believe that is what pulls a lot of investors to the market. And rightly so again. But today, what is becoming more relevant, markets are not only expected to allocate capital more efficiently, but also do it in a very mindful manner, if I can call it, in a way that contributes to the real economy, in a way it takes care of broader social and environmental outcomes that is so much required by our country. And that is what this conversation today will be about. We plan to unpack all of this in next 1 hour. We are in 2026, we've just entered, this is the middle of the decade. Some of the questions that confront us are, what should our market ecosystem optimize for as we build towards Viksit Bharat 2047? How can purpose be embedded into capital allocation decisions in a practical, credible way? And how can securities markets be leveraged to mobilize capital for development and innovation at scale? And we are very privileged to have, very fortunate to have a very distinguished panel with us. They don't need any introduction. They all are, to me, what excites me the most is they're all thought leaders, apart from being experts in their relevant sphere. Just a quick word, Dr. Andrew Shang, he brings the rare experience of having worked across both central banking and securities market regulation. And he also served on our international advisory board a few years back. Mr. Amit Chandra, again a very leading voice in private equity and deeply engaged in philanthropy. Mr. Nilesh Shah, one of India's most experienced leaders from the mutual fund industry, and of course Mr. Amitabh Chaudhary, CEO of one of our leading banks in India. Our discussion today will be in 3 broad parts: the role and purpose of exchanges today. I think there is a need to revisit that. The coexistence of profit with purpose, and third, capital mobilization for a future-ready India. But before we get to that, let us listen to some words of wisdom from Dr. Andrew Shang. He sent us this recording from Penang, Malaysia, where he currently resides. Can we have the video, please?
Distinguished guests, ladies and gentlemen, good morning I am very honored to be invited by my good friend, whole-time SEBI Commission member Amarjit Singh, to deliver a special address on reimagining the securities market, purpose-driven capital for future-ready India. We are living in unprecedented times. The world is in literal transition with massive geopolitical rivalry and transition, conflicts in almost every continent, hottest climate in recorded history, and yet stock markets are in levels unseen since the 1929 Great Crash, government deficits and debt that seem to grow and grow, with some in debt distress, and technology that is changing life by the day. Global capital markets are in new territory because technology has enabled business activities to expand at speed, scale, and scope that is dazzling and yet frightening. Generative AI, artificial intelligence, and robotics, genomics are already transforming every aspect of life. We are already using AI to help us invest better, and very soon we will be talking not to human securities analysts or advisors, but AI agents who can answer your questions specific to your needs. Remember, robot or not, it's still your money to win or lose. Buyer beware and self-awareness of your own weaknesses and blind spots are always necessary to invest in an uncertain world. Reimagining the future is both exhilarating and frightening at the same time. Studies of how people consider the arrival of AI show that half are optimistic about rebooting growth and productivity, but half are pessimistic as to job loss and robots taking over from humans. Companies that invest in AI find that they must completely train their existing staff and yet are not necessarily impressed by the improvement in productivity. At the same time, no company can afford not to be investing in AI, nor can any individual. The stock market seems to be rewarding those who innovate and punish those that do not. Not changing to avoid a risk is itself a major risk today. At the same time, there is no question that deep capital markets are critical to the funding of high-risk, high-return innovation that may change our economy and our livelihoods. I therefore want to make 4 or 5 fundamental points, some of which are obvious, but some needs a little bit more reflection. First, finance or money must serve the real economy. The whole purpose of capital markets is to create jobs, help you invest better, and get the economy going, investing in innovative industries and promoting inclusivity and also ecological sustainability. However, the concept of money has changed profoundly with the arrival of digital currency and the tokenization of everything, both assets and liabilities. We are in new territory. At the same time, we cannot allow the public to be deceived by technology to fall into scams or to foster speculation that may bring the whole system down. Secondly, this is a little bit more complicated. Money, energy, data, information are essentially the same thing. Think about money as representation of energy that charges a battery. The bank or the securities market is like a battery that receives energy or money to be charged into the system, and you can withdraw money or energy when you need it. The value of that money or energy depends on supply and demand. The more you need that energy and less supply, the higher the price. The more efficient the bank or the securities market, the more efficient the real economy. The anchor of the whole financial system and of value is trust. When trust breaks down, energy is lost, withheld, or dissipated. Financial crises are crises of trust. This is why the securities and capital markets is crucial to the well-functioning of the real economy and must therefore be regulated according to transparent rules and regulations. Third, technology has networked energy, data, information, and money from local markets to global markets, creating a value that is more than the sum of the parts. Networks create not just individual capital, but social capital. The more and diverse and wider the network, the more resilient to shocks and disruptions from virus attacks or threats. The Indian market is becoming global in scale, making it more resilient and therefore necessary to be more competitive and transparent relative to global markets. Fourth, all change needs energy, which can be accessed through money form. Thus, investing in new growth needs more money. The diversity of network means that through technology, securities markets can be made more inclusive or democratic rather than concentrated, and also help solve human or planetary injustices or imbalances, such as the need to fund forest restoration, better social infrastructure, or addressing net zero. Putting money in the small people makes them more inclusive, giving them more knowledge and funding, help them become entrepreneurs, and compete with the global economy and not just at the local one. So putting all these four basic points together suggests that we can imagine a future for the real economy, such as India with 1.47 billion people, or slightly 1/6 of mankind, to aspire to have the equivalent of 1/6 of world GDP and market capitalization, which would then be equivalent at the current global GDP level of 115 billion to nearly 20.3 trillion. Sorry, I beg your pardon, 115 trillion, compared with current levels of 4.15 trillion GDP and $5.3 trillion market cap. An acceleration of growth in both GDP, income, and the stock of wealth would require greater savings and investment in people and the real economy. Clearly, the capital market, which contains the savings of people in the enterprise or corporate sector, as well in government debt, can be a major engine to transform the economy to the forefront of growth, inclusivity, and sustainable development. In this regard, I commend SEBI for its foresightedness and vision in building investments even for the small investor. Technology has made all this possible. There is no reason through the arrival of Web3 mobile technology not to allow the street vendor to invest his small savings into a share in high growth stocks or mutual funds or even private equity funds. At the same time, the Social Stock Exchange is a pioneering effort to enable non-governmental organizations and NGOs and communities to access equity or funding from charitable foundations or those with surplus funds, so that projects with social impact can be properly funded and yet subject to public scrutiny in a transparent manner. India has been able to advance its public infrastructure through the digital channel, networking communities and markets far faster with the Aadhaar digital identities, e-wallets, and micro markets that serve communities better with lower transaction costs. Having a secure, trustworthy digital public infrastructure has enabled digital stock and securities markets to be created to serve diverse community needs. The future cannot be imagined by one person. It is the collective imagination and the collective execution that is now possible to be built and co-created by everyone. So are there risks and pitfalls in the transition to the new imagined securities market or the real economy? Of course there is. The lessons of Silicon Valley are that there is no success without failure, no gains without pain or risks. The future is not created through simple imagination. It is created through experimentation and actual building of diverse projects and initiatives, piece by piece, module by module, program by program, failure and success, aspirations and implementation, all intertwined in a continuous process of trial and error, competition and cooperation. So in this regard, the SEBI mission to protect the interests of investors and to promote the development of and regulate the securities market remains perennial. Laws and rules of markets must be enforced transparently and fairly to ensure the integrity and the vitality of securities markets. As a former member of the International Advisory Council of SEBI, I remain confident that India's future in the real economy as well as the securities markets will be bright because the country has many talented innovators and entrepreneurs and officials whose time has come. We should never, therefore, be afraid of the future because very soon it will arrive and be the present and then the past. I wish this Samvad Symposium all the best for the very fruitful and constructive discussions. Happy New Year, and thank you very much indeed.
So that was, I believe he's quite a visionary, so he very nicely brings perspectives from economics, central banking, securities market, technology, all into one. So turning to all of you now, and we have 3 rounds of questions, followed by, time permitting, followed by some quick rapid fire, which I enjoy the most in these sessions. I would request the audience to be more attentive. We will have a good pace because I want to cover a lot of ground with our esteemed panelists. So the first question in the first round, this is on the role and purpose of stock exchanges today. And this is a common question to you, Amitji, and Mr. Chaudhary. Stock exchanges have, just to give you a little of background before I ask the question, stock exchanges have a history that goes back over 4 centuries. We've come a long way since the Dutch East India Company's public share issuance in 1602, which helped shape, presumably, the first Amsterdam Stock Exchange. If you fast forward 400 years, with growth capital coming from private markets have really grown very well in the recent years. In several markets, we are seeing that the number of listed companies has actually declined, and public markets are seen more as a venue for liquidity and exits. India, of course, has been very lucky. We have a very bright spot in terms of IPO activity and new listings, mostly via OFS. So this is one important trend. Second is private markets. Interestingly, they are trying to democratize their industry, quoting individual investors alongside their traditional institutional clients. And in fact, some people tell me that they're also trying to create more liquidity in the private market sphere so that they can compete with public markets. In India, our attempt has been, at SEBI at least, our attempt has been that market infrastructure that we've developed over the years should be put to use by various stakeholders. So to that end, we've come out with the instruments like ZC, ZP, zero coupon, zero principal instruments, municipal bond, REITs, InvITs, SM REITs, and also Choti SIP, as Dr. Andrew Shang also mentioned. Why not a street vendor should be able to invest in the markets to serve a larger set of stakeholders? But these instruments have had uneven traction, as we've seen. Now I'm coming to the question. In this context, as both of you have been witness to the evolution of both private and public markets, what do you see the larger role of stock exchanges evolving into? What changes or innovation could help better serve the needs of our economy and society? Over to you, Amitji, first.
Thank you, first of all, for inviting me here today and being amongst friends for this panel discussion. Look, I think, first of all, the transformation has been truly remarkable. I came back to India 32 years ago, and my first visit was actually to the pit And Nilesh would remember the times when one had to go into the trading pit. And from there to what's probably the most efficient trading infrastructure in the world is quite a remarkable journey, both in terms of speed, in terms of cost, in terms of the way we process things. I mean, you would do trades and then you'd have to wait for 15 days to figure out whether you're going to get delivery. You know, the way the thinking was largely tip-based. Now it's research-based. The widening of the markets. We are no longer dependent on foreigners or a few individuals. Today, if you're a good company, mid-size or large, or you're a small investor or large investor, this is probably the most efficient market in the world. So I think, first of all, when we step back, we should really give a lot of credit to policymakers, regulators, market participants who have all come together to make this remarkable transition happen. So question really is, what's the challenge and what will it take to keep this engine going so that in 30 years, we again have another remarkable story to talk about from this launching pad. I'm actually going to step back and think about something which I think needs to happen slightly outside the gamut of the exchanges itself, but I think the exchanges need to play a critical role working with policymakers and industry participants. Look, if you step back and look at what has been happening in the US in the same 32 years, today in these 32 years, about 40% of the US capital market is absolutely new companies. These companies didn't exist. In India, that number is low single digit, right? So R&D, innovation, funded by private equity and venture capital, has had an extraordinary role to play in what we call the US success story. China, they've got to it in a different way by basically unleashing huge amount of state spending and creating an R&D and innovation ecosystem. So question is, if we really want to, again, have a remarkable 30 years, we will have to address that issue. What is it that we're going to do today to build an Atmanirbhar private equity and venture capital ecosystem so that we are in a very different position? Because the fact is today, and I'll end with this point, if you look at our net FDI, it is close to zero. And the reason it's close to zero is that because we are such a successful market that anyone who puts in $1 for 5 or 6 years ago takes out $3 after a certain point of time. So we simply cannot be exporting our success overseas. We have to be capturing our success in the local markets, pretty much the way we've been able to do in the capital markets. The same story needs to be replicated in the private markets. And the future will get created by new companies getting funded in important national priority areas. And so the biggest role any ecosystem player, be it the regulator, be it a private participant, be it the stock exchange, is to think about resolving that one issue. That was Arvindji's last 2 points on his slide as well. I think we have to be very focused on it.
So thanks a lot for inviting me to this panel, as Amit said. Happy to be amongst friends. I'll just build on what Amit said, because I think he made some very relevant points. The Indian stock exchange market, the stock exchanges, the whole infrastructure ecosystem has come a long way. And obviously, as SEBI chairman was also saying, we'll keep working at the edges, we'll keep looking at incremental things to keep, keep pushing in the right direction. But if there's some large-scale changes that will be brought about in the stock exchanges itself, or how the markets are governed, I don't think that is the issue. Is, in my mind, we are caught in this vicious cycle. Is there enough right supply? Is there enough, and where is the demand coming from? So kind of both are low, depending on which markets you look at. And then you have to step back further and ask the question, what will India, take India to the next level? Everyone talks about, Atmanirbhar Bharat or the, the 30 trillion economy and so on and so forth. I think Mr. Cheng talked about 1/6 of the population. Do we account for 1/6 of GDP? Far away from there. And while we have made rapid progress over the last 2 decades on capital formation, to sustain this capital formation, India does need to look at what will it take for the country to have, the investment. There was a question on R&D. Our investments in R&D are 1/4, 1/5 of what other nations, the developed nations are doing. How do we increase R&D? How do we create global brands? How do we ensure that this market is not just about small, generally small Indian companies, or it is about market of companies which are playing at a global scale? There are very, very few companies. So firstly, the policymakers, the regulators have to all think about what will it take for India to produce these, let's say, global brands of the future. What will it take for India to actually be seen seriously on the R&D side? I recently read a report done by an Australian entity which looks at 72 areas of research, fundamental research. And the US used to be number one and ahead of it, ahead of every other country in the world in about 50, 55 of them. Last research report they have done, China is ahead in 65 out of those 72 fundamental research areas, and the US is ahead only in 7. Obviously, the rest of the countries don't figure. We are not there anywhere. Now, if you want to create an economy which is developed and not be just a mid-sized economy and caught in this mid-income trap, we have to think very, very differently. My worry is that we have thought incrementally, or we have thought big but acted incrementally, and so we get only incremental output. So that's one thing I want to leave. Second thing is that from this ecosystem perspective, while we end up doing a great job individually, everyone will do their bit. A regulator will do their bit, a stock exchange will do their bit, the market partners will do their bit. What can be done collectively if all of us was to trust each other, I think can be much more. Now that takes too much time in India because everyone is suspecting everyone else or thinking that, if I allow them or if they give me the ideas, I have to think and put some controls in place because that's not necessarily going to work. And because we keep doing that, I think we're just caught in this, this bhavar, and where we're just, running around with very little output. So while you ask the question on stock exchange, I think there's some fundamental issues to be asked, questions to be raised and answered. And I think Amit was also kind of just hinting to precisely the same thing. If we don't solve for some of those big things, let me take corporate bond example, market as an example. Everyone has been working at it for a long period of time. And it has improved. And we can point to the history and say, oh, by the way, the corporate bond market has grown in size. And it's an important market for risk capital formation. But is it where it should be? No. And frankly, if you look at all the activity and all the effort which is going on, everyone individually has done it, but still the market is just not there where it should be. And that's the basic problem. Let me just leave it there. Thank you.
Yeah, so I take your point. I think you very rightly point out there's no room for complacency and we still have a long way to go. Nilesh, if I may turn to you, this is a related question actually. So stock exchanges were built to support capital formation, yet today we often judge success by secondary market metrics like liquidity and turnover. And as we all know, much of it is driven by derivatives. Have we begun to mistake activity for value? How should we define success for a stock exchange? And what would be the right approach and the right matrix? And just one related question on the F&O segments. At times, especially in the recent past, F&O segment has been criticized as turning markets into a casino, and I hate to say that as a regulator. Where should regulators draw the line between healthy risk management and excessive speculation?
So thank you, Amarjit Bhai and Sebi, for inviting me over here. Good to be among friends. But many a times, we don't end up giving credit to stock exchanges for what they have done. For example, how many of us are aware that Mumbai's favorite dish, Pav Bhaji, is actually creation of Native Share and Stockbrokers Association. In those days, they used to trade at Horniman Circle below a tree of banyan. And रात को trade करते थे because American cotton, American timing पे trade होता था. They were a small group, कोई restaurant खुला नहीं रहता था. घर पे रात को पहुँचे तो कोई खाना नहीं देता था. So दिन भर में जो सब्जी बचती थी उसको जमा करके भाजी बनाते थे. ठंडी रोटी खाई नहीं जाती थी तो पाव आ गया. So Pav Bhaji is thanks to Native Share and Stockbrokers Association. How many of us know about the history and how many of us give credit? Number two, अमरजीत भाई, आपने speculation के बारे में कहा. So there is a perfect example in our history when the Parsis fled Persia and reached Sanjan in 8th century. They went to J.D. Rana and said, we want refugee over here. And he gave them a bowl of milk. And they added sugar into it, saying that we'll mix in your country like sugar mixes into the milk. The same thing is relationship between speculation and market. अब sugar बहुत ज़्यादा हो जाए तो diabetes हो जाता है. तो as a regulator, please ensure that we are healthy and we don't have diabetes. There are many people who don't even know that they have diabetes, so please ensure that you do that test before they enter speculative market. And after the test, they should come. अब खाली आप शुगर वाला मिल्क पीते रहेंगे तब भी तकलीफ है, और भी खाना खाना चाहिए. To ensure that people trade according to their net worth. We can't wish away speculation because they provide liquidity that creates the capital formation. So ensure that there is good entry test. Ensure that people trade responsibly.
Sorry, I'm interrupting you. Problem is, whatever we do, we are damned. You know, we are criticized either way. तो आप कभी इधर आके बैठे तब आपको मालूम पड़ेगा.
So again, it's not criticism. I think, as Amit bhai mentioned, there was a time in stock market when Vandho, Patawat, Garo, payment crisis were part of lexicon. Thanks to you, we have forgotten all those words. So that's a fantastic achievement. But at the end of the day, the success of stock market is if every Indian entrepreneur who has a dream and a vision to do something is funded by Indian capital, as Amit bhai mentioned. We should not be depending upon foreigners to fund our entrepreneurs' dream and vision to make a Viksit Bharat.
Yeah, thank you. So I'll not do a follow-up, otherwise, you know, we'll have problem in terms of time. So thanks for your interesting, as usual, you know, very interesting and apt stories. Let me move to round 2 now. So we will move from questions on market structure to market outcomes. And the theme is, can markets pursue purpose and profits at the same time? And we've seen there is a tension between the two. So Amitji, question for you. Purpose-driven capital is now expected to generate social and human value alongside financial returns. As an impact investor, I mean, you have an illustrious track record there. When you look at what is happening on the ground, what does purpose-driven capital actually mean in practice beyond labels and beyond good intentions? We all know market is still return-oriented, financial return-oriented. What distinguishes genuine purpose-led leadership from mere signaling, you know, just the talk, but not the walk? And as this space scales, do you see purpose washing risks? That is from the regulatory perspective, and how can those risks be addressed? Over to you.
Yeah, Amitji ji, I'm too small a person to comment on this, but I personally feel that there is no tension really between purpose and profit. If there is a tension, it's basically in its horizon. Ultimately, there is great alignment from a longer term, and rather than espouse my own views on it, I always, you know, go back and look at history. And India is a country where there's great history of when purpose and profit have aligned, remarkable things have happened. I used to be a trustee of the Tata Trust. I sat on board of Tata Sons. If you read Jamshedji Tata's history, Tata Steel got created out of purpose. And it, you know, it's a remarkable company which got created just because he wanted India to be Atmanirbhar in steel, much against British wishes, and he did everything possible in his lifetime to lay the foundations of that. Similarly, he was very clear that textile workers had absolutely appalling work conditions, and so he created a differentiated textile enterprise foundations with Empress Mills and Swadeshi Mills, and again built a very vibrant textile industry. And so we've got great example, and then much later, if you look at what Hamid Saab did with Cipla to break the colonial stranglehold on pharmaceuticals. It all shows you can build enduring, long-term, value-creating companies with aligning purpose and profit. I think the problem often is that in the market, in the quest for all of us to get so focused on short-term objectives, we really lose this long-term orientation. I'll give you one example from just the recent term. Look, the entire healthcare industry globally has moved towards value lying with innovators as opposed to with, generic companies. This shift has happened in the last couple of decades. Now, in India, we have got two great examples of companies who have actually put their head down quietly and tried to do innovative work, who are listed companies and consistently been penalized by the stock market because of that, Wockhardt and Glenmark, right? And if you see the stock chart of both these companies, it took them a long term, really a really long term to show that they were, that they had a breakthrough before the market has recognized it. And even now, the market doesn't necessarily recognize them for having done something exceptional out of India. We instead have rewarded our entire generic industry for being a great profit optimized engine. So to Amitabh's point when he talked about it, we've actually in India greatly rewarded this huge disservice that we have done to the country by underinvesting in corporate R&D. We buy all our IP from the West and China effectively, and on the market side, all these companies are basically providing non-IP services and products, at high multiples. This is simply not sustainable. And ultimately, unless we change our way of thinking and say that it's okay if companies make 5% less profit because they're investing in something which will show up 5 years later, 10 years later, and even if it doesn't, that's okay as long as they're doing the right thing, I think we will not actually build a great country.
Right, as a regulator, we're not supposed to talk about specific companies, but you talked about Tata Steel, and I'm tempted to add to that. I still remember their tagline, "We also make steel." And this is like 2 decades ago, I think they had this. And that was there was such a foresight in that statement. All the sustainability debate which we picked up in the recent years, I think it really precedes that.
Yes.
So amazing vision there.
Yeah. No, absolutely. I think that's, I mean, if you see what they created in terms of, they created cities, right?
Yeah.
And that's a great example of that.
Yeah. So Nilesh bhai, if I can turn to you and just extend this question a little further. Globally, the investors led the early push on sustainability. To my mind, there are two main driving forces, investors and regulators. But investors were probably ahead of regulators, with regulators following. Though in India, we started way back in 2012 with BRR. As an investor, how much influence do you realistically have on the sustainability choices of the companies you are investing in, of the investee companies, through engagement and stewardship activities? Are corporate sustainability targets realistically compatible with quarterly performance pressures? Lastly, on sustainability disclosures, what information is truly decision useful for investors versus the box ticking language that merely adds the noise in the system?
So undoubtedly, sustainability is an important part of investment research thesis. We essentially evaluate share price as a net present value of future cash flow. If you are not going to sustain cash flow, net present value cannot be high. Now, obviously, there are challenges. We are not the expert on sustainability management. When we go and meet companies, they put PhD in various fields in front of us, and it's very difficult to argue with them. So one of my suggestions will be to replicate what is known as Climate Action 100, where top 100 investors or the large investors of the world come together to engage with top 100 polluting companies. Unfortunately, a couple of them are in India. These large fund houses have the financial muscle to attract talent which can teach sustainability to their investee company. And we get an audience on the ring side. When we hear how this large investors are pushing sustainability agenda to their investee companies, we also learn a lot, and then we can replicate with other investors. So in India, I think we should have climate action 100 kind of workforce, where large investors carry the lead on sustainability management, but share the knowledge with other investors so that we can make this a campaign. The second thing on the sustainability side, from a disclosure point of view, earlier there was a challenge in terms of understanding data, but thanks to AI, we are able to put the data back into the model and raise appropriate question. So to that extent, data crunching has become much easier, and leveraging AI, we are able to put right question in front of the management, including some of the inconsistencies. In one company, we had pointed out some of the disclosure as scientifically impossible. And then they came back saying that, yes, this was a printing error, and it was indeed a printing error.
Oh, okay. So let's get the banker's perspective on this issue that we are discussing. So banks, as we all know, they sit at the heart of capital allocation. So the question is, how can India's long-standing multi-stakeholder approach that can be weaved into lending decisions when multiple stakeholders' interests are at conflict with each other? How do banks structure and manage those trade-offs?
So very quickly, let me just respond to the question you asked before, because I'm sitting on the other side of the table when some of these things are being asked. So a couple of years back, obviously, there was a lot of interest in ESG goals and how everyone is looking at it. By the way, we were still the only bank, I think, who has a ESG committee of the board, and we have sustained and continued that. That interest has gone down dramatically. I mean, I'll be very honest. The questions have all gone away. A lot of the fund managers used to have someone who would come in and ask specific questions around ESG and sustainability. That has all stopped in the last 2 years, very clearly. And when the most powerful country in the world is headed in a direction saying this is all bullshit, then obviously the interest also, I mean, let's be very honest, the interest has gone away. So the level of questioning, the level of interest, the value they might see in something of this nature, at least I'm not seeing it now. Maybe it will come back when some of the regimes change around the world, or when the impact is visible, when the impact becomes even more visible. Because of what we are doing to the climate, we are suffering. I think when in India, we do it very well. Only when we suffer to a point where there is no other choice, then we act. Hopefully, world will start acting when, I guess, the world will suffer more because you're not doing enough. So I would say, yes, a lot of good work has happened, a lot of disclosures have happened, a lot of people are realizing it, but still some work to be done. So let me now come back to the question you asked me. Well, as any institution, as any industry, we have certain choices to make. We can push ourselves too much, we can grow too fast, but then it comes with its own cost. We can take too many risks, it comes with its own cost. We can go and fund all kinds of stuff for the long term and take additional risks. End of the day, all of us have pretty well-defined risk guardrails and risk management structure where, depending on our context, our size, what we believe in, we decide what kind of risk we'll take, what we'll fund, what will not fund, what is okay, what is not okay. I think one of the important things which some of the large institutions do is what they will not do rather than what they will do. I think once those things are defined, managing the short versus long, the pushes and pressures from various stakeholders becomes that much easier. Because you can always refer back to your risk guidelines and say, this is what I'll do, this is what I'll not do. And I think that is helpful. It's not that once defined, they never change, they do change, and they have to change in line with regulatory changes in context, global, what might be happening on a global political scenario, economic scenario, or local. But I think broadly, the large institutions, large companies do have a framework which has developed over a period of time which they're operating in. And so it becomes much easier on a day-to-day basis to manage some of these conflicts, as you would call it. It's also because I think there is a constant dialogue between the government, the regulators, the companies involved, that when you are stuck in some complex choices, those discussions also help, because it's not that the government is completely shut on you or the regulators are not listening. So I think everyone understands the other side of the market. The fact that we can sit here and have this discussion itself is an indication that, there is a dialogue. And in that sense, I think sometimes the complex situations, the government and the regulators are willing to act and willing to react to some of the circumstances might be caught in and give us some leeway, give us some time. All of us have an idea what is coming down the roadmap. And so we can also, plan for it much more in advance. So I would say it is not easy, but it is manageable.
One quick follow-up. I'm tempted to ask you this. I agree with you. The boardroom discussions, probably there's less of emphasis on ESG issues. ESG has become a bad word in many jurisdictions, certainly. Point taken. But the issue is, if you look at the long-term movement, and also if you look at the real climate risk, more in terms of physical risk, so many assets around the world are becoming uninsurable. If they are uninsurable, they are unbankable. So probably bank boards will have to be.
So as I said, we have a ESG committee report. So we have actually done a lot of work. We don't get any value for it, but we do believe that in the long run, that's the right thing to do. So we are doing it.
Right.
So we have very clearly defined policies on what funding will do, what kind of funding will not do, what will sustain, what kind of reports we want. I mean, today, every credit memorandum of ours, for example, has a section on ESG, and we discuss those risks there. We have actually been working very actively with IFC Washington to come up with risk assessment models internally or the companies we lend to and look at the bank itself. By the way, we are working extensively with RBI on the same. So we believe it's the right thing to do, so we are doing it. We did not do it to get some extra value. And we believe if we keep doing it, at some stage in the future.
So in some sense, it is becoming mainstream without calling it ESG. The label is changing, right? Okay. So I'm mindful of time, and we still have a lot of ground to cover. So I'll request for short answers, and I'll keep my questions also short. So the third round is on the capital mobilization for future-ready India. So Nilesh bhai, it's for you. So what is your view on instruments like green bonds, sustainability-linked bonds? We've issued a number of such instruments on the climate finance side, but we are not really seeing much traction there. Is it a lack of demand, or is it a supply-side issue? Your quick thoughts on this.
The issue is investors' mindset. Heads I win, tail I lose. And since we talked about Tata Steel, I still remember an interview of Rusi Modi, where they were encouraging football players, and there was no tax incentive for it. So the anchor asked Rusi Modi, then managing director of Tata Steel, that आप खर्चा कर रहे हैं, but आपको कोई tax rebate नहीं मिल रही है. And he replied, I am doing this for the football, not for tax rebate. The day Indians will have mindset of Rusi Modi and Tata Steel, I think green bonds भी take off कर लेंगे.
Right. So another question.
I also saw some data which said that 65% of the investors today, the retail investors, are investing on the basis of what returns they're seeing of last year, right? So, that mindset is very, very visible.
Right. So we'll all agree that both bank finance and capital markets are important for India's growth.
So the issuers are not using some of these bonds and instruments because their mindset is also the same. What is the benefit I get by doing all this work? And because the benefit is not...
the compliance issues, or?
No. A typical investor or the issuer is saying, because I don't get a interest subsidy, the rates are not lower, some investors are not coming in because they want to invest in climate and green bonds. Why should I go through this whole exercise of doing this? Because I'm getting nothing for it. And that's precisely Nilesh's point, that they should do it for the right reason, not for that interest subsidy.
Essentially the incentives point.
Absolutely.
So, okay. So another question, related question for you on how do you see the complementarity between the bank finance and capital markets when it comes to infrastructure financing?
Well, banks, because we are in a way seen as trustees of the population of India at large, we can take only that much of risk. End of the day, for long-term capital formation, it is important that we find instruments and means to fund this. You have insurance companies, pension funds, government bonds. Government needs to support it directly. We can fund for small periods of time, some very specific projects when they've gained some maturity. But if you want to put large infrastructure in place, people talk about $4.5 trillion has to be put in by 2047. Banks don't have the money or the wherewithal or the risk-taking appetite. Or neither the regulators will allow it. That, okay, our average tenor of our deposits in the banks today is 1.3 years. Now, if we expect the banks to fund a 15 to 20-year project and do a lot of it, it's just not possible. So we do need to find ways and means of other avenues of capital, in which obviously the capital markets play a very, very important role. We talk about bonds of various kinds, corporate bond market, whatever it might be, specific institutions which can back this up. And I think government is doing it, but the amount of money which is needed and where we are, there is a huge gap.
Is there any ask from SEBI on this? Is there anything we should be doing to help you?
I don't think SEBI can do this. I think the markets have to develop. So whatever role SEBI can play in developing some of these markets, I think you have done everything possible. And that's what I said. The problem today is not a SEBI or the market itself. The problem is there's this vicious cycle of not enough supply and not enough demand. That's where we are caught. So it's the suppliers and the people who are willing to invest. SEBI cannot bring investors out of nowhere. It can create means whereby the suppliers and the people who want to demand it can come together and price that. But right now we don't have enough suppliers and people are willing to buy.
Amarjit bhai, I have a suggestion and a request. India is the only country in the world where 125% of GDP is locked in Tijori. And this is a very, very conservative estimate of gold lying with Indians. That saving is frozen. It doesn't add any value to Indian economy other than the wealth effect it may cause. I think as a regulator and market participants, we have to put our brains together in terms of how do we create a structure whereby this frozen savings can come out of Tijori into Bazaar. Many years ago, there was an instrument given through use of derivatives where because of options buying, you would have got 100% participation in the upside of gold. And because a part of money was invested into fixed income, and in those days 14% was the 10-year yield, the downside was protected. So essentially, I could have gone to investors saying that if gold prices go down, you get your capital back. If gold prices go up, you will be able to get the return. Unfortunately, that product could never see the light of the day because it was commodity linked. The same thing happened with benchmark ETF. They had come with the world's first gold ETF. By the time we could take approval to launch, there were others who had copied that idea. So the world's first gold ETF was created in India, but launched outside by someone copying idea. I think time has come for us to come together and see how this 125% of GDP lying in the Tijori can be brought into the bazaar.
Interesting, yeah, thank you. Thanks for the applaud. You know, it shows that you guys are hooked on, engaged, and not sleeping. Thank you for that.
Also, they have a lot of gold.
Correct. So, obviously, I can't help but ask you this question, and probably you are one of the best persons to answer. As somebody who's been very closely associated with the evolution of social stock exchange, so why are we not seeing the scaling up? You wanted to say something? Oh, please. Nilesh has a flight, so we'll let him go, please. Thank you so much.
Look, I think the social stock exchange, first of all, is a remarkable initiative. Kudos to the government and SEBI for basically laying the framework for it. And I truly think its time will come. It's just that it will take time to get popularized. And just for the sake, for the benefit of the audience, I think the reason why it's so important is basically because what we haven't done yet is democratized the giving movement in a transparent way, in a way in which people can give money very easily, the way we managed to do it in the equity markets. And by having this entire giving infrastructure ride on the stock exchanges infrastructure is actually brilliant. Because today, you can be on Axis Bank's app, or you can be a Kotak's app, and you can reach all their accounts and be able to basically give money. And it's not just about giving money, it's about bringing hundreds and crores of Indians into the development dialogue. and being partners of change and how India evolves. And I think that's what's really, really important. What will it take for this to happen? I think it's a matter of time. But, you know, if you go back to the step functions in the development of the stock market as well in India, sometimes it takes that one big issue, the Reliance type issue, which captures people's imagination. I think maybe there'll be one or two really, you know, high imagination issues which will come to the market in the next year, which will capture people's imagination.
We'll really wait for that moment. Thank you. And now let me move to my last round of short closing questions and very brief answers in the interest of time. So, Mr. Chaudhary, to you, first question, rise of private credit, is it a regulatory blind spot?
No, I don't think so. I think it is coming up because there is a need for it and there is demand for it. Obviously, one has to be watchful, but ultimately it is private credit. I mean, people who are getting into it are knowledgeable. If they lose some, let them lose some. I mean, the market will evolve over a period of time. I don't think, obviously regulators have to watch it, but it's not something we should worry about too much at this stage.
Okay, so let me ask you another question. Your sense of how acceleration of AI, which we are witnessing, it would change the financial sector landscape?
Oh, it will change dramatically because, you know, AI can do on both the sides. On one side, can allow you to automate processes, can go and attack certain set of customers you could never think of. It can do things which human beings are doing and you employ armies of people doing it. It will upgrade the skill sets which, you know, people are right now using or deploying. So there are huge benefits potentially to come from AI. Earlier there was a lot of talk, but now we are seeing some real benefit. On the flip side, AI can lead to, you know, people can misuse it also to do all kinds of wrong things, which is also happening. So on one side, we have to take full advantage of it, and there'll be significant changes across all the industries. On the flip side, we have to be prepared for a world where AI will be misused, and people will come across new scams, new ways of how they will be taken for a ride, wrong information, misinformation, and all of that will also happen. So I think we have to just be watchful on both sides.
Can I just make one point? There's a very interesting factoid. A few months ago, incremental private credit in the US overtook bank credit. I think this is a tsunami that's going to happen globally. And in India, you're going to have two credit regulators, RBI for banks and SEBI for private credit. This is something we should get prepared for because that's the future. And I think we should be really thinking about how we make sure that we enable the domestic industry to benefit from that, because it will mean credit will be very innovative when it gets into private hands.
Okay, so another question. Now these are random questions, not on a particular theme as such. Where do you see the biggest gap in the innovation financing ecosystem today?
You know, I'm sorry, I'm going to give a Ghisapeta answer. The biggest gap is that between regulators, policymakers, and domestic players, we are not imagining Atmanirbhar private equity and venture capital industry. It's an opportunity waiting for us to happen. I've seen it happen in China. The reason why a lot of the US success story is what it is because of that. We need everybody to come together and we need to create this, because if we get that one fundamental right, then a lot of the things we talked about will happen. We have 100+ unicorns. There's no reason why we should not have thousands. I travel a lot to tier 2, tier 3, tier 4 India. There's aspiration amongst youngsters to be entrepreneurs and not become professionals. We need flow to basically enable that to happen. That's the future. And I think we need to be reimagining our entire supply of capital infrastructure to enable the demand for it.
Okay, so last round, definitely the last round. 3 questions to both of you, common questions. Road to being a developed nation by 2047. One change that we must make now to finance growth.
Well, we have to, you know, fundamentally think of transforming how we look at creating pools of capital. I think we're still being too incremental.
Create domestic champions.
Can you elaborate?
What I talked about.
Whether
it's
okay.
Even in banks, I think we need to figure out how we have 10 big Indian banks who are on the top 100 banks of the world.
Okay. Okay. So next 2 questions are a bit tricky. First one is, where do you see the next financial crisis coming from?
history repeats itself. We believe that we have cleaned everything up, so everything is okay. I think we should look back at history and keep asking ourselves this question: has anything really changed? We convince ourselves things have changed. In my mind, many things don't change. I think that's where, rather than saying it too bluntly, I think that's where the next financial crisis will come from.
It'll be a geopolitical event.
Oh, any sense of what?
And it's always, today, we have leaders who do things which every morning seem like, oh my God, aisa bhi ho sakta tha.
Every hour, actually, we don't
So, so I think we could, and the problem is, it could not just be trade policy, it could be, a defense event, etc. So, again, that's why you need to really have very strong local fundamentals.
Yeah, I've started checking geopolitical news more closely now because anything can happen.
By the way, there's a tracker where you can look at and you figure out this is happening a lot for all of us.
Right. So the final, yeah, please.
So I think Amit is referring to more of like a black swan event, one big defense event, for example, which could impact India significantly.
So the last final question, I'll give you 3 multiple choices. You have to pick one. And I'm going to miss Nilesh for that. But so the question is, you have to pick one of the following. A, I love regulations because it's not regulator, so you don't have to worry, right? I love regulations because, you have to complete the sentence. I hate regulations because, complete the sentence. I love and hate regulations because.
Oh, this is being telecast?
Definitely being recorded, yeah.
You want to go first?
I'm sitting in a chair where I have to be very careful, but no, I think all cribbing we can do. I do love regulations because they do ensure that this country progresses in a certain way within some framework. Cribbing aside, we love to crib. So it's okay. It's fine.
I agree. You cannot have a fast car without an accelerator and a brake. And that's why regulations are important.
I wish one of you had said you love and hate both. So, but anyways.
Well, I'll tell you when I hate regulations. I think because when we throw the baby out with the bathwater, that's when I hate regulations. We tend to paint, we choose the worst character and then we say, yes, sab aise hi hai.
But that is the Indian way. Secondly, I think the devil is not in the regulations. Devil is in the way, in the details and how we try to think of every door which needs to be shut and shut the entire industry. We see, the biggest problem we have is we don't go after the people who misuse it. We go after the entire industry. We just
exactly
slap everyone together. That's where the problem is.
That's exactly what I mean.
If we had mechanisms where the people who are misusing them are the ones who are, penalized heavily, I think the impact will be that much more.
Thank you, both of you. Let's
thank you so much.
You wanted to say something?
No, I said thank you so much.
No, thank you so much. It's been such a fantastic, very engaging conversation. Just give them a big round of applause.
Thank you so much to our panelists. I believe Nilesh had to leave in the middle, but we're going to have this opportunity of felicitating all of you on stage. But before that, Amarjeet, we did this quiz, and we also would want you to felicitate the winners, if that's okay. So can we request our quiz winners, Rushikesh Ugle, Aditya, and Yogi Kedari, to please now join us on stage. Come on, ladies and gentlemen, a big, big round of applause as we welcome all the winners of the quiz. Rushikesh Ugale, Aditya, and Yogi Kedari, please to join us together on stage. And remember, we're going to continue to have a lot more quiz for all of you so that many get this opportunity of being with us and getting the gift. A small token of appreciation. Can we request our moderator to please can we request all the winners to please join us on stage? I would say a gift of applause is always appreciated. Let that continue as we appreciate all the winners. And may I now request Sri Sundara Raman sir to please join us and help us in felicitating our key panelists on stage, but first off, and it's such an honor always requesting him to be with us. May I urge now the token of appreciation to be brought on the stage. We'd of course like to felicitate our moderator and our panelists. First, we're going to be felicitating our moderator, Shri Amarjeet. Thank you so much for joining in. And whilst as our leader is here with us on stage, Amarjeet, if we can request you to further felicitate our panelists as well. We just request our leader to please stay with us so that we can capture all of you in that moment. We're now requesting our moderator to felicitate our panelists on stage. Let that applause continue. We've learned so much from this session. We'd once again like to thank Amit Chandra, Amitabh Chaudhary, Andrew, who joined us virtually, Nilesh, who had to leave in the middle. But thank you so much to each and every one of them for joining in. We have with us on stage Amit Chandra and Amitabh Chaudhary, along with the moderator and, of course, our key presenter who's joined us, our key speaker, Shri Sundararaman Sir. Currently, we're felicitating our panelists, courtesy our moderator, Shri Amarjeet. And we'd now like to capture one final picture of four of you just a little ahead. And when we have such great leaders, ladies and gentlemen, what do we need to do? Give that big, mighty round of applause. Come on. Thank you so much to all our leaders for joining in. And it's now time for us to move ahead to our next discussion. Well, a lot is happening at Samvad 2026. We now move ahead to the next session, which builds on the theme of the capital formation strategies, shifting the focus from concept to execution. Startups and micro, small and medium enterprises are central to India's growth story. Those driving innovation, entrepreneurship, employment generation, and regional development. As these enterprises scale, access to public markets becomes an important milestone, offering not just capital, but also visibility, governance discipline, and long-term sustainability. With so many IPOs coming in the market, I'm sure this session's going to be a very relevant one. In this context, the SME platforms and dedicated listing frameworks play a crucial role in creating those structured pathways for startups as well as SMEs to access capital markets while addressing their unique challenges related to compliance, disclosure, and market readiness. I personally feel this is a very important and an integral session. This session will bring together diverse perspectives to discuss how an enterprise navigates this journey and how markets can better support them at every stage. So now let's talk about the execution. To moderate this session, ladies and gentlemen, we have with us the whole-time member, SEBI. Let's call upon stage Kamlesh Chandra Varshney. And joining him are our panelists, Sundararaman Ramamurthy, MD and CEO, BSC, along with Adit Palicha, CEO, Zepto, Kunal Shroff, Managing Partner, Chris Capital, and Sandeep Bhagat, partner, SNR Associates. Ladies and gentlemen, we have Adit Palicha, Kunal Shroff, and Sandeep Bhagat. From the inaugural address and session, Sundara Raman Ramamurthy is rejoining us. Adit, of course, has been building Zepto and has been doing incredible work. We also have Kunal Shroff, the managing partner of Chris Capital, and Sandeep Bhagat, partner, SNR Associates. With that, may I request all our panelists, we always have this as a protocol, that first we're going to request you all to please join us in the spotlight for a group photograph. We know we normally do it at the end, but here we do it at the start. We want you to be in the best energy at the start. So come on, ladies and gentlemen. We've got such great leaders with us. Let that applause continue as we have all of them joining in for a group photograph. We would want to capture this particular moment and encourage all of you to take those photographs, put that word out, and of course, continue posting. And with that, please remain seated, and if I could now request Kamlesh to take forward the live baton.
Thank you very much. And welcome to all the participants here. We have a wonderful panel. Sundarji heads Bombay Stock Exchange, and we have Adit, a very, Prime Minister keeps talking about our Indian startups. So that is one Indian startup. So let me just introduce. Yeah. And then we have Sandeep, who is a legal expert, and Kunal, who represent investors, right? Because he heads a good fund. So we have a very wonderful mix of panel. And the topic is also a very, very relevant topic today. The IPOs, where all retail investors participate, and how it is performing, to what extent we can make it more transparent. That would be the theme of today's discussion. But before that, let me hand over for the quiz. Thank you.
Thank you so much. I, of course, didn't want to leave the opportunity because we have such a great moderator and definitely the introduction of all our eminent panelists. So ladies and gentlemen, as cued in from my team and of course the organizers, we also have time for us to go back to having 3 of you win this next quiz. May I again urge all of you to scan the QR code right here on the screen. We had 430 people participate in the first quiz, and we had a tough competition, and 3 emerged as winners. As we have now displayed on the screen the QR code, and we know we've got such an enthusiastic audience who's so well-read and so educated on this, we're encouraging all of you to take out your mobile phones. We can see 132 of you logged in. We're just going to keep it for a couple more seconds on the screen. Remember, the QR code is there for all of you. Just the rules of the quiz is the fastest person. There are going to be 5 questions in this quiz again. 20 seconds to answer every question. The best, the fastest as well as the correct answer winners towards the end get declared top 3. We have 255 of you join in. That's great. And we can see all of our names getting displayed on the screen. Remember, in just 5 seconds more, we're displaying the questions. And as I can see a lot more of you joining in, and for the ones who couldn't, remember, we'll still have the QR code on the screen for all of you. 312, it's getting bigger and better, and I think it is now time for us to go ahead and begin the quiz. Ladies and gentlemen, the first question on the screen. You have 4 options right there on the screen. Remember, you only have 12 more seconds. 132 of you have already logged in. We're going to see how many of you know the right answer. And let's see what the audience pulse is at. They feel it is the SME platform with 92%. Let's see if it's right. Yes, it is right. So 92% of you got that right. Next question on the screen already. 20 seconds have started. We have 4 options for the same. 100 of you have logged in. We'll see how many of you get this right. 5 more seconds, ladies and gentlemen. Remember, right answer and the fastest. The second option gets 85%. Let's see if it's right. Yes, it's a very well-read audience. Let's move ahead to the third one. The timer's already begun. The right answer and the fastest. Many of you are getting right answers in this quiz, which is great. More than 150 of you have logged in your answer already. Just 5 more seconds. Let's find out what the majority feels the answer is. And 62% feels it's the fourth option. Let's see if it's right. Yes, wow, this is going great. So many of you getting the right answers. The fourth question already on the screen. The timer has begun. Let's find out if still the majority gets the right answer. It's only getting interesting and exciting. And just 5 more seconds, ladies and gentlemen. More than 200 of you have logged in your answer. 367 have participated already. With that, 50% feel it's the first option. Yes, half of the audience got it right. Let's move ahead to the final question. Ladies and gentlemen, this is going to be the deciding question. The timer has already begun. Your options are on the screen. Remember, this is the final one. And we're going to be finding out how many of you get it right. And just immediately, we're going to be declaring the winners who are going to be felicitated at the end of this session. The time is up. Let's find out the answer. 45% of you went for second, and it's the right one. Wow. And the winners on the screen. Top 3. Let's find it out. Wow, once again, Rushikesh Ugle, congratulations, Dhaval Sharma and CS Sagar Bode. Let's give them a big, big round of applause. And may we request our winners to join us at the end of this session. And with that, I'd now like to leave it in the hands of our moderator. We just thought we'll have something exciting before we begin your session. And of course, we'd now like to give the live stage to you. Thank you.
Thank you so much, and heartiest congratulations to all the winners and all the participants. It was quite encouraging. I mean, so many good right responses that you all gave. It was really good, and I understand that, sessions have been delayed, so your lunch may get slightly delayed, but I can assure you, we have a wonderful mix of participants, panelists here, and they will keep you engaged. So, this IPO topic in itself is a very, very relevant topic that we see today. A lot of IPOs are coming in the market. Retail participation is also very encouraging. In fact, if you see the number of IPOs which have hit the market in last 2 years and the amount of capital that is raised, we are having 2 successive years of good IPOs. If you see the history of IPOs, you won't find too many instances of consecutive years of good IPO. They generally follow a cyclical nature. But this, I can tell you that even the third year, what we are going to have next year, we already have a strong pipeline of IPOs, and it is likely that we are going to have third consecutive year of good IPO. So that is something which will prove that we have gone out of cyclical nature of IPO, and we have now entered a consistent phase of good IPO. So what are the issues surrounding IPOs that troubles the mind of investors, particularly retail investors? Now, those issues are the main issues that we thought we would like to discuss and take the views of our fellow panelists. The main issue comes to valuation. SEBI has made it very clear that we don't want to go back to the old regime of control of capital issue who used to determine the valuation and pricing of IPO. It is determined by market forces, demand and supply interaction. So we believe that is the right way to do it, but is there any way that we can make it more transparent and most trustworthy, particularly for the retail investors? So that is one question that I would like to ask my fellow panelists. But before that, let me just give you some figure to show that it is not that valuation has been excessive, because if you see main board IPO this year, we had 72 main board IPO till October, and I have taken the figure till October because these were the data which was presented in the board meeting of December. Out of that, 45 had listed gain, and 6 of them had listing gain of more than 50%, which is quite good performance. And if we go to last year data, last year we had 79 issue in main IPO, that is I'm talking about 24-25, and out of 79, 65 IPOs were listed with positive gains. So that's a good number, but obviously we can improve upon it. So my first question would be to Kunal. Kunal, what do you feel that whether the system that we follow, that we leave it to the market forces, whether it is the right way to go about it, or should we allow loss-making companies? Because we have a system that we do allow loss-making companies, but retail participation is less in that. So do you think this system that we follow is all right, or we need to be more careful about valuation aspect?
Sure. First of all, thank you for having me here. And I would reiterate what you just said. I think the last 2 years, if you count all the IPOs in India, each year over 300 companies have gone public. That's a Herculean task for SEBI, right, to manage all of this. And I think it shows that the depth in the market is really increasing. So kudos to SEBI for managing that. As an investor, I will always say, let market forces determine pricing. Let market forces determine whether an IPO happens or doesn't happen. And as a regulator, my suggestion would be to do what you suggested, which is make sure the disclosures are robust. Make sure that people who are not disclosing are getting caught for that. And you can always add tweaks to it, but how do you make the compliance effective without being burdensome is the critical. Ultimately, there is enough depth in the market. There are enough smart investors out there as well. So an IPO is not entirely done by retail. There are mutual funds out there. There are other foreign investors who can hold the line on pricing. And I would say as long as the regulator is ensuring that risk factors are properly explained, as long as information is shared broadly with all investors, that's the main task of the regulator. Thank you.
Right. Thank you. So, I mean, you spoke about disclosure. So I will come to that disclosure part, which is also very relevant. But before that, let us hear from the startup, right? Adit, you have some views on this, whether loss-making companies should have access to capital market, or the valuation aspect, whatever views you may have on this?
Sure, and again, I mean, I just want to thank you, first of all, and the SEBI team for inviting me on here. Obviously we'll second everything that Kunal mentioned, and, from our perspective, if you look at it, in general, companies that are in investment mode, even if you look at sort of more developed capital markets like the US, those are the companies that, in most cases, contribute the highest amounts to capital formation over the long run, right? Everyone knows great examples, right? The Amazons, Netflixes of the world. I think, of course, with, investment mode comes high growth, comes opportunities for, more shareholder value creation, more job creation in the real economy. But of course, also comes, more risks. And so I think, generally speaking, I'm aligned with the philosophy that, institutional investors should be, the ones primarily underwriting these IPOs. Ideally, these institutional investors should be, capable, should have the, underwriting depth and the rigor to evaluate these high growth companies and to weigh the risks and rewards. And of course, if those risks are correctly weighed, the payoffs in these sorts of IPOs can potentially be higher over the long run, right? So I think, generally speaking, quite aligned, and I think it's just worth noting that, capital investment is not actually a bad thing. And I think if we keep, if we allow companies to invest capital for longer periods of time, and we have longer investment horizons as investors, as market participants, I think we can create larger companies in the long run.
Yeah, that was very useful, Adit. So going back to Kunal, you spoke about disclosure. Now, so we follow disclosure regime in IPO that, we don't interfere in market forces, but we want that all important information should be disclosed in the offer document so that investor can make a very informed choice. So I have two questions on that. One is also related to valuation part. First of all, do you think whatever offer documents, whatever disclosure is made in offer document, is it adequate, or is it too much, very difficult to comprehend? We would like to hear from you, and if you have some suggestion for improvement, that is one aspect. Second aspect is that we were talking about valuation. So would it be a right idea that when we are talking about disclosure-based regime, so we also present the performance of merchant banker as well as mutual fund, or like on the issues, like mutual fund invest as anchor investors, or even like a normal investor in IPO. So what has been their performance in the past, so that investor get an idea that this particular mutual fund who is very good in selecting IPO is investing here, so I am comparatively safe. Similarly, merchant banker performance, that the issue that he's managing is generally giving good returns. If that is known to investors, they can make a very good choice. So your views on these two aspects?
Sure. See, on the first one, I think the requirement is actually much more for companies, so it's a little bit on the burdensome side, but more disclosure is always a good thing. I think the recent regulation where you have a summary or an abridged version is a good idea because it focuses people. Although I'm sure there are ways to reduce the paperwork that's required and focus the disclosures on the key risks as opposed to every risk under the sun. I would say on the disclosure of merchant bankers' success in IPOs, I think some of that is already happening in a small way, where if there are 5 merchant bankers, there's a table that shows how many of their recent issues are above water, below water. It's not a bad idea to at least signal that this company is endorsed by high-quality merchant bankers. It gives retail investors one more area to draw some comfort. I think similarly on the investor side it could, but I worry a little bit about how much noise that can have in the system. Because like you said, there were 70 plus IPOs on the main board, 300 overall in each year of the last 2 years. It can end up giving information, but it may be more noise than actually signal. But I think it's worth iterating with some of the market participants to figure out a model that can give you a good signal out of this.
So maybe, I think, let me bring in Sandeep here. So what are your views on these suggestions of, the performance of merchant banker and the fund, if it is available before investors, they can make better choice? Or will it create noise, as Kunal referred to?
There's already some disclosure on performance of merchant bankers. It comes up in the issue advertisements towards the end. Maybe we can put it up on a website of either SEBI or the stock exchanges where you say that in the past 2 years, which are the IPOs which you manage and how many of them traded up or traded down. On the investor side, I guess mutual funds and maybe pension funds would be the ones handling retail money. And mutual funds have a lot of disclosure, so maybe they can also put up we invested in 25 or 50 IPOs and here's our performance after 1 month, 3 months, whatever, over a 2-3 year period. You could consider putting that up on a separate website, and that can be updated periodically depending upon what. But I think just to come back to your earlier question, 2 thoughts. One is our offer document is too long. Okay, we have offer documents of 700, 800 pages. it is exhausting to read. The only 4 sets of people who read it is the company, SEBI, stock exchanges, merchant bankers, and lawyers. The real guys who should be reading it 800 pages are the investors, which I seriously doubt they will have that much of stamina. The DIP guidelines were issued in 99, 2000. The first ICDR was 2008. It was amended 2018. I think it's time now to rewrite that regulation. That's my personal view. And the focus should be on capturing the material part and actually reducing it to more sensible disclosure. A step today which we've taken is basically going around it, which is saying issue an abridged prospectus. But really the entire document should be simpler to read from the investor perspective. I think that would be the need of what we need to be moving towards in terms of that. Having in disclosures on what the merchant banks, etc., do would be additional helpful factors. Valuation itself, which is what the question is, a lot of steps have been taken in the past 2-3 years to include what valuation people have come in at 6 months before, promoters, what they, and I think that disclosure can all be put into the actual prospectus as opposed to putting it in an issue ad or something, maybe putting it up there.
Yeah, thank you. So that's a very good point raised by you. Just for everyone, in the last board meeting, the abridged prospectus concept has been approved for DRHP stage as well. And what goes into that, we will be notifying it. But these are some very good inputs that what should be available in abridged prospectus, because that is what is going to be read by most of the investors. So what are your views, Adit? Do you feel particularly from risk factors, what should be highlighted more in abridged prospectus?
No, for sure. I think, as a company that's, recently filed our DRHP and went through the process pretty rigorously on risk factors, I think our objective, and I think a lot of new age companies are coming with the DNA of how do we be investor friendly, investor transparent, and at Zepto we describe ourselves as an investor friendly company. One of the most important areas I feel that investors should understand transparently is risks. We try to communicate that also. I do feel that today the risk factor section has become more of a check in the box section, right? People are, to paraphrase, in other words, people are using it more as a, better safe than sorry kind of instrument where you just put all risks imaginable to the company, including risks that are, very broad and vague, economy risk, very high level labor risk, geopolitical risk, which frankly impact every company, in the marketplace. But because there are so many risks mentioned and most of them are generic and are, in most standard issue or in a lot of DRHPs, it actually ends up becoming counterproductive because the real risks, companies that, have an opportunity, to actually hide real risks, buried in between hundreds of actual risks. My sort of humble perspective would be that, maybe we have a section at the top which is, unique to these company risks, right? Which should be ideally drafted by the merchant banker or the legal representative of the company, where, they actually have to draft unique new risks for the company that honestly transcribed, here are 3-4, company-specific risks that you'll find for this asset, and you would not have found for other DRHPs. And then, of course, here are the rest that are more broad for the entire market. But I think if we highlight those 3-4 ones, then investors can actually get a clear sense of really, what am I underwriting?
Yeah, thank you, Adit. I think this is a very useful suggestion that company-specific risks are highlighted, which would be more useful for investor to take decisions, because general risk, generally everybody knows that if economy performs well, this will be the result. If general things, which you will find common in all IPOs, they are relevant, but they may not be as relevant as company-specific risk or industry-specific risk. So that's a useful suggestion. So I think now it's the time to come back to Sundarji. You have heard all of them about disclosure requirement. I mean, you handle probably the maximum number of IPOs. They have all been talking about bulky IPO documents and all. So how do you process them? Do you use any AI or anything? So you can probably share your experience about the bulkiness of IPO, what needs to be done, and how do you use AI to process them?
Sure, thanks for having me. In respect of SMEs, the DRHPs come to us. We process and we give the approvals. In respect of main board, of course, it goes to the regulator themselves. What we have found is a couple of all the points that they all made. One is it's very bulky. And many a times, it does not contain all the relevant things that you want, and it may have a lot of other items. And thirdly, in respect of risk factors, it's all jumbled up. Fourthly, where genuinely somebody puts a risk factor, that risk factor gets taken by press and they exemplify this is such a risky company, why it is being permitted to go live. Actually, where they have gotten it from the risk factors which have been disclosed. So all these things happen with regard to SME IPOs we see. We used to take, therefore, a lot of time in processing them. And it will be a back and forth type of a situation where no finality and clarity is there. A few months before, after a lot of testing, we introduced AI-based package software which is available free to merchant bankers who want to file the DRHPs. Basically, it takes care of 4 areas. One is all the minimum SEBI requirements that need to be complied with. It checks from the prospectus. It uses a LLM and AI. It checks and then sees whether all of them are complied or not. Wherever it is not complied, it highlights. Next is BSE specific additional whatever we have put in place. It checks for that as a requirement. And same way it escalates. The third important point is it goes and checks for background verification. In respect of all the things mentioned there, wherever from public domain it can gather background, it collects and puts it across. Fourth, based on our experience, we have given a sort of red flags to the system. For example, if the chartered accountants are changing very often, or it is a very investment-oriented, fixed cost investment-oriented company, but it is raising money only for working capital. Or the objects clause say it is a general purpose capital that is being taken. So this type of stuff, they may not be wrong, but we need to have a red flag and we need to analyze. So these are the types of modules we have put in place. Till now, around 150 DRHPs have gone through it. The rejection rate is around 25%, which clearly shows it is doing some amount of job and therefore catching things. I'm talking about final rejection, that we don't take it. In between, it will ask for a lot of questions. And it has reduced our timelines. We are able to process successfully an application in T plus 25 days.
Very nice.
So these are some of the things which is our experience.
One thought, sir, just a thought. So suppose 10 years from now, do you think there's a possibility we are sitting around in Samvad 2036 and saying AI is doing the principal lead in drafting the prospectus, AI is taking the principal lead in reviewing the prospectus from the regulator, AI is taking the principal lead in deciding whether the public should invest, and we will be talking about the good old days when we used to review a prospectus? I mean, do you think that's a possibility?
Sorry, last sentence, can you repeat? Last sentence, can you repeat?
I said, do you think we'll be in that where we will be debating that is AI doing too much? I mean, right now it seems to be enabling you to reduce processing time from 30, 45 days to 15, 20 days, which is an enabler. But do you see it taking over?
Okay. So this is a problem with all of us. We generally extrapolate linearly because no, human vision is light travels in straight lines, right? So our vision is linear and typically we tend to extrapolate linearly, but life is curvilinear. In Hindi we say, उसकी जिंदगी में ऐसा एक मोड़ आया था. So life is fully curvilinear. So even if we were to extrapolate it linearly, the way we are talking about, maybe 10 years down the lane, it may not be AI, it may be some super AI, right? And we may be sitting and writing codes for that, and we may not be doing this job. The job quality and nature would have changed. But I don't think the capital raising will be happening the way it is happening today. It may be happening very differently. All the prospectors and all would have undergone a very different type of a change.
Sundarji is reassuring all of us will remain relevant. So, okay, now next topic is also something which is hugely talked about in the media, and that is offer for sale. You know, some people are of the view that offer for sale is something which is used by promoters to take money from retail investors. So SEBI on various occasions have said that offer for sale is essential, because otherwise, if you do not provide exit route to risk capital, why would risk capital invest in startups? Okay, and you know, very interesting data was presented yesterday. I'll share that data with you. It was that contrary to public perception, out of the OFS money, only 16% money is going to promoters. The remaining portion is going to corporates and you know, these early investors. So probably, you know, it is always useful to make our opinion based on data, and that was, I thought, that was a very useful data which was presented in yesterday AIBI conference by Mr. Mahavir Lunawat. So if that data is correct, then probably it is something to be kept in mind while we discuss offer for sale. And Chairman also yesterday, you know, spoke about some data on this OFS issue, and that was that there was a time in 2020 when a large portion of raising of capital was through OFS, but now that has moderated. In fact, SME is only 25% through OFS, while on main board it is about 55%. So kind of moderation we have seen, and that, as I said earlier, is also not going to promoters. Only 16% is going to promoters. So on that context, Sundarji, what do you feel? Is it a concern, or it is something which is required, that exit route is needed for early investors?
Yes, sir. Yesterday in the conference also we discussed about this. OFS per se cannot be used as a yardstick to say it's a bad behavior or something to be concerning. In respect of main board IPOs, as you said, the percentage hovers somewhere around 59% or 60%. There are reasons for it. If the reason for OFS is for the corporates and the promoter who have put in risk capital, they want to at some point of time retrieve the capital which they have employed for a sizable period to reinvest elsewhere. And if we do not permit them to realize the value of their investment, further capital formation could get hampered. Whereas, if the OFS is for the purposes of washing off your hands and totally taking away your responsibility, that could be really concerning. Typically, that concern used to be expressed in respect of SMEs. People used to say there is no skin in the game. This SME comes and makes an issue with you, and every penny being raised here is for OFS. So what is the value add to the economy? That would be the question. There again, as you rightly said, sir, want to share some data. In FY 2024-25, we had 241 SME issues. 9,811 crores were raised. The OFS was 8%. In April to November 2025, 176 issues, 8,033 crores, 23%, because in any case now we have put a cap of 20%. Yes. So beyond that OFS cannot go. So I think typically some data or some imagination, like in the case of risk factors I talked about in respect of SMEs, is taken and exaggerated. So it should not be judged as a bad or good thing just by seeing the word OFS. we should slightly go behind to see the purpose and whether it is just giving away of control or it is for valid reasons.
Right.
I think YFS is not bad.
What about you, Kunal? Yes?
So I have a very strong view on this. As investors, we look at high return on capital businesses very positively. If you're a high return on capital business, you will need to raise less money. So a lot of the investments we make, which are private companies, are also OFSs. We are buying from other investors, or we are even buying a little bit from the promoters. And we would be happy to do that if the company is doing well. I'll give you an old example. Everybody knows Google, Microsoft. $3-4 trillion of market cap. How much money do you think Microsoft has raised from the capital markets? Any guesses? $60 million. 60 million. Google has raised maybe $1 billion, that's about it. And that was 20 years ago. Microsoft 40 years ago. Today, companies are staying private for longer. If that one round that they did in the market, they had done as a private company, their whole IPO would have been OFS. Are you going to prevent investors from investing in those companies? We recently, 2 years ago, took a company public, Mankind Pharma, which was full OFS. The stock is up 2x in 2.5 years. And the point is not to take one example, but the point is companies that are high return on capital will, by definition, not do as much OFS. And you want retail participation in high return on capital businesses. So we feel very strongly about it. I think in the SME construct, it's a good idea to put some guardrails on it so that there's no abuse of the system.
Right. So, Sandeep, do you think some guardrail is needed or this is fine the way it is right now?
On the main board, I don't think anything more needs to be done. Frankly, I don't think, and I think this debate on OFS is frankly more hype than anything. I personally don't think the regulator should be looking at whether it's an OFS or a fresh issue. Fresh issue should be looked at from perspective of where is the money going and is it being described properly in the prospectus. But whether the transaction is an OFS or a fresh issue, ultimately the focus would be, can we get good quality companies to list in India? Can we broaden the capital markets? And the investor focus should be on the company and whether it's an investment decision which is worth taking to put in the money. Whether the promoter or the selling shareholder has sold a lot, not sold at all, I think that just should be part of the decision, but surely that should not be the focus of anybody when they are looking at investing in a company. So I don't think anything further needs to be done in terms of what the regulator should be thinking about.
Right. Thank you. Adit, you have any thought on this?
Obviously I second everything that all three of the other panelists have said. Generally speaking, OFS is a good thing, creates capital formation. But I do have one point that's a little slightly different, which is I do think it is not a completely invalid, concern for investors to have, especially for new age, young, high growth companies, to say, there's still a lot more execution to go. There's a lot more execution risk to create a valuable asset. Are the key management personnel in the game or not, right? And I mean, in day-to-day, running a company, it does happen, right? People do create wealth, even if it's a relatively small percentage of their shares, they do slow down, execution does suffer. It's a very real, phenomenon. So I do think it's not completely invalid for an investor to ask that question. If I was on the other side of the table, and some of the best investors that I've interacted with in the world in private markets, their number one question is, what is founder psychology? What is management psychology? Are they looking to build a generational outcome, or are they satisfied with a mediocre outcome? And so that alignment of psychology between, investor management, investor promoter is important. That's what, creates good outcomes or breaks outcomes. If anything at all, not that I think that something should be done, but if anything is to be done, I think it should be treated in the same way that, SEBI has treated loss-making companies. Basically, the underwriting threshold or the underwriting bar is higher, so it should be more institutional, right? If anything at all. So I think that an institutional investor, like a Chris Capital, is capable of, determining whether that, alignment is there over the long run between management and the shareholder, because they also have access to management that a retail investor would not have, right? So I think if anything is done, it would be more to make it, I think, more institutional and to increase the underwriting bar that way instead of putting sort of restrictions on it.
Right. A very, very useful discussion we had on this point on OFS. Time to move on one point. Hopefully, we will have some, good food for thought. It is on how do we utilize object of the issue. Yesterday, AIBI conference, we had different views. From merchant banker side, the view was that we should not have a very clear-cut object to the issue. There should be flexibility there that will help company to raise money and use in a flexible manner, while the regulator thought that it is important that the object of the issue should be clearly laid out, because investors want to know how their money would be utilized. So let me start with Sandeep. What do you think, which of these two positions you will go for?
See, investors should know where the money is going and how it's being spent. I don't disagree with the general principle. I think the flexibility could be in when you're raising money and let's say you want to use it for an acquisition, or in the new age companies you want to be able to do things which you've not anticipated, but you clearly set out and give some approximate ideas, and within that do that. So people should have an idea of where the money is going and how it's being utilized. I think the request for flexibility would be that it's not always clear-cut when you're raising money in the IPO market, exactly and to what detail you're going to use it for a particular, let's say, an acquisition or a particular expense. So can there be flexibility to say we will use a range between X and Y to be able to do that? Currently, you have 35% with general corporate purpose to do acquisitions, which include that. Can we, instead of having that, can we give more flexibility for companies to be able to do that? If they tomorrow want to change the objects, they need to go back to their shareholders at that point and should be able to do that. I think the other bit, which is a little strict in my view, is that if you want to change the objects and there are dissenting shareholders, then you have to give them an exit. I think that, to me, the investors who've come in the IPO may not be the same ones. That's under the Companies Act, so I think that may be something to think about. But there should be, even if you've not got it down to the last rupee as to where and that's the current requirement, take it down to the last rupee other than for 25%. Is there some possibility of giving some more flexibility for investors who are today coming in and want to do, may not have an exact idea what, but may have an expectation or a range that they may raise the funds that way. So it's a bit of a balance. I think it's a little delicate, right. But you do need to specify where you're, where the money is going.
Sundarji, you had a view on that yesterday. I heard it on your keynote address.
See, in the respect of, my view was very specific to that of SME yesterday. The situation becomes different between a main board and SME in this case. The amount raised in a main board is far larger, and the company has gone through greater stringency and is open for retail public. And there is a greater amount of setup that is already in place in such companies. Whereas in SMEs are not only small and medium enterprises, they're also in a way subject matter experts. They know their subjects. That does not necessarily mean they know accounting, they know corporate governance, they know many other things. They are fledgling, they need support. So there can be good companies and there can be bad companies. So if we just permit everybody to have a free object clause with no monitoring, then what can happen is the 200 crores or 100 crores or 25 crores or 40 crores or 15 crores which is raised, I'm not saying will be squandered, could be squandered, and it is public money. And the capability, like in the case of a main board company where a larger institutional investor has a capability to go and question the the company and get data. Here it will be for 15 crores, many people will be there. They are not going to get this. And if it is not properly monitored, there could be loss of faith in this system. So the same yardstick cannot be applied. In respect of SMEs, there should be some amount of stringency with regard to object clause and utilization of those funds. I'm not saying the stringency should be such that they're not able to breathe, but not having a control, not having a stringency could lead to loss of faith in the system.
Yeah, so unlike yesterday, we seem to have some convergence between two of you. So more of what chairman calls optimum, right? So balance of both sides, right? Yeah, good. So, so I now move to confidential filing. Now, friends, we have an option that DRHP can be filed in a confidential manner, though I don't know whether that remains confidential because we can see it on the media that this company has filed confidential DRHP, so it doesn't remain confidential. But anyway, so what is the utility? Maybe I will ask Adit. What do you think? Is it necessary, or what flexibility does it give you?
No, absolutely. I think the confidential route is extremely valuable. I think you correctly mentioned that media gets a wind of it. There are these MCA filings that give it away, and all these journalists are waiting for the notification, so they immediately get to know. But generally speaking, confidential filing has been valuable, at least in our experience. Few reasons why. Number one reason is it puts us in a position where we can start the SEBI process, ahead of time, get the commentary, finish and refine the document while our numbers are still playing out. Especially for younger companies, difference between, 2 quarters can be 50% revenue growth, right? And I might say, okay, I might want to, let's say, go public end of this financial year. I think I'm going to grow ABC %, but I don't want to, start the process then because there's a couple of months lead time. So I can actually start the process early, finish it with SEBI, and then when I start presenting my actual commercial picture to investors, I have my full financial year completed. So actually it helps you save quite a bit of time in the listing process. So that's one. Second piece obviously is that it gives you optionality, right? I think for companies that are getting built out, capital flexibility and optionality is always a good thing. There are multiple sources of capital, private capital, public capital. And I think having a thought process saying, I filed a DRHP confidentially, I'm going through the process with SEBI, but depending on what the situation is, maybe market environment improves, deteriorates, but I can take a call later. I don't need to give out all my numbers to competition or other industry participants. I don't have to risk anything to begin the process. So in our case, we're in a competitive industry, so if we're going to initiate that process, it's better to initiate the process confidentially, have certainty that, okay, we've completed the process and the IPO is imminent, and then make the numbers public, versus make the numbers public on day one and then, give up industry secrets and numbers, etc. So it's, generally been very positive for us.
Thank you. Kunal, you agree with Adit?
Yeah, I think Adit put it really well. I think the optionality is helpful. And I don't think you are sacrificing anything. Because ultimately, if the company chooses to go public, the same level of disclosures have to be maintained. So I think it's a positive. Obviously, it's more work for the regulator and the exchanges. But given the job is to develop this market, I think it's a win-win.
Yeah, so now your perspective, Sundar, more work for you because of confidential filing. You again have to process it. So do you think it is okay?
I think it's okay, sir. Okay. I think it's okay. The point what Kunal made, more of a regulatory job. So it's good.
Right. Thank you. Friends, so I will now come to my last question, maybe because we have been, all earlier sessions have been stretched up and time for lunch. So I will just ask one last question to all of you before we finish. Maybe a little ahead of time, unlike other sessions in the morning. So SEBI preamble has, 3 distinctive objects to be achieved. 2 of them are very important, that is market development and investor protection. Chairman said it very clearly, that it is not that it is either this or this. Both can be achieved together. And the purpose of discussion that we had in this session was that how do we do market development, more IPOs without compromising investor interest. So we have tried to cover a lot of topics. Now I will go one by one. Something which has not been covered, you feel this can be done, maybe any out-of-box thinking, this can be done to make this process more transparent, more fair, so that we have more number of IPOs without compromising investors' protection. So I will start with Sundarji. Yes.
So SEBI has done a wonderful job in these 33 years of its existence, that today, by any parameters what we take, there are many areas where probably we are #1 in the world in terms of our processes. There is no doubt about it, and it is a tremendously great job, and this should continue. One vague thought process which always comes to my mind is, are we considering all investors as same? Or are there different classes of investors who may require different things as protection? Today, all investors to us, whether it is a small person who is applying for a 10 share or a person who is dealing in lakhs of share, are we treating all of them equal in terms of investor protection? Are the needs different? Are we able to cater to the different needs of protection differently? Is one vague question comes to my mind. If you ask me, do I have any categorical things to talk about it here? Maybe no. It is some thought always lurking at the back of my mind.
Yeah, thank you. That's very useful. Yes.
So I think I just want to echo Sundarji's words on the fact, and saying this genuinely, I think SEBI's done an exceptional job. Process of filing for an IPO for us was actually very positive and smooth. And I think all the requirements, although it requires work from the company, requires work from the founders, I don't think anything that was asked from us was unreasonable. I think everything was actually pretty fair and done in good faith, and hopefully that process continues. So it's wonderful, and as a company that's got investors from across the world, right? Europe, United States, parts of Asia. Frankly, capital markets are not as welcoming in a lot of parts of the world. So it's great to have that. I think to answer the question, the best way to accelerate IPOs is actually to take a step back and go deeper into private markets. I think that there is actually a pretty meaningful gap, a very serious gap in India right now that's overlooked, but actually is a pretty big engine for growth and job creation, which is late stage risk capital. Right? If you go to the US, you'll find a lot of relatively high beta, large capital allocators that are still willing to take risk, because they've got very big outcomes. You can build a $100 billion, $1 trillion company in the US, and so people are willing to write big checks and take risk even at later stages, right? Now that does two things. One, that enables companies to grow more, take a longer horizon than public markets sometimes allow for. Private markets are static. It allows a company to take a 2, 3, 4-year view, which is important in the early stages or in the growing stages, right? Public markets demand quarter on quarter, right? So how do we basically create a deeper late stage risk capital ecosystem? Today, that entire ecosystem is 100% dependent on American capital, like almost entirely, right? There is no, or there are few very heavy, high growth risk investors there. I think if we have that, and if we bridge that gap a little bit deeper, we will create more public ready companies, because there are lots of founders that I know that are running exceptional companies, but feel like they need to achieve XYZ scale, XYZ metrics before they can go public. And to accelerate that process, that's where capital should come in, but they just don't have access to that capital, so their IPOs get pushed out by 2, 3, 4, 5 years inadvertently. So how do we as market participants, as a regulator, create more capital there? And I think the way that we do that is primarily through OFS, right? I mean, the capital that comes out from OFS and the wealth that's been created with family offices and promoter groups, how do we now use that to build, late stage growth equity firms for this asset class? So if there's any way we can encourage that, I think that's a big white space opportunity.
Right, thank you. Sandeep?
It's something which I said earlier. just as a legal person working on IPOs, I think it would be helpful, it's time to relook and redraft ICDR with two clear objectives. One would be make the offer document simpler, which would mean, and obviously the second part being continue to keep investor protection in mind, retail investor protection. To me, I think the one other part of this, you can't make the offer document simpler unless you're ready to say that I don't think this is needed. And I think, and this is my personal interaction also with SEBI over these years, is if you are taking a call, if you're taking a regulatory call that we should delete or we should change or we should amend, while there is investor and retail protection in mind, perhaps the thinking should also be, can we, are we still getting to the same point with reducing this, but not, is SEBI doing too much for retail investor protection when it looks at the disclosures? I think every regulator in the world is focused on retail investor protection, but when you are changing laws, when you're trying to make something simpler, the question should be, are we doing too much and therefore the disclosure obligations becomes higher, or can we live without and can retail investors live without a particular disclosure? I think that should be the focus when you are redoing and relooking at the regulation.
Yeah, thank you. That's very useful. Yes, Kunal.
Sure. So, first I think it's good to step back and think about what has happened in the last 5-7 years, right? Your retail participation has gone up 5x, 6x, which is great. I think market development, what has happened is commendable. You look at domestic market deepening and you look at foreign investors, they've been selling at various points in time without impacting the market the way they used to 10 years ago. That's all credit to domestic institutions stepping in and now being the dominant player in the market. It bodes extremely well for the next 10 years and where India can go. And the last point I'll make is household wealth. I mean, I think the markets have done a fabulous job of increasing participation in equities. 5 years ago, 2% was in equities. Today, it's more like 6% probably. That's fantastic, but it's still very, very low. The US is probably 6-7 times that, right? And we may never get to that point. But it's remarkable to see that at least from a low base, equity is being embraced, right? From physical savings to financial savings, and within financial savings from fixed income to equity. And I think that's very commendable. What that will do if you extrapolate further, whether linearly or not, I don't know, is there will be much more of household wealth in equities 10 years from now. And therefore, there'll be more companies, there'll be potentially more scandals and other things to manage as well, right? But that shouldn't deter the market development. So the key is to make sure how do you have redressal mechanisms. But I would actually commend SEBI and the exchange, and I think some of it is luck and where India is in its cycle to really develop this. I have a slightly different point, which is, look, you can try and make things easier for companies to go public, but companies are going public even with the onerous documents. And we have to recognize it's a cyclical market. You won't have 300 IPOs every year. There will be times it will be down. There will be times the markets will be down. The government and the regulators will need to have the maturity to recognize that this is a cyclical industry. And that's not a failure of the exchange or the governance or the regulator. Having that maturity will allow us to take the 6% up to 10% and even beyond. One small point I had, which is actually a very minor point, is to make it easy for companies to go public. One way is to also make sure it's not irreversible. Today, as an entrepreneur, if I decide to go public, it is a permanent decision. Going and delisting a public company is extremely onerous. If we can look a little bit into that and say, how do we make delisting easier, maybe you'll encourage some more good quality companies to think about going public.
Yeah, thank you. Thank you very much. And thank you to all of you for such a wonderful discussion. May I have a huge round of applause for all the panelists for giving their thoughts, which would be useful to SEBI. As we say, the Samvad is dialogue. where we get ideas, and at SEBI, we do look forward to these discussion and ideas from market participants, and then we work on them. So, and I can tell you some very useful ideas came today, and we will be working on them to see how we take them forward. Thank you everyone, thank you.
Well, ladies and gentlemen, may we request our panelists to please stay back with us. First, allow us an opportunity to just capture you in one frame. Let that applause continue as we thank all our eminent panelists. May I also request the moderator to give the prizes to our winners of the quiz 2. We had Rushikesh Ugale, Dhaval Sharma, CS Sagar Bodhe. Can the three of you please join us together on stage, as we'd like to give you a special prize for winning the quiz. May we also request our panelists to please stay back. We'd like to have an opportunity of felicitating you. But first, from the moderator, if I may request you to please give the prizes to all our winners. Ladies and gentlemen, let's give them a big, big round of applause. All of you, please come in together. We'd like all of you in one frame as we celebrate your victory. We have one more quiz at the end, so remember, we'd encourage all of you to stay participative. And of course, a big thank you and congratulations to all the winners. May we request all our winners to please pose in for a group photograph. Thank you so much and congratulations. I know a lot of you have that energy left, and I know you can be better with that applause. Come on, Mumbai. Thank you so much. And with this, if I may request our moderator to first felicitate our panelists. We'd of course like to thank all our eminent leaders with us on stage. They personally have contributed so much in their space. And today they're here to celebrate with us, through their wisdom, contribute their knowledge. And it's such an honor having all of them join in for the same. We have Sundara Raman Ramamurthy, Adit Palicha. We have Sandeep Bhagat and Kunal Shroff. All great leaders here on the platform of Samvad 2026, ladies and gentlemen. Thank you once again to all our panelists. Of course, we still have felicitation of two of our panelists, Sandeep Bhagat and Kunal Shroff. Conversations have been so great here at Samvad. We'd once again like to humbly thank all our leaders for joining in. And now for the felicitation of our moderator, may I please call upon stage Sunil Kadam, Executive Director of SEBI, to please give us a moment of his time and help us in felicitating our moderator of this conversation. He's been excellent. Ladies and gentlemen, let's give it up for Kamlesh Chandra Vashne. Thank you so much, Kamlesh, for joining in. You've been so kind with your time and, of course, in curating this conversation for us. We'd, of course, like to once again encourage the group of panelists for a group photograph at the end. Thank you so much. Just a little ahead in the spotlight. Let's get all of you in the spotlight. And these are the moments, ladies and gentlemen, to capture wherein we talk a little bit more about Samvad, and it should be better only with your applause in the background. These are the future leaders who have been shaping the industry and creating that inspiration for all of us. Well, we've been hungry for knowledge from morning, but I think it's now time for us to take a short break for lunch. May we urge and request all of you, though we know it's a short time for us, but may we urge you to please join us back at 2:25 as sharp we start with the final session. Also remember, we're going to be having the final quiz, which is going to have 3 more winners being announced. On the other side, let me remind you, we have with us our final set of speakers, Shashi Krishnan, Director, NISM. From HDFC AMC, we're going to have Navneet Munit. We're going to have from Lakshmi, Preeti Rathi Gupta joining us. The AVP of Zerodha Varsity, Nitin, is going to be joining us as well. So we urge all of you to please join us back at 2:25 IST. Thank you so much.
architect of future-ready India.
Many steps have been taken to improve transparency in the market.
convened by SEBI and NISM.
We are looking to architect a future-ready India.
Many steps have been taken to improve transparency in the market.
Block 26, convened by SEBI and NISM.
We are looking to architect a future-ready India.
Many steps have been taken to improve transparency in the market.
architect of future-ready India.
Many steps have been taken to improve transparency in the market.
Convened by SEBI and NISM.
We are looking to architect of future-ready India.
Many steps have been taken to improve transparency in the market.
Convened by SEBI and NISM.
We are looking to architect of future-ready India.
Many steps have been taken to improve transparency in the market.
convened by SEBI and NISM.
We are looking to architect a future-ready India.
Many steps have been taken to improve transparency in the market.
Block 26, convened by SEBI and NISM.
We are looking to architect a future-ready India.
Many steps have been taken to improve transparency in the market.
Block 26, convened by SEBI and NISM.
We are looking to architect a future-ready India.
Many steps have been taken to improve transparency in the market.
Well, a very good afternoon, ladies and gentlemen. Welcome back to the second half of Samvad 2026. Well, the inaugural ceremony, the fireside chat, the panel discussions truly have been enriching. And we're looking forward to a great finale of Samvad 2026 through your support. We hope you had a great networking opportunity outside, and it's always great to meet your peers and the leaders ahead. Now, ladies and gentlemen, it is time for us to resume and put our attention towards one of the foundational pillars of market integrity, the informed and empowered investor. In an era of rapid technological transformation, investor education truly has expanded far beyond traditional outreach. Leveraging digital platforms, data analytics, and behavioral insights to reach investors at scale. While technology has significantly enhanced access to information, it has also raised important questions around effectiveness as well as impact. This session will explore how education initiatives and institutional efforts can be designed, delivered, and evaluated in a technology-driven ecosystem, and how impact measurement can inform more targeted and effective investor education strategies. We're extremely elated that at Samvad 2026, ladies and gentlemen, we have with us our moderator of this conversation. Let's give him a big round of applause as we welcome him on stage, the Executive Director of SEBI, Shri Sunil Kadam, along with his eminent panelists joining, Shashi Krishnan, Director, NISM, Navneet Munit, MD and CEO, HDFC AMC, Preeti Rathi Gupta, Founder, Lakshmi, Nitin Sasikumar, AVP, Zerodha Varsity. And as all our panelists are here with us on stage, may I please, before we begin, request you all to join us in the spotlight. So as per protocol here, we're doing a group photograph before so that we can get the best smiles at the start. So can I please urge all of you to step forward, allow us an opportunity to first capture you all in one frame. And I think the way we can encourage them is through your round of applause. Come on, ladies and gentlemen. Samvad 2026, we resume back with our panelists joining in. Sunil, who's going to be moderating, Shashi, Navneet, Preeti, and Nitin as the eminent panelists. And as the photograph has been taken, it is now time for us to move ahead to the final quiz. Just for the information of our panelists and moderator, we're doing a quiz before every panel. There are going to be 3 winners which get announced at the end of the quiz, and they get felicitated at the end of the session. So just allow me 5 minutes max. We'll just go ahead. For all the ones in the room, you by now know the rules. Trust me, it's going to be the final one. As you know that we have the quiz QR code already. There are 33 of you who have already joined in. We're going to be having, once again, 5 questions each. 5 questions are going to be, again, popping on the screen. They're going to get 20 seconds only to decide on the answer per question. Remember, 3 winners, final, who are going to be announced. It's going to be based on accuracy in terms of the right answer, as well as how fast they are to answer it correctly. So we're just giving you another 10 more seconds. We have 220 of you already joined in. Wow, this is brilliant. In every quiz, we've gone way above 300. We're looking forward to the finale. This is the final quiz for today. We have 265 of you joined in. If there's anyone still left, last 3 more seconds. And if you still can't log in, remember, we'll keep the QR code on the site for you. And with this, let's begin. So ladies and gentlemen, as we have many more joining us on screen, we've crossed 300. We're now going to be requesting the team to go ahead and display the questions. So question number 1, ladies and gentlemen, your 20 seconds begin now. You have your 4 options. Remember, it's about choosing the right answer and the fastest. 5 more seconds left. We're going to be telling as to what the audience feels is the right answer. First, as per survey, we've got 77% who feels it's the 3rd option. Let's see if it's right. Yes, it is. So once again, the audience here is brilliant. Second question already on screen. The timer has begun. A lot of you are logging in the answer. Let's see if in this question as well, do the majority get the answer right? And towards the end, we're going to be announcing 3 winners from this quiz. Let's find out what the majority feels. 50% feels it's the option 1. Let's see if it's right. Yes, again, right. Brilliant. Let's move ahead to the next one. The timer has already begun. We're on the 3rd question of the quiz. 2 more questions after this. 20 seconds per question. 3 winners at the end of this are going to be announced. And as you can see on the screen, only and only 5 seconds left. Let's see what the majority feels and if they're correct. 80% feel it's option 3. Let's see if it's right. Yes, wow, this is brilliant. It's going to be very competitive, looks like. Now we're going to ahead to the 4th question, and let's begin the timer of that. Ladies and gentlemen, just last 2 questions left. These are going to be the ones which are going to be the deciding ones, wherein we find out the 3 winners at the end. 5 more seconds. Let's see once again if the majority is right on this question. As we can see, 62% feel it's option 2. Let's find out if you're correct. Yes, you are. This is brilliant. And the final question, ladies and gentlemen, for the final quiz today. Already on the screen, the timer has begun. Give it your best shot. We're going to be announcing the winners immediately after this. And we request the winners to join us at the end of the session to get the prizes. 5 more seconds on the final question, ladies and gentlemen. You cannot miss this one. 350 of you looking forward to that. Let's go ahead. 91% feel it's option 4. Let's find it out. Yes, a very, very informed audience this is. Let's go ahead. The winners are... Wow, Chirag Agarwal, Pranay Saraf, and Amit Maheshwari. Give yourselves a big, big round of applause, please. And may I request the 3 winners to please stay with us and join us at the end of the session. Meanwhile, I'd now like to leave it in the able hands of our moderator, Sunil, to take it forward. Sunil, we hope that the audience engagement was worth the time of our panelists. Over to you.
Thank you. First of all, let me welcome all of you for this Samvad conference, and thanks for coming and joining this conference. So we have a topic today for a panel discussion on investor education in the era of technological transformation. So how it works? So that's the question of discussion for this panel discussion. This is a relevant question, a relevant topic for discussion in terms of, in fact, recently ISO also has published a paper on this issue. And primary concern of that paper is that while technology is being used and it is very useful for all of us to impart our education as well as increase our reach, but there are also concerns about misleading advertising or deep fake kind of problems. And how do we kind of use technology to increase the education as well as keep balancing the misuse of it? So that's an important topic for us for discussion. So before we start the discussion, let me introduce my panel also. On my left is Mr. Shashi Krishnan, Director of NISM. Huge experience in securities market and the proper education work is being conducted at NISM on, this is the SEBI's initiative, education initiative of in the securities market. Then we have Mr. Navneet Munot. Everybody knows him. I mean, he is a veteran in the securities market as well as the mutual fund industry, and we will benefit from his contribution. Then we have Ms. Preeti Rathi Gupta. She is a pioneer in women and education and women entrepreneurship, and we will get to learn more kind of focus, understanding how we should participate more women in the securities market. And then we have Mr. Nitin Shashikumar. He represents the Zerodha. Zerodha Versity is known to everybody. It's one of the unique product, and it's kind of a revolution in terms of digital education in securities market. So we have this panel with us, and we will get benefit from their experience, and their suggestions will help us to lead to proper investor education. So before we talk about investor education, let's understand how technology has helped securities market to grow. So over the last 3 decades, securities market has done a significant reforms, and primarily the benefit, or what you call advantage, we can give it to the technology reforms in last 3 decades. So starting from, we talk about open outcome system to screen-based trading, dematerialization of shares, rolling settlement, derivatives. These are all the products which have introduced only because we have technological advancement and reforms. And taking that advantage, we in fact are ahead of the world in many terms. If you look at the kind of number of transactions happening in Indian securities market, so NSE stands number 3 in world, and in fact it stands number 1 in terms of derivatives transactions. So if you look at the technology, the number of transactions happening, the market functions in such a manner, all credit goes to technology. But that is fine. So what we do for educating investor, or how do we educate investor through technological mode, it's a topic for discussion for today. And let's see how technology can help us in improving our reach, education to investors, and they come to securities market more informed. So that's the topic, and let's start with our panelists first. So we'll start with the pure education side of it. So just wanted to check with Shashi sir. So if you, NISM has been doing many things in terms of investor education, because that's a dedicated institution created by SEBI purely for this purpose. Now, what are the things NISM doing, and how we are using technology to improve the skills of the people who are part of, who are learning from the education?
Thanks, Sunil. I think all of what you said just now basically seems to suggest that we have democratized access. So it's easier to open an account, you have a demat account, you've got screen-based trading, anybody can get on and sort of lose money on a derivatives trade if he has to lose money on a derivatives trade. But I think the problem is this has not automatically democratized understanding. And I think that's the fundamental problem, and that's how actually technology has actually upended the entire sort of investor education space. And for us, that's, I think, very important, because we are in investor education, we are in financial education, financial literacy, financial inclusion, and hopefully financial well-being, you know, given that sort of order of things. And I think what seems to have happened in the world is that we've got into financial inclusion, forgetting the first 3 steps. And what we in NISM, you know, need to do and have been doing is on 3 accounts. One is, as you said, education itself. And I think, you know, on the education side itself, we've understood one thing, that we cannot solve 21st century problems with 20th century technology. And unfortunately, our pedagogy was 20th century, and we need to transition into, you know, 21st century pedagogy. And I think that's where we will necessarily need to have what I call financial flight simulators. So we need to sort of engage with people who want to learn in this exam to help them experiment in a controlled environment. And, help them in that controlled, say, virtual environment. First of all, learn the cost of failure and learn the risks of, trading this market. And to that end, what we've done is we've set a number of immersive learning experiences in our pedagogy, where we've got a simulation lab. We now have a Bloomberg lab. We are setting up a, data sciences lab. We have now put together a RegTech lab. We will now have a simulated bond trading platform. Because I think the only way that we can sort of teach this generation and the way that pedagogy needs to change is through this. The second thing that we need to do is in terms of capacity building. And there I think there is a huge change that necessarily needs to happen, because it is not what we teach that is important. It is how we teach that is going to become very important in this world where technology has made such a big difference. And therefore, the way I see it is we need to transition from what was essentially a linear way of teaching, where you picked up a notebook and said chapter 1, 2, 3, 4, 5, 6, and then an assessment at the end of the day. To give people an opportunity to learn at their pace, it necessarily needs to be a lot more dynamic. And to that extent, what we have done is we now have moved away from that traditional, let us say, text and PPT, which we would have even on many of the digital offerings that we had, to more immersive, modern authoring tools and, personalization and, a lot more immersive experiences out there. And with that, I think the next challenge that comes in capacity building is the fact that you need to move to micro-learning. Because gone are the days where you could have these expansive, subjects and courses. We necessarily need to deliver a lot more content, bite-sized content. And to that extent, what we've done is we've converted what we essentially had, a lot of e-learning courses, etc., into skill development courses. Because I think the need of the hour now is, can you deliver skill development courses digitally? I know there's a long way to go, especially to sort of build up capacity in the market, but I think that's the second thing that we do. And the third part of what we do is investor education. And that's where I think technology and digitization can be very, very useful, because it allows us to deliver at scale. And what also happens is that now that technology enables us, for example, to translate into all the 14 vernaculars that are commonly used in this country, it becomes that much more simpler for us to create content and to deliver content at scale. And that, I think, is going to be something that will change the entire way we look at investor education in the times to come.
Thank you, sir. I think what we need to understand is that pure education or classbook teaching is okay, but in addition to that, if you want to be a job ready, you need to add a skill. And therefore, you should have these facilities, simulation lab, Bloomberg lab. All these labs are useful for learning students. Now, taking from there, now we'll move to Mr. Navneet. So, thing is that we all have heard the mutual fund Sahi Hai campaign, and it's very popular. So, one thing is sure, the concept of mutual fund has reached nook and corner of the country. But taking further, now we have very multiple products available in the mutual fund industry, and sometimes they are complex also. So if you want an investor to make an informed decision, how do we kind of give more focus, awareness campaign or education to them?
Sure. First of all, thanks for having me, and sincere compliments to SEBI and NISM for putting this together. And the name is very appropriate. I think it also reflects ethos of SEBI. I mean, everywhere in the world I talk about it, that I have the honor and pleasure of working with some of the industry bodies, including MFI and some of the business chambers, that our regulator prefers an open, honest communication from both sides, and the name is Samvad. And we have seen that every regulation that comes, every step which is taken is after thorough deliberation, after a lot of consultation from each and every market participant, each and every sphere of the society. So Samvad also in a way reflects that, so sincere compliment on that. And agree with you, the Mutual Fund Sahi Hai campaign has been very successful over the last several years. It has created, I would say, at least a sense of curiosity around the product, has busted a lot of myths around the product. And there is a book, Persuasion. It's a very famous book, Persuasion. I think what we have done is something like a persuasion. So persuasion is done by individual players, but a persuasion is done by industry in a highly collaborative manner. Once I remember it was like very flattering for us that I got invited to speak at a consumer industry event, and they said that you have done something interesting, Mutual Fund Sahi Hai. What is that we can learn? And I said it is very flattering and embarrassing because you sell your products to more than 100 crore people and we have only 5 crore investors yet, so what should I tell you? But definitely something has worked where all the industry players have come together and talking about the product. But on a serious note, while it sounds like there are many products and there's some bit of like complexity, but I think thanks to the way regulator and industry have worked together over the years, we have tried to make it like really very simple. India is the only place where you know that if you are calling a fund a large cap fund, what does large cap mean? That these are the top 100 stocks. Our own fund at SDFC used to be called top 200 funds, got launched 30 years back. And then when the regulation changed in 18, the name got changed to top 100 funds. But then SEBI was persisting and said, no, everybody's calling large cap, so you call large cap fund. Now somebody was calling it blue chip, somebody was saying top 100, somebody was saying something else. Now every fund is like large cap. When it's a large cap, you know what is the underlying index. If you're calling it mid cap, then you know what is the underlying index. Then like minimum 65% has to be in this category. That itself has brought in like a lot of simplicity. The way disclosures are, I mean, you go and see the fact sheet of any of the fund house, it may look like there is a lot of information for somebody who wants that. But if you want like basic information about any product, the way it is disclosed, I think again, a lot of credit to the regulator and the industry body working together over the years, the way we explain whether it's the fund's characteristic, whether the details about the fund manager or the portfolio details, the performance details and all have got like simplified over the years. The industry message of Mutual Fund Sahi Hai is like very simplified, that markets by nature are volatile, invest in a disciplined manner, don't get swayed by the volatility. Volatility is going to be there. I mean, if you are investing through the SIP, and again, it may sound like very flattering, but the SIP has become a household name. And somebody just told me yesterday or day before that a doctor was explaining to a patient, it's a real life story, and उसने बोला that जैसे SIP करते हो वैसे रोज लेनी ही है. So it was like very flattering. And there is a ad on the front page of I think it was Times of India, where a real estate player wrote, I mean, they were selling plots of land that do SIP in real estate. We have seen gold players giving an ad, do SIP in gold. The pension and the insurance companies have done. And the most flattering was, few weeks back, I saw an ad by a spiritual guru, which was SIP, and I said, ye kya kar rahe SIP? He said, spirituality in practice, because everybody has understood. So that's the simplicity we have kind of like brought in, that it's very difficult to do time. SIP has become like, okay, investing in a disciplined manner, markets will go up and down. I can talk about many other things that within the industry, whether it's a fixed income fund, when somebody is investing in liquid fund, and every fund is called liquid fund, that if you are investing in a liquid fund manager is investing in securities with less than 90 days of maturity. If you're investing in an overnight fund, in India it is called overnight. We are not calling it like globally in US, you would see somebody calling a money market, somebody calling something else. It is like an overnight fund. You know what an ultra short-term fund means. But of course, there are few categories and classification has happened. SEBI, I've heard like SEBI is looking at that classification again. There is another beautiful part of the SEBI that while there are things which are carved in stone, but every few years there is a constant review to make it more simpler, to make it more accessible, to make it easier for every fund. I can talk about like many other things that industry and regulator have worked together to make it easier and to make it more simplified. I mean, I'll highlight one of them. So a lot of people might say that in a country where a small percentage of people are speaking English, but let's say large part of some of these portfolio disclosure, etc., and maybe all of them had their birth in the US, so an alpha or a beta and some of those like benchmark, etc., are borrowed from there. I think another innovation of a riskometer. People relate to some of those colors, so you know that this is the riskiest product and this is the least risky product, and on that scale, where does this product kind of like fall. So I think both the regulator and industry body over the years have worked very hard to communicate our message in an easier and easier manner. And the one thing again stand out, maybe even at the cost of repeating, I think this whole thing about the SIP, which is like disciplined investing, the power of compounding, staying invested for a long term, I think really stands out in terms of making something complex as simple in a country like ours, which is at the very early stage of financialization of savings.
Yeah, thank you. Thank you for this information. In fact, the concept of mutual fund we are promoting basically because many investors do not have access to finance. I mean, they have access, but they not have ability to analyze the financial reports, the complex accounting norms and all. And mutual fund industry, that way the products offered them by them, gives a simple products so that people can straightway go and invest in schemes which is already analyzed by the informed kind of investors or something. Now coming to Preeti madam. So she is a pioneer in women education. So talking about women education, in fact today morning only Mr. Ashish Chavan mentioned that we have increase in number of women investors, and today every 1 in 4 investor is a woman investors. So that is a significant progress. One more thing I would like to share with you is that India probably is the first country to make a woman director mandatory on the boards of the corporates. So that's a initiative which regulator itself is taking to promote the woman entrepreneurship in overall country. So taking your background, just a simple question, what prompted you to focus on this area actually?
Well, firstly, thank you for having me. I think we do need this representation of, how do we have more awareness and education to women to access capital markets. I think a big round of applause to the many young women I can see seated here. It's such a sure sign of optimism for all of us. So, 5 years ago, I'm part of a larger BFSI company, and I was watching what's happening there, and I think sometimes, they rightly say, that it takes a woman to see, problems that women face. And in this journey, I realized that women were actually not, taking charge or taking decisions around investing, whether they were earning or they were saving money. And one of the things when I sort of studied a little deeper, I realized that, everybody as the digital platforms came, it was not a problem of access because everybody had access to it. It's definitely not a problem of, aptitude or attributes, because we know that women make for amazing savers. A lot of people, and I say this on every platform, that we've been tagged as women to be risk averse. And I cannot stress more on the fact that we are not risk averse, we are very risk aware. And which makes for it's a great investor attribute, where you're actually studying what the risks are before you put your money in. I think what I realized was the problem was more around the system, it was more around design. Something that would suit the way women would access capital markets based on their life stages, the way they think, their behavior. And that was what needed to be solved. And in my head, I thought, the time is right because, it was like, if not now, then when? Because technology was the big catalyst. It was, women no longer needed to come to anybody. You could actually reach out to women. And second, it was also a question about if not me, then who? Because, being in the ecosystem, I understood the problem statement. That's how Lakshmi started. The idea was, how do we create a platform which understands women, helps them in this journey, or rather, I don't even use the word help, powers them in this journey because, for us, our life stages, the different hurdles that we face, and I will give you one example that typically, and Navneet just spoke about SIPs, which sort of stresses upon the fact that you are able to invest with the discipline at regular intervals. Now, the challenge with women is that at most times, even if they start, they are not able to, right? Because maybe their career takes a break, or maybe they drop out of workforce, or whatever. Second, as women, we tend to we manage household finances very well. So the way we think about money is very emergency because of these life stages that, how do I manage? I have to first take care of what's in the near future. I have to take care of emergencies. So the idea of long term and how do I access products that help me even save or grow money in the long term is not a thought that occurs. And the core of this is education. Is awareness. And even that education, it's not that there's not education, there's enough education out there. But how are women accessing? Are they accessing, first of all? And we just had a small chat before where we said there are modules, but women are not accessing. So really creating even education in a way which is bite-sized, which is relatable, and which is true for them at their life stage. I think one of the things that women suffer from is time poverty. So if you have a 20-hour module, if you have a certification course, it's not something that they take up very easily. But if you make that very bite-sized, very easy to access, at the time when they want to access it, or nudge them when they should access it, we realize technology solves for that. So that's how Lakshmi happened, and that's what we are building. And the core of course, something which really differentiates knowledge sharing for women is a community. Women, no matter what it is, whether it's parenting, whether it is, even cooking or anything, we like a sense of community. We always reach out to other women to understand what they are doing. So the core of this knowledge sharing is the community that we've built. Community plays a very active role in, today if one woman comes and asks that should I put for my daughter's or son's education, should I put money in a Sukanya Samriddhi Yojana? There are 50 and 100 other women who will come and give inputs that, okay, maybe you should invest, do this SIP in a mutual fund because after 15 years, this is the money you would need. We'll have some people say invest in cryptocurrency. So all types of knowledge sharing where then we play the moderator and we come in and discuss the pros and cons. This makes very holistic knowledge consumption where she feels very confident. And I think confidence is that gap that was missing and which is primarily what we are solving for.
Thank you, Preeti. So it's not new for us that women are always saving money. It's not that they are not doing it. Only thing earlier it was used to save in the kind of rice dabba or something, and now it's moved to a financial product which gives kind of give returns on their investment also. That's a good shift, and going forward we would like to changing those ratio 4:1 to 2:2 as 1:1 up further to that. So that's a beginning for all of us, and we will be very kind of supportive for all these initiatives. Thank you for that. Now coming to Mr. Nitin now. So Nitin ji is part of Zerodha Varsity. So this Varsity is a kind of a new concept for India market, especially in the area of financial education, and that's a beginning which Zerodha has done. Importantly, this is a kind of a free education platform, and I was talking to him before that. So almost 2.5 lakhs people in a year, they take benefit of their certifications. And going forward, that will going further. But just a basic question again for you also. So what prompted you to think of starting this kind of initiative?
So let me set a little context. Zerodha as a company has been around since 2010. I've been in the system for 6 months, right? So the OG Nitin, I know a lot of people might get confused when they see Nitin over here and then Zerodha and think that, oh, Nitin Kamath has come. But unfortunately, I'm representing them, so sorry to disappoint everyone else who thought that the other Nitin has showed up. But it might surprise you when I say that when Zerodha was just an idea in Nitin's head, he'd actually sent out an email to the people that he was starting the company with a list of probably 5 things that he wanted Zerodha to do, right? Broking obviously being the cornerstone of the company. But one of the things that he actually mentioned in that small note was financial education, right? So since day one, there was an objective that Nitin had that financial education has to be imparted through a setup like Zerodha. Now, it did take 5 years for Karthik Rangappa, who actually started Zerodha Varsity within the ecosystem, to come in and take this up. So Karthik was an educator before that as well. And when then he joined hands with Nitin in 2014 is when Zerodha Varsity emerged, right? You asked me earlier also why Zerodha Varsity, not Zerodha University. University would have probably led to some regulatory questions regarding from UGC or anything else. Varsity was a very easy way to let people know that this is a sort of a collegiate approach without coming under the regulatory ambit, right? So the objective was always free education. The purpose of that, if you think back to what the market was 10, 11 years ago, right around the time 2014, you probably had around 20 million demat accounts, if I'm not wrong, in India, right? Today, that has gone nearly 10x, right? So the objective when you're starting something like this was to ensure that if people are coming and using the platform, how can they benefit the most out of it, rather than just come in and buy and sell stocks? What can you learn out of it? It was a way of sort of giving back as well, right? And if you think about it, is also ensuring that the people who are using the platform are well-versed in the markets and they remain sticky for life, right? So in a nutshell, that was the goal behind creating Zerodha Varsity as an educational platform.
Thank you. And one more kind of connecting question to it. So your platform is entirely free for the participants, actually. So normally, a general mindset or tendency is that whatever is free is not good. So how do you balance that thing? How do you still attract people to come to your platform?
So I think I differ a little in that, right, where we generally assume that free is not useful. But I think if people see the genuine intent with which you're approaching content, if content that you're creating or education that you're creating, I shouldn't be calling it content because it's so misused these days, but if the education that you're putting out has no malicious intent, you're not trying to upsell anything, you're not trying to, so even if you look at the Zerodha Varsity app today, you will not find the Zerodha logo in many places. So a lot of people still come back to us today and say, hey, I didn't know that this was part of Zerodha, right? So I think as long as you are creating educational content with the objective that this free content is meant to actually improve the lives of people, and you're giving it your everything, right? You're not holding it back thinking that free content should be only limited to the ABC. If you're able to go from A to Z, go in depth, people will slowly start realizing the value that the genuinity of the content starts to get appreciated. So I think each time you exceed people's expectations with content is when they actually appreciate it. Yeah.
So anyway, education, whether it's a free or paid, is very much essential. And considering that securities market is a kind of risky product, it's a complex product. No matter how much education do, it's less. So all of us should be joining hands to create more awareness on this issue. So coming from there to another issue, the mode of education many times are different. Some people voluntarily go and learn from the website, whereas some people are required to be forced to go and learn somewhere. So there is a thought always ki if you kind of mandate a certification kind of activity, there will be more participations who will be willing to do it. So Preetiji, what is your thought on that?
So I think, and can I just add a little bit more on your earlier question, especially about, free and, charged content. I think the truth is that in our country, nobody pays or wants to pay for learning, okay, other than schooling, etc. And I feel which is why content needs to be more, learning needs to be more relatable. It needs to be more storytelling. So that people can come back and, sort of want to consume more of it. And once you've done that, maybe they'll be willing to pay, but the first instance is to make it very relatable and, understandable. And I think the way, and I'm sure Nitin will agree, I think that's what sort of the aim is, and so is it at Lakshmi. And just to go ahead, to sort of build more on that, I think today there is so much, NISM does a great job on, and has been doing so for years in terms of whether it's certification, whether it's the knowledge around investing, etc. So do, mutual fund Sahi has become like, I think we use it, everybody who's, sort of telling or advising their customers or clients to use mutual funds, we use that tagline, right? Mutual fund sahi hai. SIP has become such a known, word. I think it's really decoding all of that I think is still a challenge in certain stratas of society, and I would put women there as well, because when I speak to women and they say, Acha, I would ask them, do you invest your money? And they would say, हाँ, LIC है मेरे पास और SIP करते हैं मेरे पापा या मेरे husband, right? So I said, अच्छा उसका मतलब क्या है? क्यों करते हैं? What is SIP? Why do you do it? या LIC अगर आपने ली है तो क्या उसका मतलब है? Why is it like confusing even insurance with investment, right? Actually breaking it down for them to build interest and want to know why this is not investment or SIP, or how can it actually help build their or create their wealth, and how it's the simplest way of wealth creation, right? Or creating their financial security. I think that has been a very interesting journey, and one of the things that I learned was in my storytelling avatar was exactly this, that how do you make that more fun, more interesting. The way we would talk about it is, and I say this all the time, a lot of people tell us, are you simplifying content for women? I said, women are not stupid. They don't need simple. They need smart and what they can connect with. So, the ability to say that, okay, just like you do explaining asset allocation, to say, okay, asset allocation means that, okay, if you have, when you cook for the family and you look at, dal bhi honi chahiye, sabzi bhi honi chahiye, your vitamins, or you'll add in a dash of pickles. So then how does that attribute? How do you look at debt, gold, and equity in your thali, right? I think making that and relating it to everyday concepts is what has been pretty much our journey, and more interesting. And I think building that relevance actually brings recall to say, okay, this is what we've understood, and now I remember what it is.
Sir, taking forward on certification subject, NISM has been conducting a lot of certification exam, and almost above 4 lakh certifications are taking place at NISM. So, sir, what is your feedback? Means what people say after taking the survey? Any feedback on that?
So, the first thing is, I think we need to give credit to the regulator for making certification sort of mandatory to operate in this market. Because I think the underpinning of any sort of securities markets is trust, right? And where does trust come from? Trust comes from, the fact that the person who is either managing a product for you, or the person who is advising you, or the person who's selling you a product, has that minimum level of understanding of that financial product or whatever advice he's giving you. And therefore, the moment you say that you are certified, it straight away establishes this credibility. And I was just last week talking to the chairperson of ARIA, that is the Association of Registered Investment Advisors, and she told me that everybody and his grandfather is giving advice, financial advice in this market, right? But why is it that today almost 750,000 people have gone to registered investment advisors? 750,000 people is not a very big number for India, I mean, unfortunately, but we only hope that it will grow from there. And the only reason that they have gone to registered investment advisors is because they are certified. And therefore, I think, and in the morning session, I think without exception, every speaker from chairman to Dr. Virmani and Ashish talked about the fact that, without trust, there is no market. And without certification, there is no trust.
Thank you, sir. Moving to the next topic on the AI versus education. Now, that's a hot topic. Everybody talks about it. Its impact on various sectors is being debated, discussion on that. So education also, we need to debate and discuss on that. So one part of AI is that AI is being used for kind of imparting education awareness, but at the same time, same is also being misused for inducing people or giving the misappearance about some dignitaries or some people in the media and trying to mislead people. So Navneet, from that perspective, what is the thing which we should do that people, while we are spreading messages or giving messages, how do we kind of make people aware of which is fake and which is genuine?
So again, I also have the honor of in the IAPF committee of SEBI, and sincere compliments. I think MF is also participating well in the scam versus SEBI, and tremendous focus in SEBI to educate investors, to talk about the whole thing related to whether it's the fake content, whether it's the influencers who are misguiding, and many things that have been done. I'm sure you would have heard during the day, so won't elaborate further on that. But AI, again, I think this is my view, like one of the most transformational force in human history. We have seen an agriculture revolution, we have seen an industrial revolution, we have seen information revolution, and this is intelligence revolution, and this is like happening at an exponential pace than what humanity can even adapt or adopt to it. But there are a lot of positive, I write an annual letter, and I think 2022 was Gen AI was my person of the year, and I said like this is really transformational. But there are a lot of advantages. There are several things that we could not do, now we can do at population scale, whether it's creating the awareness among larger number of people. In one of our SEBI committee, there was a survey, I think, with participants of over 40,000 or something, where many questions, and one of the question was in which language you would like the content to be. And I'm sure it wouldn't come to you as a surprise, but if you look at the content, a large part of we discussed in the NISM board also, large part of the content that industry has been generating is in English for a variety of reasons. But I think less than, if I remember correctly, the survey results, less than 5% of the population said that they want content in English. I think 40% said Hindi and 45% said regional languages. Now AI makes that a lot easier. If you've generated a content through like Bhashini and now many more of those, you can immediately deliver that content in a different language. You can do personalization at scale. You know that each individual and can personalize the content, personalize the information, personalize the knowledge to that individual. The content can be generated at a scale which would have been absolutely impossible. Today you see a lot of these, even a Makar Sankranti video and also I say that Everybody has got like a content agency in the pocket now. You can generate so much. It has its downside where there could be fake videos, there could be fake content, there could be like so much of proliferation of content on the social media where there's a lot of good work done by the SEBI. But I think the positive side will ultimately outweigh the negative side in a country where after all the efforts, and I just did a lot of chest thumping that our campaign has been so successful, SIP has become a popular name. The fact is, and the humbling part is that in a country of 1.4 billion people, we only have close to 60 million unique investors. So a large number of people are yet to participate in the financial markets in a disciplined fashion. So we have a long way to go. I think over the last 10, 12 years, one of the most outstanding thing about India, underappreciated, is that how we are leapfrogged on many things and trying to solve problems at population scale by leveraging technology. So in last 10, 12 years, we have transformed from the most data poor society in the world to the most data rich society in the world. For decades, we could not get bank account for everyone. Now everybody's got bank account in pocket. For decades, we could not provide a telephone connectivity. Now everybody's got a mobile phone. For decades, we could not provide, let's say, a computer to people. Now everybody's got a smartphone. And I think AI gives us an opportunity to solve many other challenges at population scale. In a country, it's very interesting. We are at a very interesting juncture that you have people who are financially underserved and people who are digitally enabled, empowered, and digitally, I would say, intelligent. My mother never went to high school, but I think she knows how to operate phone far better than me. I would be using like 2, 3, 4 apps here and there, but she knows how to search things far better. She would tell me, ऐसे photo नहीं लेते हैं, ऐसे नहीं save करते हैं, ऐसे forward करते हैं, whatever. That's the part of technology. And now with the AI, it can give us wings to our imagination, what all we can do for our people, whether in terms of access, whether in terms of awareness, whether in terms of creating more I would say, intelligence around all our products.
So adding to what you have said, so just for information of the audience also, SEBI has recently got a power as one of the agency who can remove the fake content from the social media platform or digital media platform. So SEBI has a media management team, and they are being kind of doing a lot of removing or cleaning up kind of activity. And we could say that in last 6 months or 8 months, we have removed more than 1 lakh such contents from the media platform.
Sunil, can I go to the other end of the spectrum from what?
Yeah, sir, for you.
From what Navneet said. As much as we're talking about population scale, I think personal finance is more personal than finance. And where AI gives you the great opportunities to pick up content at scale and personalize it. And deliver personalized content to every single individual who needs that content, especially in finance.
Yeah, I was about to come to you on the same topic. You already answered that question. Now, again, speaking to Nitin, so you have varsity which imparts education, but probably I believe that it is in English and Hindi probably right now. Now, India is quite a bigger country where people speak multiple languages. Now, if you want to reach to this large population, so how do we reach with them with multiple languages? Does AI will help in kind of doing some assistance to us?
Let me take a step back, Sunil. So when Navneet and Shashi were talking about the positives of AI, you also asked the question about how this will evolve, the deep fakes and all of it, right? And I think we ran one experiment also, like a short video where we attempted it. And people they believed in what that deep fake was saying. I don't want to reveal too many more details about it, but they actually believed it for a second. That is how easy it was to create a deep fake even 1 year ago. So you can imagine that as time goes by, AI is only going to get better and better. I think the previous panelist, someone said it'll be super AI, right? I think we are already seeing that happening, where deepfakes are going to be, I think, something that all of us on this panel and everyone over here will have to combat. Sometimes we will have to do things which can scale, which is joining hands in putting out content about the problems of deepfakes, right? But there will also have to be instances where we do things that don't scale. So for instance, we actually work a lot with NGOs who go down to the grassroots level at villages, talk to school children, talk to community members, talk to them about the prevalence of scams. I think every day I saw this as part of a WhatsApp group. Someone's uncle, someone I know, their uncle actually sent a video which was a deep fake of someone in our ministry saying that these schemes are now open for investment and wondering if it was a good investment opportunity. Luckily for him, he had someone in the finance domain that he could reach out to and ask, but a lot of people don't have that availability. So I think it's incumbent on us as people from the industry to keep doing things that scale, which is using technology to put out content, but also do the unscalable and non-glamorous side of educating people, right? Going down to the grassroots levels. Now, going back to your question, which you actually asked me, which is, what is Zerodha doing in terms of language? I think that's a debate that we have almost every day. I don't know whether it is a function of us being in South India of the city of Bengaluru, that our focus has always been on English as the language, right? Because for a lot of us, that is what comes naturally to us as well. But over the last couple of years, we have slowly branched into doing content in Hindi. It's still work in progress. It is nowhere close to the level of content that we have or the library of content that we have in English, right? Hindi is still very much a work in progress for us. That being said, I think this is where the usefulness of AI actually comes into the picture. For someone who's truly interested in learning, it doesn't take too much of an effort these days to just take the English content, use a large language model, such as, let's say, Cloud, Gemini, or ChatGPT, to just ask them to translate it for them, right? So it's not necessary that we have to put resources and time into building something in every language, because as we all know, the diversity of languages in India is extremely vast, right? So people who have that genuine interest will take that effort, is what I believe. The second thing is, sometimes you don't need to actually reinvent the wheel. So if you look at what's happening in YouTube today, they're releasing auto-dubbing features. So you just have to put out language content in, say, English, and someone who wants the language in any, wants to absorb that content in any other language, has the option to actually select that feature and just change that language. And there will be an auto-dubbing feature, which is based on AI, right? So I think using resources which are already out there will help us achieve that scale without putting a lot of time and resources into building out something like this.
Yeah, that's a wonderful idea, actually. Rather than we converting everything to the different language, we give the option for the people to, or person to access the language which he wants to understand. That's a good concept, and probably AI will further improve on that also. So, Pritiji, I will not ask a question on AI, but Pritiji is a kind of in a production business of films. She has produced some very good movies. So, through her movies, she has always been giving some message or something. So, if you want to give a message of investor education or securities market, how best we can use media for giving such messages?
So I'm a little offended that you chose not to ask me the AI question.
No, you're open to answer
Okay,
that.
no. So that, of course, I think everybody's spoken enough on it. But I do want to add a little bit. I think AI allows you, like Shashi rightly said, hyper-personalization, right? Today, and we will, as I think the younger generation will become more and more entitled, because what they expect, just the basic level will be that everything that I need should come to me versus I go and get it, right? So I think that changes, but I think it's also a very deep responsibility of regulator, education outfits like NISM and intermediaries to work very closely together, because the flip side of AI, just yesterday we had elections in Mumbai, and I had somebody in the building come and tell me, नया आजकल नई voting machine आई है, उसमें बोला है 4 बार press करना पड़ेगा. And that's our WhatsApp varsity, right? And many more that AI now generates a lot of content that goes viral to really create a checklist that becomes, and we spoke about it earlier as well, that before anybody, especially when it's their money and they're investing their money, what are the things that they should sort of make sure that they are also, because it's the user, how do you, investor, how do you educate them that what is their onus to make sure, what should they check on, etc. And I think that that is possibly something that needs to be done at a very fast pace, because as you know, the makers of deep fake and using AI for troublemaking or misuse run faster than everything else. So the guardrails, I think, have to be built probably run faster than them and build it. I think on your next question, I think storytelling plays a very important role. And I will take the example of films. Films have always shown that it is the man who looks after the money and woman who looks after the home. So I think what we show in real has a lot of effect on real, and which is where I think that impact is so large. And I've, firsthand we've realized that when we actually sort of create, whether it could be through films, it could be through content, it could be through content distributed anywhere, I think media essentially plays a very important role, because that is what everybody is consuming. Men, women, children, everybody. And how do you actually send out that right messaging, the right education through that is very, very powerful. And like I said earlier, I think storytelling is the best medium to create, interest, relevance, relatable, all of that. And it just makes something, most women I ask, they say, okay, finance is very boring. Or finance is all about, I'm not a math expert. And then it takes us a lot to explain that investing your money or managing your money is not about being great at mathematics. It's about discipline and consistency, right? But how do you get that information in a more storytelling way out, I think is what's most important. And I think my filmmaking avatar has helped build that in Lakshmi.
Very good. So storytelling is an area which I think every concept needs to be explained.
If I can.
Yeah, you want to add something?
I think in India that part of analogy, the part of storytelling is very important. Maybe, that's like the unique society we are, and given our rich, the history and the civilizational, I would say, heritage, that everything we relate to some story. There are very few places in the world where you get so many Puran and so much of stories which are beyond realm of imagination. You have whatever, few of those epics in the world, but I don't think we have not sold ourselves pretty as well. We have all the Superman and the other, whatever, Spider-Man, but I think our storytelling has been at different level. I'll give one example. So we started this campaign a few years back, on the 75th Azadi Ka Amrit Mahotsav, Badni Se Azadi. And this was like storytelling that for thousands, and I completely agree with Preeti, I strongly believe that women are outstanding savers, but they have not been a good investors simply because we didn't really kind of move them in that right direction. So they always have this habit of putting some money in the Badni, the kitchen jar. And it's interesting that in a country where we have the best digital payment system in the world, there are more than 35 lakh crores of cash notes are still sloshing around. Why do we need that? And imagine if all of that moving over a period of time to the investment in the right manner. So it's a whole campaign around Badni Se Azadi ki पैसों को बढ़नी में मत रखिए, उनको आज़ाद करिए. And I'm sure everybody in the industry, even at the MPhil level, what SEBI is doing, what I think most of the other MIIs are doing is, I think, using those stories and the analogies pretty well in this. Because if you just put in a very clinical and a simple text in a school manner, I don't think that's going to work as well in India.
Yeah, thank you, Navneet ji. And we are almost coming to end our session. So before we end session, let me give a background that SEBI as well as MII, we are coming out with a very big media kind of strategy for investor education and awareness. And since all of us are here, I would like to have one theme which you would like to be promoted more significantly, which will be useful from the investors' education perspective? Starting from you, Nitin.
You put me on the spot, Sunil. If I had an idea, I would be in advertising, which I'm not. So unfortunately, off the top of my head, I don't have any idea. But I'll ask this question in turn to Navneet. We spoke about the mutual fund Sahi campaign. Do you think, so in India, Bollywood and cricket is what works. The RBI has cricketers. I think Amphi also has used cricketers. I don't know if SEBI has used in any of the campaigns. Do you think a large part of the success of the mutual fund Sahi campaign is to do with Sachin and other cricketers being part of it?
Combination of many things. As I said, that in India, like I think the storytelling and analogies really work, and somewhere that thing of कि शायद मतलब zero पे मैं भी out हो सकता हूँ कभी, market volatile हो सकता है. Somewhere I think people could relate to that today.
So I don't have an idea other than probably use Bollywood or cricket in the SEBI language.
First, SEBI needs to give permission for that.
So I think we will be flexible in that. The thing is that, Pritij, I want to ask you a question. Obviously, women empowerment is one theme which is already in our consideration. But any additional theme would you suggest that we should take up for prominent awareness campaign?
So I think just highlight a lot more women investors. I think that's very important because, you know, I go back to this campaign that I ran, you know, I sort of ran for Anand Rathi, my company. And I remember when we created that campaign, the tagline, that whatever it was saying, we said, let's have a woman saying it. The person who created the campaign came to us and said, "Nahi, madam, ye to theek nahi hoga." I said, "Why?" He said, "Nahi, normally men hi bolte hain ye line." I said, you know, so these are small things. I think women need more role models to sort of look up to. And I think that is what I would sort of talk about. And yes, I would, you know, I mean, this is something that, while Nitin touched on in Zest, but I think I would really say that I think the right influencers play a very, very important role, especially for women. And if there is some way that we can integrate that piece where we have the right influencers come and talk about, you know, how they manage their money or how they take, you know, what do they look at, what is the education they access, and how do they go about managing, what is the learning that they do, I think that will be very helpful.
Yeah, Navneet ji.
I don't know. We have a campaign like Zindagi Ke Liye SIP, which is like we're trying to relate that everything in life is SIP, right? You don't become a good sports person overnight. It's a huge practice when you are 4 and 5 and then over a period of time you grow. Or you don't become a dancer or you don't become like a doctor overnight. The whole life is an SIP, I'm sure. There can be something thought around it, yeah.
Sir. So first of all, apologies to Zerodha, Anand Rathi and the mutual fund industry. If I were to write a line, I'll say in the securities market, we don't teach you how to buy, we teach you how to think.
I just want to, thank you, Shashi. I think that was very relevant. I think one of the things that I feel is, especially when we go on ground, I think there needs to be a very strong messaging around the difference between trading and investing. I still think that is not very clear. People actually mistake capital markets, they mistake trading equivalent to being investing, and which actually takes away a lot of the genuine investors because then they hear these horror stories. I think that is one piece that I find, at least on ground, when we go and speak to a lot of women and even, you know, a lot of retail investors, it's not very clear.
Thank you very much. I think we are exactly on our schedule. We had a wonderful session, wonderful discussion, and many things to take away from this session. And we thank all the panelists. And can we have a big round of applause for all the participants? Thank you all. Thank you very much.
Thank you so much. Mr. Kadam, for curating such an excellent conversation. Of course, we'd like to personally thank all our panelists. First, if we may request all of you to please help us with the group photograph. Our photography and videography team is waiting for that. Of course, whilst as our panelists and leaders on stage are getting photographed, I'd also like to invite the winners for this final round of quiz, Chirag Agarwal, Pranay Saraf, Amit Maheshwari, to please join us on stage for this moment wherein we request Mr. Kadam to give them those much-awaited prizes which they've won. May we also request our panelists to stay back. We'd also like to felicitate all of you, but just allow us a moment to congratulate our winners. I'm once again re-announcing the names: Chirag Agarwal, Pranay Saraf, and Amit Maheshwari. Let's give them a big, big round of applause, ladies and gentlemen. They got the right answers and the fastest ones, and it wasn't easy. Every quiz had more than 350 people participating, and that's not easy to win and get into the top 3. So congratulations to all 3 of them. Well, friends, if you're clapping, you're not going to get the prize, but you'll get the best prize for the clap. Let's give them a big, big round of applause. Come on, everybody in the house. Thank you, Chirag, Pranay, and Amit. Congratulations. I'm sure they're trying to seek every moment of guidance, and it's a moment of glory. But we'd like to now request our moderator to please give and felicitate our panelists on stage. Ladies and gentlemen, Shashi Krishnan, we'd like to really give our appreciation to him through your applause. They're the ones behind this event. Thank you so much to Shashi Krishnan for his key inputs. Of course, in frame next is Preeti. Preeti, thank you so much. Preeti Rathi Gupta, founder Lakshmi. Some great insights from Preeti today, and of course, we look forward to sharing our appreciation through that applause. We also have Navneet. Navneet, thank you so much. Thank you for joining in. Ladies and gentlemen, Navneet Munith, MD and CEO of HDFC AMC. Such a pleasure having you here with us, Navneet. Thank you so much for being a part of Samvad 2026. And of course, we'd also like to congratulate and thank Nitin. Nitin, thank you so much for being a part of our conversation. Let's give Nitin a big, big round of applause, ladies and gentlemen. These are the moments we'd like to keep a treasure trove of. And of course, to felicitate our moderator, may I also take the opportunity of inviting on stage GP Garg, ex-executive director of SEBI, to please join us. Let's give Mr. Garg a big, big round of applause as we welcome him. And may I request Mr. Garg to please give a token of appreciation to our moderator, Mr. Sunil Kadam. Well, this has been the finale conversation, and I think your applause can be much more louder as Samvad 2026 has been so great. Maybe request in the finale to just have a group photograph, all of you, towards the end, just in the front. We always like to take as many shots as possible now that we have even our presenter joining us on the stage for that. We have Mr. Garg as well, so we'd also like to capture them together. And now, ladies and gentlemen, of course, as we thank our panelists, thank you so much. We'd now like to call in And we always feel this is one of the most important things to do. When an event is of this caliber, a lot has gone behind the scene. And I think a lot of you would want to appreciate that. We have with us for the closing note, ladies and gentlemen, and vote of thanks, the Chief General Manager, Department of Economic and Policy Analysis, SEBI. Let's give it up for none other than Shri Prabhas Rath. Let's give him a warm round of applause as we welcome him to the dais to deliver the vote of thanks and formally conclude Samvad 2026.
Thank God it's Friday. So normally that's what happens in this kind of an event, because normally it gets late and we get into the late evening and then we say, thank God it's Friday, because then, we get some time to relax. But here we are giving you, thank God it's Friday, the opportunity to say that for a different reason, because your Friday evening remains intact. You can go home, enjoy a good evening. So, dignitaries in the audience, my colleagues from SEBI, NSE, BSE, NSTL, CDSL, MP, and market at large, the students, ladies and gentlemen. We have been hearing quite a few things, and not a few things, a lot of things since the beginning. The words like trust, inclusion, resilience, education, awareness, surveillance, technology, access, artificial intelligence. So quite a few of them. So as you go, let me try to put that in a little bit of framework so that, we keep it in our mind and it remains intact for a longer time. So the focus, what we are trying to do, the entire focus today was on inclusion, including foreign investors, including investors from the second and third tier city, including women in our ecosystem. And for that inclusion, the three things, if you compress them into three things, what we focused on was access, usage, and the quality. So on access, we talked about digital platforms. We talked about ease of onboarding. On the usage, we talked about, how, we can facilitate ease of doing business for people to use the system more. We also talked about liquidity. And we also talked about, how we can have scale and speed in reform as well as in our infrastructure. Then coming to the quality, of course, the entire focus was mostly on the quality part, where we talked about balancing regulations with market development, balancing investor protection with growth, having good quality of financial education and awareness. So all these things we talked about. So basically this access, usage, and quality, it kind of builds up to create that financial inclusion. But what was the ultimate theme that we got from today's discussions? Ultimately, if I can summarize in one line, it would be, ultimately, trust is bankable for inclusion. So that is what we got. So having said that, also let me, before I come to the customary vote of thanks, also let me tell you a little bit about Samvad and how it is different from any other similar kind of event. Samvad, as we know, in Hindi is, it's dialogue. Dialogue means you need two parties to be participating in this and discussing among themselves. So in other events, what happened is that we have one side of the table discussing among themselves that, what is wrong, what is right, and what all should be done. But here, with its spirit of consultation and dialogue, SEBI itself is coming down to the audience at large and the market participant to hear out from them and see how we can further improve our ecosystem. So this is how this Samvad is far more different from so many other events that we are having, and that is getting justified from the scale that we have achieved in last 7 years. So having it in a NISM campus earlier and having few participants to coming to NSE last year and this year having this kind of a crowd, of course, when we come to the last session, the crowd is definitely likely to be thinner. But as we saw in the beginning, and I must tell you that this kind of a crowd we got after, intervening, telling people, some of the crowd not to come actually because we were going over capacity. So that is the kind of response we got. And I am sure that next year as we go, the Samvad is going to reach another scale. So as we conclude Samvad of this year in 2026, let me thank the main actors and players behind making this event possible and making it such a grand success. So there are quite a few names. As you know, this kind of an event involves so many people to come together and do this. So I will try to name out some people, but in case I miss out also, please feel that you are already included in the list. So coming to our team from NSE, including Prasanjit, Manoj, Naman, Vijay, Kunal and team, a huge round of applause and thanks to all of you for contributing to this event. From NISM, Nikhil, Resma, Geeta and team, thank you again for all your effort and time for this event. From BSc, Biraj, Kiran and team. From CDSL, Sudhis, Neha, Sumit and team. A big round of applause for them and thank you. Of course, as we know, we have got a lot of support from all these MIIs, which I named now, and I am also thankful to their leadership for providing all kind of support, including funding support as well as logistic supports, as well as the intellectual support that we got today. So I am profusely thankful to all of them and the leadership of all these MIIs. Now coming to SEBI, I am thankful to our chairman, Sri Tuhin Kanta Pandey, our whole-time member Amarjit Singh and other whole-time members, as well as our executive director Sunil Kadam for encouraging and supporting us to make this possible. But the backbone in organizing this event is ultimately comes down to the people who are working on the ground. And this is not an affair that happens over one day, one night or 7 days. It goes on for months. And I must thank and I must congratulate all those people who have, from SEBI, who made this possible. That includes Dipti LS, the Chief General Manager of our Department of Economic and Policy Analysis, and who has led Deepali Dikshit, our General Manager. Of course, she is the main pillar of this event. And Deepali being supported by Meena Gupta, Polomi, Chaudhary, Anuradha Yadav, Subidha Nagpal, Sudhakar Khernar, Sneha Notial, Ashish, Komal, Aksha, Bina and team. Also, heartiest thanks to all the students, volunteers from NISM and other volunteers from SEBI. Last but not the least, I also would like to thank our last mile support system, which included Ankit, Kavita, and Raj and Kiran, who were our last mile. And as you know, 90 becomes 0, unless it becomes 100. So I am again thankful to Ankita, Kavita, Raj and Kiran for this. And ultimately, no event can be successful without having an enthusiastic audience and having such a patient and disciplined audience. And because of you, we could maintain the timeline and we are able to exactly going on time. Of course, initially it got a little late, but we could cover it. And finally, we are able to end it as we had planned. A big thank you to all of you, and we look forward to see you all again in our next edition of Samvad, most possibly here only. Thank you. Have a good evening. Have a good weekend. Thank you again.
So ladies and gentlemen, since you're all standing, I always think one thing at the end, that we need to give a standing ovation to the organizing team. Come on. Let's give them a big, big round of applause. Let's all clap for one another. Let's all bring the roof down with that energy. Come on, everyone. The maximum round of applause. The 7th edition of Samvad 2026 has happened all because of each and every one of you. It's been such a great moment. We'd just like to once again thank all of you for joining in, and as we draw close to Samvad 2026, I would like to extend a heartfelt thank you to each and everyone present here, our moderators, our panelists, our speakers, and truly our audience members. Definitely, it's been a great edition, and I'm sure you're looking forward to the next one. So stay tuned, but we always feel a warm beverage will enhance the networking. So we'd now like to invite you for some refreshments and tea, which is arranged for you. We just urge all of you to continue with that networking, continue with that spirit, and once again, can we please end on a high note with your applause? I always feel there's nothing better than clapping for the industry. We've had the biggest minds, the biggest leaders, so thank you once again. This is me, Bhavna Bhatia, signing off for today, but maybe urge our audience members to please join us for some coffee and tea. And the organizing team, I need you here with me on the stage. So may I urge all our organizing team members, everybody who's contributed to Samvad 2026, to please now move towards the stage. Every single person, can I please urge you to now join us on the stage. Thank you all, God bless. Drive back home safely, fly back home safely. We'll see you in the next Samvad 2027. Thank you so much. Take care.